Yes, happy evening, one and all. So, welcome to the first session of financial management marathon, I believe. Yeah, you come here to study or revise? Probably a bit of both, huh? Okay. So, we'll be revising or we'll try to revise the entire syllabus of our financial management syllabus in about 10-12 hours maximum is what I'm keeping the agenda as. Okay. So we'll be covering the revision with the help of our chart book. So concepts will be running by everything. Questions also we shall solve, but not as many as we used to do it in our regular class. Because regular class meant for more than 100 hours. This I'm trying to cover within 10 hours. So you can analyze how many problems I'm going to be doing over here. Okay, a few problems I'm going to take you through to get our understanding on the concepts also a little better. Okay, so before I dive in, if you're looking at me for the first time, I'm called CA Sandesh, by the way. Okay, so I know that when I put this video on the marathon, we do get a lot of queries, sir, how to buy this chart book and all. So we'll be revising the things with the help of our chart book. So if you need any guidance with respect to buying of this chart book, you can visit our website learn.ArivuPro.com. I'll just show you quickly. So visit our website learn.ArivuPro.com, or we have another one called online.ArivuPro.com. You can log into anything. So just when you quickly pop in here, select CA. Under that, select CA Intermediate. If you want to buy our recorded classes, select online classes. So all the courses that we are currently selling pops in over here. We have various validity, so you can just select whatever courses that you want to buy, purchase it, and immediately you can get the access. There's no waiting period and all. You can do it, purchase it, and immediately you shall be given the access. That's for the classes. Similarly, if you want to buy the books, so select CA Intermediate. Under that, select books. So various books will pop in. Suppose you want to buy the books for financial management, select financial management, select the book. Study book is our main class notes, and revision book is what we're going to be. I mean, it's a chart book basically, which will be a summarized version of all the contents. So entire FM content I've tried to summarize in about 35 to 40 odd pages. That's what we call it as chart book or revision book. So just add it to the cart, give your attempt, give the right phone number and delivery address. The books will be delivered to your place. Okay, that's about buying the books. Okay, now before I dive into the topic, one requirement of attending this marathon is once you should have already studied. Okay, sir, I have not studied at all, sir. First time I'm opening FM and I want to see your FM class, and ultimately I want to clear FM exam, sir. Would that be possible, sir? Sir, ideally that is not what is recommended, because this is a revision class. So we'll cover everything, but problems wise we can't do that many as we used to do in our regular class. And also the pace of the revision class is probably going to be on the little higher side, because I have to cover everything in a short span of time. The target is that. Okay, so one of the requirement is you should have already studied once. If at all you feel you have not studied or you don't have time to study and this is the only way for you to which, I'll try my best to cover as much as possible. Is that okay? I'll not give any assurance that only by watching this you'll get exemption and all that stuff. Okay, because I mean, I don't want to take anyone's credit. I always tell this in my regular class. If a student passes, it's entirely his effort. If a student doesn't pass, it's also entirely his lack of concentration or his lack of efforts only. Okay, because teacher ka only job is to teach, because your job is to go there and write the examination. So examination result is entirely yours. I would not like to take any credit, for that matter any blame also. Works both the ways. So having that said, that in mind, can we dive into our first topic itself, people? Okay, so the first topic we shall be revising is cost of capital. Cost of capital. So cost of capital, as the name itself is saying. Sir, if you want to do any particular project, let's say we want to open another branch in Hyderabad. Currently, we have a branch in Bangalore and Chennai. We want to open a branch in Hyderabad. For that, we need funds. Will we get any fund for that matter at free of cost? I can raise the fund either by issuing equity shares or preference shares, or I can take a bank loan. Will any of this capital come at free of cost, or there will be a cost associated with it? Cost associated with that. That is what we are trying to compute in this particular chapter. Each source of finance has a cost. What is that cost is what we are trying to compute. Okay, and cost here refers to not the actual amount or actual, like you're paying 10%. Let's say you've taken a bank loan, and on that loan you're paying how much interest rate, I assume? 10%. 10% is not the cost of the debt. Cost here refers to the expected rate of return. Okay, it's not the actual rate of return. It is the cost here refers to the expected rate of return by whom? Who is giving you the finance? providers. So from the providers of finance perspective, you have to find out what is their expectation. That expected return only is what we refer to as cost over here. Okay. All right. Let's go into the other thing now. The first source of finance is long-term debt. When we say long-term debt, we are talking about here debentures and bank loan. Okay. So whenever you have debentures or bank loan, first check whether it is a redeemable debt or irredeemable debt. If it is irredeemable debt, then cost of debt is given by the formula interest into 1 minus tax rate divided by net proceeds. I here stands for interest amount, T here stands for tax rate, NP here stands for net proceeds. Okay. Irredeemable means what, sir? You have taken a debt and you don't have any obligation to pay. Normally, when you take a debt, it will have a term, no, 5 years, 10 years, etc., etc. If it has a specific term, we call that as a redeemable debt. If it has no term, then we call it as what, sir? Irredeemable debt, meaning it goes on forever. So then this is the cost of the debt for this perspective. However, if it's a redeemable debt, then cost of the debt is given by the formula interest into 1 minus tax rate plus RV minus NP divided by N. Whole thing divided by RV plus NP divided by 2. So this is what you get. I here stands for interest amount, T for tax rate, RV for redemption value, NP for net proceeds, N for not total life, N for remaining life, and average of these two. Is that okay? Sir, if you're giving 10% interest on this debenture holders, isn't 10% cost of debt, sir? No. Let's say you have issued, you're paying interest at the rate of 10%. 10% itself cannot be cost of debt because interest is an expense. Due to your expense, what will happen to your profits? Profit will reduce. If profit reduces means your tax amount also will reduce. That means on interest, you will always get some tax benefit. So that means the cost of debt is not really 10%, it is lesser. That is the reason we have to compute it this way. Okay, Saru? Alright, that's one. So these two methods only we call it as approximation method. These are not perfect cost of debt. These are what, sir? Approximation method, because they only give you an approximate number of the cost of debt. There is another way to get the cost of debt that we call it as IRR, as in internal rate of return. How do you get the cost of debt using IRR method? Take IRR ka formula. We have done a number of problems. What is that? Lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate. Whole thing multiplied by higher rate minus lower rate. Okay. So in FM, the whole crux is remembering its majority of the topics, no, sir, runs on your memory. If you remember those formulas, you will get full marks. The point of view is to make sure that on the examination day, you remember all these formulas. So that's the reason chart book plays an important role. Okay. And the last day, quickly, even if you don't want to buy chart book, not a big deal. Formulas and all, write it in one place. So that just before you go to the examination hall, don't take the chit up. Write the formulas in one piece of paper, quickly revise and go if you're a forgetful person. Okay. But do not by any chance also, by mistake also, don't carry that chit to your examination hall. The repercussions or consequences are very, very high in professional examination. You might be barred for life or for many attempts. I don't know about that. So watchful, because many people have that habit of writing down small notes and keeping it in the pocket. And later they forget and they take it off only. Yeah. Okay. So let's not get into that particular scenario and all. Okay. That's one. Okay. Let's quickly again. What is it? Tell me, sir. Cost of debt. How do you get first? Whenever there is a debt, you will check whether it is a redeemable debt or a irredeemable debt. Redeemable debt means what, sir? At some point of time, you need to pay back the money to the debenture holders. Irredeemable debt means no obligation to pay. Only one obligation is there, that is to pay interest. Okay. So if it is redeemable or if it is irredeemable, then cost of debt is given by the formula interest into 1 minus tax rate divided by net proceeds. However, if it's a redeemable, then interest into 1 minus tax rate plus RV minus NP divided by N. Whole thing by RV plus NP divided by 2. RV means what? Redemption value. NP means what, sir? Before NP ka full form is net proceeds. But before you plug in amount towards net proceeds, first check whether these are existing debt or new debt. If it is a new debt, then NP becomes issue price. If it's a new debt, means you are issuing the debenture. You will issue it at some price. That means the issue price itself becomes what, sir? New debt. However, if it's an existing debt, then the market price will become the NP. So NP you'll have to read the data and accordingly take it. If it's existing, you'll take market price. If it is a new one, you'll take issue price. However, if there is any flotation cost, always you need to reduce it. So what does flotation cost mean? Name itself is saying flotation cost, meaning these are nothing but issue expenses. When you have to issue the debentures and all, you will have to give it to many people. That means you will take the help of some brokers. The broker will charge some commission. That only we call it as underwriting commission. So basically all this issue expense only we call it as flotation cost. If it is there, do not forget to bring them into your formula. Okay, that's about cost of debt. Next is what, sir? Another one is cost of, or maybe one more is there. If you have any convertible debt, what to do? Because you could also have some convertible debentures. If you have convertible debentures means, then the main question will revolve around redemption value. Because there could be two types of redemption value. Because if it's a convertible debt, then company will give the option to the debenture holders. What option? Either to take cash or to convert debentures into equity shares. Yes, no? That means the redemption value could either be a cash value or a shares value. So what you have to do for cost of debt calculation in case of redeemable or convertible debentures is first find out redemption value in cash and then find redemption value in shares. Now you tell me, if you are a debenture holders, which one will you go for? I'm one company, I gave you one option, either to take cash option or share option. Which one will you go for? Whichever is more beneficial for you. So that means calculate both and you'll take the lower amount or higher amount. Higher of the two will become your redemption value for calculation perspective. All this we have done, every problem, all concept we have applied in our regular class problem. But I'll quickly discuss and take only 2 or 3 problems from this chapter at the end. First, quickly we'll revise everything. Okay. This is about cost of redeemable or convertible debentures and redeemable debentures, both we have covered. Next is cost of preference shares. Now, if you know cost of debt, you also know cost of preference shares. Because on debentures, what do you pay? Interest. On preference shares, what do you pay? Dividend. Preference dividend. Now here also, whenever there is a preference shares, check whether these are redeemable preference shares or irredeemable preference shares. If it is irredeemable preference shares, means then the cost of preference shares denoted by the symbol KP is given by, there it was interest into 1 minus tax rate. Here you will simply write preference dividend or PD. So why you will not do 1 minus tax rate? Because only interest is an expense. On expense you will get tax benefit, but dividend and all you will pay only after paying tax to the government. Dividend is not an expense, it's an appropriation item. On dividend you will not get any tax benefit. So dividend don't do 1 minus tax rate. So the formula will be what, sir? Preference dividend divided by net proceeds. That is the case in case of irredeemable preference shares. However, if it's a redeemable preference share, same thing. What is the formula? First leg of the formula will be preference dividend plus RV minus NP divided by N. Whole thing divided by RV plus NP divided by 2. Okay, RV is still the same, which is redemption value. NP is still the same, which is your net proceeds. N is still the same, which is remaining life. Okay, net proceeds also same thing. If it's a new preference shares, you will take issue price. If it's existing preference shares, you will take market price. However, if there is any flotation cost, consider it or deduct it under both the circumstances. That's about your cost of preference shares. Can I move on to the next one? Next is what's the cost of equity shares. Cost of equity shares is denoted by the symbol KE. Okay, for cost of preference shares, we have various formula. One is your dividend approach. Dividend approach assumes that the company pays equity dividend at a constant rate, same dividend every year. So under dividend approach, the cost of equity is given by the formula dividend divided by net proceeds. Dividend divided by net proceeds, as in current market price also you can take. That's what we mean by this. Okay, so dividend divided by current market price will give you your cost of equity shares under dividend approach. Second one is your earnings approach. How do you get cost of equity under earnings approach? EPS divided by MPS. EPS divided by MPS. Sir, 1 second. How do you get PE ratio? Can you tell me? How do you get, what does PE ratio mean? Price earning ratio. So name itself is saying price earning ratio. PE ratio is given by the formula MPS divided by EPS. Correct? Now here, what did you write? You check. Cost of equity is given by what, sir? EPS divided by MPS. This is MPS divided by EPS. And this is EPS divided by MPS. That means, is there any connection between cost of equity and PE ratio? Yeah. PE ratio, can I say cost of equity is ulta of PE ratio? Cost of equity is reverse of PE ratio. That means if they give you PE ratio in the problem, can you find out cost of equity? Yes. How can you find out? Cost of equity is given by the formula 1 divided by PE ratio. Sometimes they give you this adjustment in the question, so watch out. Okay, sir. So 1 divided by PE ratio also will give you cost of equity, because cost of equity and PE ratio have an inverse relationship or ulta relationship. Okay, next, the most important one with respect to cost of equity is our Gordon's growth model. Okay, one our Dev bro, Gordon Saya bro has given one formula. How do you get cost of equity as per Gordon, sir? This is nothing but your D0. Either it could be D, first maybe we'll talk about this. D0 into 1 plus growth rate divided by P0 as in current market price minus flotation cost, whole thing added by the growth rate. D0 stands here what? D0 here stands for the dividend already paid. Dividend already paid, we call it as D0. G here stands for growth rate. P0 here stands for current market price. G again stands for your growth rate. F for your flotation cost. Okay. Every formula you need to remember. Not even single formula will be given to you in the question. Okay. If you know it, FM is a very, very scoring subject. Not only provided if you remember it. Otherwise, goinda, like that wala scenario. Okay. So again, what is it? Gordon cuts is important one. Tell me once again, how do you get cost of equity as per Gordon? D0 into 1 plus growth rate divided by P0 minus flotation cost plus whole thing added by the growth rate. Okay. All right. Or instead of D0, if you do in fact here, sir, excuse me, D0 is 10 rupees. Growth rate is 5%. Okay. That means dividend already paid how much? 10 rupees. D0 means dividend already paid. How much is the growth rate? 5%. That means what is the expected dividend in the next year? Will it be 10 now or it will increase by 5% now? It will increase by 5%. Take in your do your calculator. 10 plus 5% is how much? 10.5. Correct? Either you can get like this or you tell me what is the numerator what we have written? D0 into 1 plus growth rate. So let's do D0 into 1 plus growth rate. How much is D0? 10 plus 1 plus growth rate is how much? 1.05. 10 into 1.05 is how much, sir? 10.05. Are you getting different number or same number? That means effectively numerator mein what are we trying to calculate? We're trying to calculate D1. We want actually D1. Sometimes in the problem they'll directly give you D1 or sometimes in the problem they'll give you D0. If they give you D0 into 1 plus growth rate will give you your D1. Okay, do like that. Or if they directly give D1 means what will be your formula? Reconstructed formula. If they directly give D1 in the question, then D1 divided by P0 minus flotation cost plus growth rate. So watch out. They may give one of those two numbers in the examination. Okay, that's it. Alright. So how do you find out growth rate? Growth rate ka one formula is B multiplied by R. B as in retention ratio. B as in retention ratio. R is your rate of return on your investment. Like here, sir, EPS of a company is 10 rupees. Earnings per share is 10 rupees. Dividend the company paid is 3 rupees. How much the company earned? 10 rupees. How much dividend on one share they are paying? 3. That means, can you tell me what is the dividend payout ratio? How much percentage of earning is distributed as a dividend? How much percentage of earnings is distributed as dividend? Out of 10 rupees, you are giving away 3 rupees as a dividend. That means dividend payout ratio is nothing but DPS divided by EPS. Do that. 3 divided by 10 into 100 if you do, you're getting 30%. Correct? Means indirectly, how much ever company is earning, 30% of that they are distributing it as dividend. Yes. Entire they are distributing or only 30%? 30%. That means how much are they retaining? How much is the company retaining? 70%. That too is denoted by the symbol B. B as in retention ratio. B here is how much percentage? 70% or 0.7. Is that okay? So that is what we said over here as B. Okay. So growth rate is given by the formula B multiplied by R. I have proved it to you with numbers in our regular class. Why G is equal to B into R. For now, I will not have time to go through the logics of all the formula. And that is not the intention also. Okay. When you're learning it for the first time, you need all what, sir? Logico, reasons, and all that. For 1 week before examination and all, if you say I want logic, then magic will not happen in exam. Okay. So we'll have to priorities first to clear the examination. So when you're having time, aram se when you're learning, try to know everything. But when you're on the last moment, don't break your head. Hook or crook, we have to make sure that what? We clear the examination. Okay. So G is given by what formula again? B multiplied by R. B as in retention ratio. R is your rate of return on investment. They will give it to you in the problem. Or another way to find out growth rate is just trial and error method. They will give you 3 years ka EPS. You can compare and see that EPS of all the years will not be same. It will keep increasing. In one of the problem, I will take you through. By approximation or by looking at it also, you can figure out the growth rate. Okay, that's one. Next, cost of equity you can find out through another model called CAPM, Capital Asset Pricing Model. Okay, so capital asset pricing model में cost of equity is given by the formula RF plus beta into RM minus RF. RF here stands for risk-free rate of return. B stands for beta over here. RM is for market return. RF again is your risk-free rate of return. What the funda of CAPM model is? Let's say government of India, state government or central government. So even government needs money for their investment, correct? For metro, rail construction, highway building and all that. So when government needs money, what do? One way is they'll collect the money through taxes. Let's say that is not sufficient. Then what they'll do is issue some bonds. Governments will issue some bonds. Could be central government or state government. Let's say if central government is issuing some bond means, can they issue this bond at free of cost? They're telling to the investors, you buy my bond, I will give you nothing in return. Will anybody buy? No. Obviously, if the government is issuing bond means they have to issue interest. Okay. Let's say on these bond, government is paying a return of 7%. Now, will we trust our government? Election time, compulsorily we should say yes only. Okay. Obviously. Sir, 7% is what we refer to as risk-free rate of return. Government of India ka bonds. Okay, all that we call it as RBI ka bonds, government bonds and all. We call it as risk-free because we don't have to take any risk to earn the 7%. Okay, you just have to give your money to central government or state government. They will give you how much? 7% in this particular case. That only we call it as what, sir? Risk-free rate of return. Now, we are in business now. ArivuPro, we are in coaching business. Now, you tell me, do I want to earn only 7%? Sir, if I want to just earn 7%, why will I open academy? Why will we bother opening academy? We'll simply invest money in government bonds. Any which way, aram se we will get 7%. If we are doing business means, tell me, we will expect 7% or a lot higher? Lot higher. Is that okay? Generally, let's say market return is 12%. On an average, market mein business is giving how much return? 12%. Now you tell me, just because market gives 12% return, do I want that much only or I would want to beat the market? Like Sensex gives 13% return. Sensex, Nifty, BSE index year on year, if you just check, they pay around 12 to 13%. Now you talk to any investor and tell, I will give you 12 to 13% return. What do you think they will say? Oh, I want 20% return. I want 40%. Some crazy fellow will say, I want to double my money in 6 months. Later, then money only will get doubled, but just that he'll not see that money. Yeah, it'll get doubled for somebody else, definitely not for him. Okay, so just saying. So if you're doing a business means you don't want market rate of return, you want a little more. Let's say beta of a particular company is 2. It will be given to you in the question. Beta of a particular company is 2. What it means is, if now you tell me, how much is the risk-free rate of return? 7%. How much is market giving the return? 12%. Now means, sir, by taking risk, market is generating how much return? Without taking risk, 7% anybody can generate. Yes, no? But market is generating how much return? 12%. That means market is taking some risk. By taking risk, how much extra return they are getting? Over and above 7% is how much? 5%. That means market by taking risk is generating 5% extra. We as a company would like to generate only this 5% extra or lot more? Lot more. That is denoted by the symbol beta. What beta simple says is, if beta is 2, then if market takes extra return and if they market generate 1% return means this company will generate 1% into 2, which is 2%. If market takes a risk and generate 3% extra means, and if the beta of the company is 2, then this company will not generate 3%. It will generate twice of that, which is 6%. That's all is a whole funda about beta. Okay. Fair enough, everybody. It measures the volatility, the risk, association with the company and market. Okay. Now here check. If beta is 2, then logically you think, by taking risk, how much extra market generated? 5%. Market generated how much extra? 5%. And if the beta of the company is 2 means how much will company generate? Will they generate 5 or twice of that? Twice of that. That is how much? 10%. But anyway, without risk, everybody earns how much? 7%. That means what is the total return of the company? By taking risk, they will generate 10% extra. Without taking risk, everybody will anyway generate 7%. That means the total return is how much? 7%. That's the logic. If you don't want to know all the logic, simple formula, what is that? Cost of equity is simple, given by the formula RM. RM or F? RF plus beta into RM minus RF. Plug the numbers into your formula, you will get the answer. Is that okay? If you forget the formula, you can construct your own formula. That's the reason. Little backdrop about all this. Yes, sir? Okay. So this is about CAPM. Next, realized yield approach. Realized yield approach is nothing but IRR. Tell me again, how do you get IRR ka formula? Once again, we'll write plus lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate. Whole thing multiplied by higher rate minus lower rate. Okay, sir, what is this higher or lower nonsense you are telling? I'll tell you in case you have not studied at all. Don't worry about IRR. We'll do something called investment decision topic. There, I'll take you through the IRR per se. What is this lower or higher earn? Is that fine? Others must not be. I think you are comfortable, I believe. Okay. All right. Next is the cost of retained earnings. Cost of retained earnings. Basically, in this topic, you need to compute 4 costs. One is cost of debt. Another one, cost of preference shares, cost of equity shares, and cost of retained earnings. So retained earnings also will have cost. Absolutely yes. Sir, let's say a company earned, company ka earnings is 10 lakh rupees. Company ka earnings is 10 lakh rupees. Earnings belongs to whom? Shareholders. Okay. Now company decided to pay 0 dividend to the shareholders. Company decided to pay 0 dividend to the shareholders. How much they earned? 10 lakh. Ideally, entire 10 lakh should be given to shareholders. But how much the company gave? 0. Why is the company not giving? Because company has some expansion plan. Company wants to expand. Sir, if they want to expand means they themselves need the money. So hence they said whatever they have earned, they will not distribute it as dividend, but rather they will keep it with themselves. This only we call it as what, sir? Retained earnings. Company has earned some money and have they distributed or retained with themselves? They have retained with themselves. And then hence the name retained earnings. Now you tell me, how will you be able to convince the equity shareholders now? Because this earnings of 10 lakh belongs to equity shareholders. Are you giving dividend or you're not giving? You're not giving. So that means how will you convince them? By telling, hey macha, hang on. If I expand from current market price, the shares will become so high, you will become crorepati. Like that, you will convince your shareholders. Yes, no? That means shareholder is sacrificing something. Can you tell me what is he sacrificing currently? He's sacrificing dividend. Yes or no? So that sacrificed element of dividend only constitutes the cost here. Because whatever is earnings is not distributed as dividend. The equity shareholders for the time being are ready to sacrifice. That only we're calling it as cost. And that is nothing but denoted by the symbol KR. KR as in cost of retained earnings. So cost of equity and cost of retained earnings ka calculation is ditto, ditto, ditto. Okay. But the only thing difference between cost of equity and cost of retained earnings is in case of cost of equity, there will be some or there may be some flotation cost. But when it comes to cost of retained earnings, there will not be any flotation cost. What does flotation cost mean? The issue expense. Okay. See, think logically. If you are issuing equity shares, can you pay some underwriters or some consultants? Yeah. That only we call it as what? Flotation cost. Retained earnings means, are you giving new instrument or it is earnings kept with the company? Earnings kept with the company. So is there any instrument being issued? No. That means in case of retained earnings, will there be any flotation cost or no flotation cost? No flotation cost. That means same formula, KR and KK formula is same. Okay. And there is also a relationship also. If they give you cost of equity, can you find out cost of retained earnings? Yeah. KR is given by the formula KE as in cost of equity into 1 minus flotation cost minus into 1 minus TP. TP as in personal tax rate of the shareholders. Okay. Personal tax means your earlier dividend used to be taxable in the hands of shareholders. Okay. So that means if let's say an investor got 10% dividend, he has to pay 2% to the government as tax. That means net how much is his return? 10% he got it as dividend. On that dividend, how much tax he needs to pay to the government? I've assumed 2%. So net how much he generated? 8%. That means due to this tax, personal tax, isn't his return reducing? What did we say? Cost of capital when I started. Cost means actual or expected return. Expected return. So here is it 10% or 8%? 8%. Hence, if there is any personal tax given in the problem, reduce it. Most probably it will not be. If at all it is there, give it off. Okay. So that's about your cost of retained earnings. Individually, most probably all this instrument they will not ask. From this particular chapter, the most popular question is WACC, as in weighted average cost of capital. What is this weighted average cost of capital? Simple funda. Let's say we want to do one project. Company wants to do one project. They need 10 lakh rupees. What are the ways through which company can raise this 10 lakh? One by issuing equity shares, or by preference shares, or by loan. Okay. Company we will do chow chow bath. We will go for everything. Out of 10 lakh, 5 lakh they raised by new equity shares. 3 lakh they raised by new preference shares. 2 lakh they went for debt. Possible. Company ka choice. However they want, they can raise the money. Let's say cost of equity shares is 15%. Cost of preference shares is 10%. Cost of debt is 8%. That means you have one instrument or multiple instrument. Multiple instrument. And these instruments have same cost or different cost. Different cost. Now you want to know whether this project is successful or a failure. Project means it will generate some return. Also. Yes. For this purpose, we calculate something called KO. We calculate something called KO. KO as in overall cost of capital. Meaning if you have multiple instrument, you have to calculate something called, normally how do you find out if you have 3 instrument? You normally find out average. You find out average. How do you find average? If they give you 3 rate, how do you find out average? Add everything, divide by 3. Correct? But here we don't do it like this. It's not simple average. It is weighted average cost of capital. The reason is you will raise entire money in the same ratio or different ratio. Like here, check. Out of 10 lakh, how much came through equity shares? 5 lakh, as in 50%. Correct? Because 10 lakh ka 50% is how much? 5 lakh. Out of 10 lakh, how much came through preference shares? 30%. Out of 10 lakh, how much came through debt? 20%. That means is a percentage of finance same or different? Different. Hence, we have to keep this also in mind and then calculate average. Such an average only we call it as weighted average cost of capital. Is that okay? And WACC is only required when you have more than one source of finance. And this overall cost of capital is denoted by the symbol what, sir? KO. Let's say KO is 15%. Overall cost of capital is 15%. That project return is 20%. Accept the project or reject the project. Accept or reject. So the cost is 15%, but the project is generating a return of 20%. That means what is a simple? If R is greater than cost of equity, accept the project. If R is lesser than overall cost of capital means reject the proposal. So that means overall cost of capital will help you to determine whether we should accept the project or reject the project. So how do we calculate weighted average cost of capital? Very simple. We used to keep this formula format in our table. Everybody remembers. First, find what is the source of finance? From what and all have you raised money? For simplicity, I have taken equity and debt. You could have more than one. It's fine. Equity you have raised how much, sir? 3 lakh. Debt how much, sir? 2 lakh. That means what is the total source of finance? 5 lakh. Out of 5 lakh, 3 lakh has come through equity shares. Can you tell me the percentage? Out of 5 lakh, 3 lakh has come through equity shares. How do you find out percentage? 3 lakh divided by 5 lakh into how much is that? 60%. That is your weights. That is your weight. Of your total capital, 60% has come through equity shares. Okay, this is your weight. Let's say cost of capital, after tax cost of equity is how much? 15%. So how to calculate this? We already saw now. There are 6 ways to calculate cost of equity. Dividend approach, earnings approach, Gordon model and all that stuff. They will tell you which method, accordingly data will be given. First, find out cost of equity. Here I've assumed it to be how much? 15%. Okay. Weighted average cost of capital funda is very simple. 15% is your overall cost of capital, provided entire 100% of the money had come through equity shares. If entire 100% had come from equity shares, means overall cost of capital will be 15%. But here entire money came through equity shares or only 60%? 60%. So how do you find out WACC? Simply take the cost of that instrument multiplied by the weights. So these took a multiplication. That's one. Cost of that instrument multiplied by the weights. So 15 ka 60% is how much? 9%. Similarly, next instrument ka cost of debt. What is the total source of finance? 5 lakh. In that, how much has come through debt? 2 lakh. So what percentage of total finance is raised through debt? 2 lakh divided by 5 lakh into 100, which is 40%. Of your total finance, 40% has come through debt. What is the cost of debt I've assumed? 10%. You can take 10% as overall cost of capital provided every money, total money has come through debt. Here total money has come through debt or only 40%? 40%. So what to do? Take the cost of capital multiplied by the weight. Here weight is 40%. So 10 ka 40% is how much? 4. So add these two, that becomes your 13% becomes your overall cost of capital. That's all. Is a simple funda. Yes, sir. So or in layman terms, one line if you have to tell me simply what is it? Take the cost of that instrument multiplied by the weight. If you have 3 instruments, do the same exercise and sum it up. That summed up number or the total number only we call it as overall cost of capital. Okay. So what about this weight, sir? How can you calculate? There are 2 ways through which you can calculate weights. One is the market value approach. Another one is book value approach. Book value approach means you would have raised this instrument today or possible that many years ago also. You would have raised this instrument 4-5 years back. Correct. So currently you are showing this in your books. Currently you are showing this in your books. That book value we call it as book value weight. Whatever value you are showing that instrument in your books, we call it as a book value. Okay. Market value means the current value. Current value. Now you tell me which is the priority. If the question gives you both market value and book value, ideally what you should take? Market value, because we are trying to find out cost 3 years ago or now. Now. Book value means it's a value now or many years ago. Many years ago. Which is the most relevant value? Market value. Hence, first preference should always be given to what, sir? Market value. Okay. Normally examination question will be very clear. They will say calculate weighted average cost of capital using book value. Or they will say calculate overall cost of capital using market value. If they don't tell anything and if all the information is available, one approach is you can calculate under book value also. You can calculate under market value also. Okay. But if they say first preference or if it comes as an MCQ question, book value or market value, which is more preferred, you'll always select market value. Okay, that's fine. Okay, the last theoretical concept with respect to this particular concept is marginal cost of capital. Marginal cost of capital means the cost of raising additional finance. The cost to raise additional finance, we call it as marginal cost of capital. So what is this, sir? So let's say earlier cost of debt is 10%. We've already taken a debt and the cost of the debt is how much I've assumed? 10%. Overall cost of capital is 12%. This is already there. Done. Now, sir, company wants to expand and they need extra money. They need extra money. They want to raise it through debt only. They will raise this extra money through debt. And the cost of the debt is 13% now. Earlier, what was the cost? 10%. Now, how much is it? 13%. So, why it raised? Sir, debt is a risky business. No? Like, let's say you already taken 10 crore loan from bank. 10 crore loan you have already taken from bank. Bank told you, no problem, I will give you 10% interest rate. I will give you the loan at the rate of 10%. Now, again, after 2 years, you went to bank and told, I want 50 crore loan. I want another 50 crore loan. Now, you tell me, bank will be just like that. They will sanction the loan or they will have little buku. Little buku. Why? Sir, you are taking bindas huge amount of loan, but you should also have repayment capacity. The bank did their analysis and came to know that you don't have too much of repayment capacity. That means the risk has become high. Now, do you think they will sanction the loan at 10% or higher rate? Now the bank may say, I will give you the loan, but I will not give it at 10%. I will give it to you at 13%. Is that okay with you? So that means the new fund we have raised at what rate now? 13%. Is the overall cost of capital, will it still be 12% or it will change? Change. Because overall cost of capital is nothing but average. You have issued now new instrument at a same rate or different rate? Different rate. Okay. That means your overall cost of capital after this new funds will be same or it will change. That only we refer it to as marginal cost of capital. You raised a new fund. After you raise a new funds, your existing overall cost of capital will not be same. Rather, it will change. Why it changed? Because you went for new source of finance. That only we call it as marginal cost of capital. One among these two is a popular question in examination. That's what we'll be solving. Okay. As a recap, quickly we'll sum up everything within 5 minutes. Okay. Chapter name. Is that okay with you? Because we'll try to do revision within revision, because all these are mostly driven by formats and formulas. The more and more you practice, the more and more you remember. It's not like accounts. Once you know, easily you can apply. There's an end-to-end connect. But when it comes to FM, the whole crux revolves around memory. How much you remember your formulas. So that's the reason we'll quickly once again sum up the whole thing. Chapter name, cost of capital. Cost here refers to actual cost or expected rate of return. For investors, it is a return. For company, it is a cost. At expected return only, here we're calling it as cost. So what are the types of finance that you can raise? Equity shares, preference shares, debt, retained earnings. So how do you get cost of debt, sir? Whenever there is a debt, first check whether they are redeemable or irredeemable. Irredeemable means should you have to pay back? You have to pay interest, but you have to pay back principal, not required. That's what we mean by irredeemable. Irredeemable debt is given by the formula interest into 1 minus tax rate divided by net proceeds. However, if it's a redeemable debt, then cost of debt is given by the formula interest amount into 1 minus tax rate plus RV minus NP divided by N. Whole thing divided by RV plus NP divided by 2. Perfect. These two methods we call it as approximation method. You can also find cost of debt using IRR method also. Alright, then going for if it's a convertible debentures, then what you'll do? You'll find out redemption value or two values. One is at cash value, cash option or shares option. Whichever is higher will be taken as redemption value. Then cost of preference shares, any fancy formula or same. Instead of interest into 1 minus tax rate, substitute that with preference dividend. On interest, you will get tax benefit. That's the reason you do 1 minus tax rate. On preference dividend, you don't get any tax rate. So if it is irredeemable preference shares, then cost of preference shares denoted by the same symbol KP is given by preference dividend divided by net proceeds. If it's however redeemable, then preference dividend plus RV minus NP divided by N, whole thing divided by RV plus NP divided by 2. Okay, RV as in redemption value. NP could be one of the two things. What are those one of the two things? If it's a new instrument, issue price minus flotation cost. If it's an existing instrument, market price minus flotation cost. Awesome. Next is cost of retained earnings. In fact, cost of equity. For cost of equity, we have one dividend approach. How do you get dividend approach? Dividend divided by market price. Then earnings price approach. EPS divided by MPS. Or another way, 1 divided by PE ratio. Okay, then another one is your Gordon Ka formula. How do you get Gordon's Ka growth model? Either you can take D0. First check whether in the question they've given D0 or D1. If they've given D0, then the formula will be D0 into 1 plus growth rate divided by P0 minus flotation cost. Whole thing added by the growth rate. Or if they've given directly D1. D1 as an expected dividend in future. If they've given that, then the formula will be D1 divided by P0 minus flotation cost plus the growth rate. That's one. Then you can go for a CAPM model. CAPM as in capital asset pricing model. Cost of equity is given by the formula risk-free rate of return. That is RF plus beta into RM minus RF. That RM minus RF, some books also will denote it as risk premium. Okay. Alright, that is one. Then is you can also find out cost of equity using IRR method also. Then cost of retained earnings. Do we have any new method? No. Cost of retained earnings and cost of equity are same, except that on equity shares you may have flotation cost. On retained earnings you will not have any flotation cost. That's only difference. Okay. Then there is a relationship between KR and KE. How do you find out cost of retained earnings? Cost of equity into 1 minus flotation cost into whole thing multiplied by 1 minus TP as in personal tax rate. Then the last aspect is WACC. WACC means weighted average cost of capital. What do you have to do? Simply take that instrument ka cost, multiply by that instrument ka weightage. That's all you have to do and sum it up. That summed up number only is overall cost of capital. The last one is marginal cost of capital. Marginal cost of capital means cost of raising additional finance. Since additional finance, you will raise it at a different cost. Your overall cost of capital will be same or it will change. That changed the number. That only we call it as marginal cost of capital. That was your quick theoretical revision. Can we quickly, or maybe one more is there, then we will dive into the problem. One more aspect is, sir, if you don't have any information, meaning if RV and NP, if it is same. Okay, let's take a number and first prove it. Excuse me. Sir, cost, face value of a particular instrument is 100 rupees. Interest rate is 10%. Interest rate is 10%. Tax rate is 30%. Redemption value is 100 rupees. Issue price is also 100 rupees. Okay. So the moment they give you RV, it's a irredeemable debt or a redeemable debt? It's a redeemable debt. Let's say life of this instrument is 10 years. So that means how do you calculate cost of this debt, sir? Same, interest into 1 minus tax rate plus RV minus NP divided by N. Whole thing divided by RV plus NP divided by 2. Plug in the number. What is the face value of the instrument? 100. What is the interest rate? 10%. 100 ka 10% is how much? 10 rupees. That is your interest amount on one debenture into 1 minus tax rate. Tax rate is 30%. 30% if you want to express in full, that will be 0.3 plus RV. RV is how much? 100. NP is how much? 100. Because these are new instrument, I only given. How much is that? IP is how much, sir? 100. So 100 minus 100 is how much, sir? 0. That means this is relevant or becomes irrelevant. Irrelevant. Okay. Whole thing divided by RV. RV is how much? 100 plus NP divided by 2. So calculate this. How much are you getting? You're getting 7%. Correct? Huh? So instead of doing all this drama, there is a shortcut method. If RV and NP, if it is same, if RV and NP, if it is same, then simply cost of debt is given with the formula interest rate. Cost of debt is given with the formula interest rate into 1 minus tax rate. What is the interest rate here? 10%. What is tax rate? 30%. So calculate that. What are you getting? 7%. That means you don't have to do all this drama when RV is equal to NP. Only when RV is equal to NP, you can straight away plug in this number and get it. We also applied this in our regular class. Okay. Sometimes they give all this also. So watch out. Fair enough, people? Okay. Let's go for solving some questions. There's an RTP question. So let's run through this question. Tota. Oh, okay. Some Tota. They have the following capital structure as on 31st December 2023. They have 12% debentures, 4.5 lakh, 10% preference share capital, 1.5 lakh, equity share capital, 2 lakh, shares of 24 lakh. So if you add all this, how much are you getting? 30 lakh. So out of 30 lakh, the instrument has come. Can you also tell me the weight, sir, quickly? Out of 30 lakh, 4.5 lakh has come through debentures. That means what is the weight? 4.5 lakh divided by 30 lakh. 0.15%. 0.15 or 15%. Second one, out of 30 lakh, 15 lakh has come through preference share capital. How much is percentage? 5.5%. That means balance will be what, 20% or 80% rather. 24 lakh divided by 30 lakh if you do, you're going to get 0.8, which is nothing but 80%. They'll ask you WACC, so we need the weights. So we've written that quickly. Okay. Company share. So all you have to do is when you read the data, identify what they've given and just plug in those numbers into your respective formulas. Okay. So check. I can maintain the space, no? Is that okay with everybody? Yeah. Because I want to cover everything within short time. Understandable? Okay. So company has a current market price of 30.25. Okay. This only we call it as P naught. Current market price only we call it as P naught. Okay. Expected dividend in the next year. Not dividend declared. They gave expected dividend. Expected dividend means D naught or D1. So that means what they've given this, there's nothing but expected dividend means it is D1. Directly given, huh? No. They're saying expected dividend per share in the next year is 50% of 2023 ka EPS. This is your 2023. This is your EPS. How much is this? 3.023. That means what is your D1? 3.023 ka 50% is what problem is saying. 1.551. No, I think they've asked us to take only 2 decimals here somewhere. I think I saw. It's okay. How much are you getting? Maybe we'll like full, we'll figure it out. 1.5115. Okay, that is your D1. Okay. Next, EPS for the last 10 years they've given. Last 10 years ka EPS, why have they given? If you just check every year ka EPS is same or it is increasing. Increase. You can use trial and error method and figure it out. Okay. One is try it out at 7%. Take 1.118 and add 8% or 7% you do. How much are you getting? 1.18 plus 7% if you do. 1.26. The answer should be 1.31. So the 7% is growth rate. No. So try 1.18 plus 10%. 1.18 plus 10% you do. 1.29 you're getting. Maybe try it closer number. So 1.18 plus 11% you do. 1.18 plus 11%. 1.309. That is nothing but 311. So that means what is the growth rate? 11%. Like this trial and error you can use, or you can also check the change. Like this also you can do. What is your latest EPS? Anything you can take, but I'll take the latest EPS. What is the latest EPS? 3.023. What is previous year ka EPS? 2.723. So compared to this, has the EPS increased? Tell me how much is the increase amount? These two are difference, you tell me. 3.023 minus 2.723 is how much? 0.3. 0.3. Sir, how do you, if I ask you to tell me increase percentage, how will you calculate? That is nothing but your increase amount divided by new amount or original amount? Divided by original amount into 100. How much has it increased by? 0.3. How much was it originally in the last year? 2.723 into 100 you do. How much are you getting? 11.01%. I'll take it as 11%. Like this also you can calculate. You can use trial and error method, or you can find out this. Okay, any 2 years you can check. I think study material is using this approach. You can also use trial and error method also. Fine, people. Okay, that means using this we got what? Growth rate to be 11%. The moment you see growth rate, obviously to find out cost of equity, we need to use Gordon's model. That's how to figure it out. Okay, next what, sir? Company can issue 14% new debentures. Or 1 minute, hang on. Can we figure out cost of equity, all the data? How do you get cost of equity, sir? Tell me the formula. And as per the Gordon, D naught or D1 now? D1 divided by P naught minus flotation cost plus the growth rate. Flotation cost is mandatory or it could be there also. It could be there, may not be there also. That is totally depends. So do you know D1? Yeah, we only calculated D1. How much is that? 1.5115 divided by P naught. Current market price, they only given 30.25. Flotation cost not given, so we'll take it as 0. Plus growth rate, we got it to be 11%, which is 0.11. So plug in these numbers and tell me how much is cost of equity. 15.16% is your cost of equity. Okay. All right. Can I move on to the next one? The company can issue 14% new debentures and 12% new preference shares. Company ka debentures is currently selling it at 99. Okay. That means that is your market price. The new preference shares can be sold at a net price of 9.9. That means your issue price. Paying a dividend of 1.25. Company ka tax rate is 50%. So first requirement is you need to calculate after tax cost of debt to preference shares and ordinary shares. Ordinary shares is in cost of equity shares. I think that we already did. Now we need to find out what's the cost of debt. Okay. Do you see the life? Do you anywhere see the life? No, they've not given. Yes. Okay. So that means here you just do interest into 1 minus tax rate divided by net proceeds. Okay. How much is the interest to? Debentures currently trading at what value? 99. Actually I was doing no, I'm doing first we'll do I wrote preference shares. No, I'm talking about first we'll do the debt. KP I'll come to it. Okay. Now debentures what is the current market price? 99. 99 is closer to 10 or 100. 100. That means we'll take all the face value to be 100 because interest is always calculated on the face value. They've not mentioned face value, but 99 is closer to what? 100. So we'll take the face value to be 100. So what is your I here? What will be the I? I will be the interest amount. What percentage debentures are these? 14%. So 100 ka 14% is how much? 14 rupees. That is your I. Okay. So now calculate cost of debt. Interest which is 14 into 1 minus tax rate. Tax rate is 50%. Divided by net proceeds. What is the current market price of the debentures? 99. Sir, if it is new debenture, you told issue price. Yeah. Think logically. If the debentures are trading in the market at 99, company will issue it at 99. If no information, we'll assume market price and issue price to be same. Like that. So that means here, what will be your net proceeds? 99. Plug in this number and tell me what is the number? 7.07%. That is your cost of debt. Done. Alright. Next is what's our cost of preference shares. How do you get cost of preference shares? Preference dividend divided by net proceeds. How much is the preference dividend? 1.25. How much is net proceeds? 9.9. So 1.25 divided by 9.9 you do. How much are you getting? 12.62%. That is your respective instrument ka cost. That's what they've got it. Okay, Nasaru? All the three we've got. Okay, what is the next requirement they've asked? Calculate marginal cost of capital for the new funds. Okay. Alright, marginal cost of capital is nothing but your overall cost of capital only. If you are issuing new instrument, then overall cost of capital will be same or it will change. That means, is there any new format to calculate marginal cost of capital or same? Same. So how do you calculate? How many instruments here we have? 3. 3 instruments we have. Take each ka cost, multiply by each ka weight. Can we look through that fatafat? Okay, weight we have already calculated. No? Here. How much is debentures ka cost we calculated? 7.07. How much is preference shares ka cost we calculated? 12.63. Equity shares ka how much? 16%. This is the respective cost. Weightage we already calculated here. Check sir, how much is the weightage of debt? Debentures is 15%, preference shares is 5%, equity ka is 80%. So here that's what they've taken, 15%, 5% and 8%. Take instrument ka cost multiplied by instrument ka weight. So these two ka multiplication if you do, you're going to get this much. If you add everything, you're going to get 14.492. That is nothing but your overall cost of capital, but after considering new funds. Okay, now that's all the system. Can I move on to the next? Okay, what is the next question they've asked? this is important. This question is quite popular. We have done a similar question. Examination also, this question has come a lot more times. And we have also done 2-3 questions of the same thing in our regular class as well. Check. How much money can be spent for capital investment before new shares must be sold? Marginal cost of capital remains to be constant. Assume that the retained earnings available for next year's investment is 50% of 2023 ka earnings. So retained earnings means earnings distributed or kept with the company. Kept with the company. How much retained earnings they are saying? 50% of 2023 ka earnings. Come back. How much is 2023 ka earnings? 3.023. That is 2023 ka earnings. So this is the earnings per share. And how many shares does the company have? How many shares does the company have? 2 lakh shares. On 1 share, the earnings is 3.023. On 2 lakh shares, how much is the earnings? 6,04,600. That is the earnings. Entire earnings company is planning to retain or only 50%? 50%. That means what is the retained earnings? 604,600 ka 50%, which is what, sir? 3 lakh 2,300. So out of this much earnings, company is planning to retain this much with themselves. Done now? Okay. Now they are asking you again. Let me read the data. How much amount can be spent for capital investment before new shares must be sold? Now, excuse me. Can you tell me how much does the retained earnings ka weightage is? Equity shares and retained earnings ka weightage is same. How much is equity ka and retained earnings ka weightage, sir? We already calculated 80%. Yes. That means, can I write like this? Retained earnings constitutes 80% of total capital or total finance. Can I write? Don't be misled by the term capital in FM. Capital in FM means not share capital. Capital in FM means total source of finance. So can I say retained earnings contributes 80% of total finance? How much is retained earnings? 302, 300. This constitutes 80% of total. That means, can you find out what is the total finance for me? What is total finance? 3,02,300 divided by 80%, which is 0.8. How much is that, sir? 3,77,870. I think I've written that. Let me just quickly check that. Easy, I think. 3,77,875. Correct. This is your total capital or total finance, everybody. Up to this much amount, no. Obviously, you need for new project, you need fund. So if your funding requirement is 3,77,875, company need not issue any new shares. Why? Because out of this, what is the weightage again? Remind me, what is the weightage? Debt ka weightage is 15%. Preference shares ka 5%. 80% through retained earnings. So if you need a money of 3,87,850, 80% of that will come any which way through retained earnings. Do you have that much retained earnings? Very much, yes. Okay. That means out of 377,850, 3,02,300 will come through retained earnings. 15% of this. What is 377,875 ka 15%? 566,81. That much will come through new debt. Balance 5% will come through new preference shares. That means if you are planning to spend only 3,77,875, should the company issue new shares or not required? Not required. Up to this much, company need not issue any new shares. If they need even 100 rupees more than this number, then the company has to compulsorily issue new shares because retained earnings is fully exhausted. Is that okay with you? So that means this is the limit. That's what they're asking. Up to this much amount, we don't need any new shares. Same question is there in our regular class also. Study material also, it is the same question is there. Question number 22, she's saying. Yeah, okay, great. Awesome. Next requirement. I hope this is clear for everybody. Okay, next is what, sir? Check this. What will be the marginal cost of capital? Cost of fund raised check this number. Cost of fund raised in excess of the amount calculated in part 3. They're saying now what up to which amount new shares are not required? 377,875. Now they are saying assume that the new project requires fund lesser than this or higher than this. Higher than this. Let's say we need 5 lakh rupees for a project. That means now can we make do with existing instrument or we have to issue new shares? We have to issue new shares. Okay, that's what they're saying over here. Cost of fund raised in excess amount calculated in part 3 if the company can sell new share at 22%. Now they are issuing the new share at 22 rupees. Okay, now you tell me, sir, if the issue price initially check what is the current market price. When you calculated cost of equity, how much did you take as current market price? 30.25. Now, are you issuing it at 30.25 or different number? You are issuing now at what value? You are issuing it at what value? 22. Will the cost of equity be same or will it change? Change. So calculate revised cost of equity. How do you get the revised cost of equity? What is the formula again? D1 divided by P naught. Flotation cost is not there, so leave that. Plus the growth rate. How much is D1? Expected dividend, we already got it. How much is that? 1.5115 divided by, you are issuing new shares. So what is the issue price? 22 plus growth rate, we got it to be 11%. So what will be your cost of equity? 7.62%. Yeah, that is what they must have got it. So the cost of new preference shares is 7 or 17? 17. Okay, 17.87 is what they are saying. You also got the same number. So that is the number. Is that fine? Now, when you calculated overall cost of capital initially, your cost of equity was how much? 16%. Now, when you're issuing new shares, cost of equity is 16 or it changed? Changed. That means overall cost of capital will be same or again it will get changed? Again it will be changed. That means again you need to put up this table. Weight, will it change or same? Same weightage. Okay. What about debentures and preference shares? Will that be changed? No, that is the same thing. Only cost of new preferences, new equity shares is how much? 17.87. Take the respective weights, multiply by the respective instrument cost, you will get the overall cost of capital. This only we are calling it as marginal cost of capital. Why are we calling it as marginal cost of capital? Because overall cost of capital is changing. Why? Because you are issuing some new instrument. That's all is the overall funda. So the whole crux of this third adjustment is retained earnings contributes 80% of total capital. That's what, if you are able to underline or remember that one line, whole question is solved. Is it necessary in every problem it has to be 80%? No. In this problem, the weightage of retained earnings was 80%. So we kept that. Problem to problem, that could vary. Yes, Asaru? Okay. Another interesting question was asked in one of the MTP question. We'll quickly run that question. What happened? Huh? You couldn't solve this question. Huh? Oh, yeah. Then I also cannot solve. We'll skip. She's saying it's difficult. We'll not require. Right? Okay. RAM Limited evaluates. So normally RTP MTP question sometimes will be little tricky. Usually RTP questions are a lot trickier than study material questions. Okay. And your examination also do expect 2 or 3 tricky questions to always come. It will come every attempt. So don't freak out because of that. Okay. Alright. First time when you look at it, it will be like little bhari. Later once you solve it, once you get the funda of it, it will be little easier. So let's run through one such question here. RAM evaluates its capital project using one check here. RAM Limited evaluates all of its capital project using discount rate of 16%. It is not one project, it is all. All means they're talking about overall. So what is this 16%? Overall cost of capital is 16%. That's the first thing they have given in the problem. That means in this problem, you don't have to calculate KO. You have to calculate something else. So let's see. Its capital structure consists of equity shares, retained earnings, bank term loan and debentures. And these are what debentures? Redeemable debentures. That means can you take, which formula you have to take? Obviously, you have to take RV wala formula there. Rate of interest on bank loan is 1.4 times of that of debenture. So if debenture ka interest rate is 10% means bank loan ka interest will be 10% into 1.4 which will be 14%. That's what they are saying. Okay, if your debt ka debentures ka interest rate is 1 means this loan ka interest rate will be 1.4x. That's what they've told. Remaining tenure of debenture and bank loan is 4 years and 6 years respectively. Book value of equity share capital, retained earnings and bank loan is 20 lakh, 30 lakh and 20 lakh respectively. That means if they're given book value, you have to calculate overall cost of capital using book value weights. If they've given market value, we will use market value. Here they have given book value, so we will stick to book value. Debentures are having a book value of 30 lakh and currently trading at 98. Currently trading at 98 means this is your current market price. Okay. The ongoing P multiple, the moment you read P multiple is 4. What are they indirectly telling you? If P is 4, can you find out cost of equity? Yes. How do you find out cost of equity? 1 divided by P ratio. How much is P ratio? 4. So 1 divided by 4 is how much, sir? 0.25, which is nothing but 25%. So that means a cost of equity is one-liner solution. Okay. So that's where you need to be smart. Okay. Even if this whole question was bounced to you, let's say it came for 5 marks. I don't think so it can come for more than 5 marks. It looks bari, but it is a very simple question. Okay. It can come for maximum 5 marks. Even if you calculate this, Instead of getting 0, you got 1. I will take 1 over 0 any day. Even half a mark, I will take it any day over 0. So when you look at the question, even if you don't know, just don't blindly ignore it. There will be some part of question you will be able to solve. Okay, little, that's what they say, no, honey honey seri sagar. Okay, boond boond se ocean banta hai, something they say. Yeah, like that. So even if you get even one working note right, 1 or 2 marks you will get, that is good enough ultimately for you to clear that particular paper and whole group. Okay, so now let's go over this. So don't skip the question. Just because you read 2-3 lines new, entirely don't skip off that question. Maybe now what you do, if you find anything is new, no, don't attempt it now. First do all the question which you are comfortable. Last when you will have 10-15 minutes extra, no, that time come back to this question. Keep your mind cool, read it. At least 1 or 2 working notes will definitely be easy, even in the trickiest of trickiest question. At least 1 marks to pakka you can score in those. Okay, whatever possible, write that. Don't accept 0 by any, in no matter what. Write something. You have capability. Believe in yourself. You are creative people. Okay, something will nikal ke aayega. Okay, like that. Okay, be like that. So now let's see what they're asking. Calculate the rate of interest on bank loan. Calculate rate of interest on debentures. Tax rate is 30%. This is not actually a FM concept. This is more like solving mathematical question. This is maths. They brought maths into this drama. Because sir, if they give you interest rate, aram se we can calculate cost of debt. Because every data is given. Alright, but the only main drama over here is interest rate is missing. If you don't know interest rate, you cannot calculate interest amount. If you cannot calculate interest amount, cost of your debentures as well as cost of bank loan, you cannot find. That is the crux over here. So what you simply have to do is, it's a very simple thing. Just quickly, I'll take you through. Pay attention to this. Assume the rate of interest rate on debentures to be X. If you don't like X, any other variable also fine. Okay, I'll. Alright, rate of interest on debenture, we'll take it as X. Okay. Now, sir, let's say face value of the debenture is 100. If the interest rate is 7%, can you tell me what is the interest amount? How did you calculate? 100 ka 7%, which is 7 rupees, correct? Now, face value is still 100. I've assumed interest rate to be X percentage. I've assumed it to be X percentage. Can you tell me how much is the interest amount now? 100x. X is not the amount. X is the percentage. Is that okay? That means how much is the interest amount now? 100x. All of you comfortable? I don't know the value, but I know it in variable. What is the variable? 100x. Got it? That's all. You have to substitute this and go on doing. So how much is interest, sir? 100x. Got it? We'll come to the loan a little later. First, we'll do off the debentures. What is the interest amount on your debenture? 100x. X is not the amount. What I've assumed X is, let the rate of interest, meaning the percentage of interest, be X. We take the face value, multiply by interest rate, then only we will get interest amount. Okay. So when the interest rate was 7%, how did you get the interest amount? 100 ka 7%. Hence it is 7. Similarly, if this is X percent, interest amount will be 100x. Easy. So now you got the interest amount. Tell me the formula for redeemable debentures again. Interest here, not I here stands for not interest rate. I here stands for interest amount. So retrace that formula once again for me. Interest into 1 minus tax rate plus RV minus NP divided by N. Whole thing divided by RV plus NP divided by 2. Okay, how much is the interest amount you got? 100x. What is the tax rate? They only told. Somewhere we saw, no? Tax rate is 30%. That is here 1.3 plus RV. If they don't tell anything. Okay, what is the currently debentures trading at what, sir? 98. 98 is closer to 10 rupees or 100 rupees. That means what will you assume? Face value is to be? Face value is 100. If you don't tell anything, we always assume that it is redeemed at par. It is redeemed at par. What is the par value? 100. So redemption value is 100. Minus NP. Currently, what is the debenture trading at? 98. That means net proceeds will become 98. Understood? What is the term of this debenture? They told. The remaining term of the debenture is only 4 years. So divided by N, which is 4 years. Substitute. You will get the answer fully or you will get it in variable. When you solve this question, you will get the answer to be cost of debt. You will get it as 70x plus 95 divided by 99. Is that okay? Comfortable, everybody? Okay, this is your cost of debt. Done. We have one debt here or two debts? Two debts. We have bank loan also. Now, what did they say for bank loan? rate of interest in bank loan is 1.5-4 times. 1.5-4 times of debenture. So debenture interest, I've assumed it as what? X. X is the amount or rate? If debenture interest rate is X% means the rate of interest on loan will be 1.4 times of that. That means this will be 1.4x. Easy. 1.4x. So debentures you can redeem it at par, below premium, below face value. Now, if you have taken 1 lakh principal from bank, how much you will repay? 1 lakh only. That means RV and NP for bank loan will be same. Because net proceeds means how much bank will give you, how much principal bank will give you? 1 lakh. How much principal you will give it to the bank? 1 lakh. That means RV is also 1 lakh. NP is also 1 lakh. What did I say? When RV is equal to NP, should we have to do whole drama or shortcut method? Shortcut method. How do we go for shortcut method? Interest rate, not interest amount. Interest rate into 1 minus tax rate. Correct? That gives you your cost of debt. Interest rate into 1 minus tax rate. How much is the interest rate here? 1.4x. Correct? 1.4x into 1 minus tax rate. When you solve this equation, you're going to get 0.98x. This is cost on bank loan. Easy, everybody? Comfortable? Cost of equity we know now. Cost of equity we know already. Cost of debt on debentures also we got it, but in amount or in variables? Variable. Cost on bank loan also we got it in variable. The crux here is, how do you find out weighted average cost of capital? Take that instrument ka cost multiplied by the weight. Yes, no. So what is first weight? We will plug in all these numbers. We have how many sources of finance? 4. Equity, retained earnings, debentures and bank loan. All the amount they've only given. Okay, all these numbers, data given in the question. Find out the weights for this. Out of 1 crore, 20 lakh through equity shares. So the weightage is 20%, 30%, 30%, 20%. Correct? Respective instrument ka cost, do you know? Yes, there is no flotation cost. So cost of equity and cost of retained earnings will be same. How much did you get as cost of equity, sir? Cost of equity, how much did you get it as? 25%. So both ka will be 25% only. What about these two instrument ka cost? You got it in interest rate or you got it in variable? You got it in variable. What is the cost of debenture? 70x plus is 0.5 divided by 99. Plug in the same number. What is the bank loan ka cost? You got 0.98x. Plug in the same number and do the same step. How do you calculate weighted average cost of capital? That instrument ka cost multiplied by that instrument ka weight. These two you multiply. You will get this much. Comfortable? Just pure multiplication. That's fine. That much maths you can manage, I believe, no? Just take this and multiply by the respective weights. If you sum it up, finally you will get this numbers. Add everything. All this if you want. Maybe this. These two addition you do. These two addition you do. How much is it? These are numbers. No, these two addition you do. Fadafat. 0.8 plus 0.15. One more number is there. Add that. Or let that be there. Is it okay if I mean, just addition is okay? I mean, it's simple. 0.05 plus 0.075 plus 21x plus 0.15 divided by 99 plus 0.19x. Is that okay? So how do you add up this now? Only this as 99, no? So what you can do? Multiply 99 to everything. Or finally, first add this maybe. Then we will figure it out. Add these two are numbers. Now add it. How much are you getting? 0. Or this also you add. This is another number. How much is that? Add. Or you can multiply totally and also get it. That's also absolutely fine. How much are you getting? 0. I think they've solved it. They've kept it slightly differently, I think. That's okay, I believe. Okay, or I just keep it here. That's fine. This is the number you have got. No, these two you add. How much are you getting? Tell me that maybe. 0.12. These two addition is 0.125. Oh, okay. I think that's what they have done. Okay. Mathematical, sir. You can solve it multiple ways. That's fine. So plus 21x plus 0.15 divided by 99 plus 0.196. What is this? This addition only we used to call it as overall cost of capital. In this problem, overall cost of capital is missing or given. Given in the question only they told it as 16%. That means this equates to 16%, which is nothing but 0.16. Now we have to solve this equation to get x. That's all it is. How do you do it? 99 is common, no? Multiply everything through 99. These two, this ka 99 you multiply, sir. 0.125 ka 99 you multiply. 12.375. Okay. 21.x. This is anyway I added number only, so that's fine. So leave that as it is. Plus 0.196 into 95. 99 rather. I think they've already done that. Okay. I hope that you're getting same number. Okay. Tell me. 90.4, 19, 19.404x. This also you multiply 0.16 into 99. How much is that? 15.84. From here, can you take it as a? That's all. You need to solve that equation and simply get the x. When you solve this, you're going to get the x to be 8.20. What is that x? What did we assume x as? Interest rate on debentures. So debentures ka interest rate will be 8.20. That means if debenture ka interest rate is 8.20, means bank ka interest will be 1.4 times of that. So 8.2 into 1.4 you do. How much you're going to get? 11.4. Very, very simple question. Just that mathematically they try to confuse you with some x, y and all. So the only crux, again, if I have to summarize this question, go through this question once. Easily can be asked for 5 marks. Not difficult at all. But first time when you're reading, it looks a little complex. Only thing what you do have to hear is assume one interest rate to be x percentage. If debenture ka interest rate is x%, then bank ka interest rate will be 1.4 times of that. And then simply calculate marginal cost of capital or simply calculate overall cost of capital. You will get it in value or you will get it in x. You will get it in x. Overall cost of capital is already given to be 16%. So equate that equation to 16%. You will get x to be whatever value. That's all. Is a simple question about this. This came, I think, in this particular attempt ka MTP, if I'm not wrong. Okay, Saru. All right. Maybe this question was added to that new study material also. I'm not very sure. Anyways, okay overall. Okay, so this is one thing. Yeah. So I think this is good enough. So with this cost of capital ka chapter, we have fully completed. Thank you. Okay, can we take up the next chapter, people? Okay. The next one is capital structure. The next chapter is capital structure. What is the overall funda of capital structure is? So in the previous topic, we already learned that each source of finance has a cost. In this chapter or topic, what we're trying to do is from which source of finance we should raise the money. From what source of finance we should raise the money so that the value of the firm is maximized. From what source of finance, if you raise the money through equity shares or through debt or 50-50% combo or 80%-20% combo, in what combination should we raise the money so that the value of the firm should be maximized? That's all is the overall topic or funda behind this particular chapter. Here you have to remember only 4 or 5 maximum formulas. 1. Value of the firm is given by the formula EBIT divided by overall cost of capital. Value of the firm is given by EBIT divided by overall cost of capital, which is denoted by the symbol KO. So basically EBIT divided by KO. That's one. Okay. Or value of the firm can also find out through another way. Normally in the firms, no sir, they will either go for equity shares plan or debt plan. Hence market value of the firm is given by S plus D. Market value of the firm is given by S plus D. S as in market value of equity. D as in market value of debt. Okay. If you want to know what is this formula all about, it's quite simple. Let's say company wants to raise 1 crore. Company wants to raise 1 crore. Sir, if you want to raise 1 crore means we'll have a return percentage. Now we will utilize the money for that purpose. And if you are utilizing the money for some purpose means we'll have a return percentage. Let's say company wants to earn on this 1 crore, they want to earn 10% return. That means what is the return amount? 10. Now, if I give you the return amount, if I give you a return percentage, can you find out value for me? If I give you these two, can you find out value for me? Rephrase the equation for me. How do you get value? Return amount divided by return percentage. Correct? So basically return amount divided by return percentage. Yes. EBIT, that return amount only we're calling it as EBIT. Return percentage only we're calling it as KO. Because for an investor, it is a return. For a company, it is a cost. That's a relationship. So basically return amount divided by return percentage. That only we're calling it as EBIT divided by overall cost of capital as in KO. Okay, this is one. Then we can also find out, I told value of the firm, you can also find out through another way, that is S plus D. S stands for market value of equity. D stands for market value of debt. Market value of the debt will be usually given to you in the question. Market value of equity denoted by the symbol S also you can find out through another way. How did you find out value of the firm? EBIT. Is EBIT available for equity shareholders? No. What is the order? Tell me. From EBIT, first you have to deduct interest. From that you will get EBT. From this deduct tax. You will get earnings after tax. From this you have to deduct preference dividend. Then only you will get earnings attributable to equity shareholders, or we used to call this as also net income. Yes, no. This belongs to equity shareholders. That means you have to resubstitute your formula. Instead of EBIT in the numerator, what will you take? Ish in the numerator. There, my value of the firm, what was the denominator? KO. Are we calculating overall cost of capital or market value of equity? That means instead of KO, what will be in the denominator? E, as in cost of equity. So market value of equity is given by the formula E divided by cost of equity. That's all. Okay. So most of the questions will play around these two formulas. Okay. If something is this is one type of question that gets popularly asked from this particular topic. Okay. That's one. We'll take up the question. Same way, the way we revised last topic, this also same fashion. We'll run through everything once, then apply it in few questions to remember the formulas and things a little better. Fine with you? Okay. Next. Sir, under this particular chapter, no, there are some relevance and irrelevance theory. Relevance theory, what they argue is debt is important. They say debt is important. If you go for more and more debt, value of the firm will increase because they say debt is cheaper. Debt is cheaper. Think logically. Excuse me. Company wants 10 lakh rupees. They want to raise this money through debentures. What interest they will give to the debenture holders? Maybe let's say 10% on average. Let's assume that the company wants to give interest at the rate of 10%. Now, let's say company wants to raise this 10 lakh by issuing equity shares. To the equity shareholders, can you give the same 10% return? Will the equity shareholders agree for it, or they will want a lot more? They will not accept for 10%. They will want higher. Why? Because, sir, debenture holders, they take risk or less risk. Debenture holders take less risk. Because what will the debenture holders tell the company? Every month or every year, you have to pay me interest. Whether you earn profit or whether you make loss, my interest, my interest, you have to pay. Correct or not? But what will equity shareholder Papa tell? If you make profit, give me dividend. Otherwise, okay. Yes, no. That means equity shareholders takes a lot of risk. So he will not settle for 10%. He will expect a higher return. Is that okay with you, everyone? All right. That is what traditional theory says. Okay. Or relevance theory says. If you take more and more debt, debt is cheaper. When compared to equity, debt is cheaper. So because the debt is cheaper, your overall cost will come down. So because of debt, your overall cost of capital will reduce. If your overall cost of capital reduces, your value will increase. Between your overall cost of capital and value, there is an ulta relationship, as an inverse relationship. Meaning if overall cost of capital reduces means value will increase. If overall cost of capital increases means value will reduce. If you want, I can figure it out through one small number. How do you get value of the firm? EBIT divided by KO. Let's say EBIT is 1 lakh. Overall cost of capital is 10%. How do you find out value? 1 lakh divided by 10%, which is 10 lakh. Correct? Let's make this overall cost of capital, instead of 10, let's take it as 8%. Instead of 10%, let's make it as 8%. Let's find out. That means overall cost of capital, what did I do? I reduced. So that means EBIT is same, 1 lakh. 1 lakh now divided by what? 0.08. If you multiply, if you divide, what are you getting? 12 lakh 50,000. What was previous value? 10 lakh. That means when overall cost of capital reduced, value of the firm increased. That's the reason I said overall cost of capital and value have inverse relationship with each other. So that's what first relevance theory argues. Take as much debt as possible, because the more and more debt you take, overall cost of capital will reduce, which will increase the value of the, which will make the value of the firm to increase more and more. That is the first theory. Yes, sir. Okay. And same relevance theory, one more is there, that is traditional approach. What traditional approach says is, yes, we acknowledge that cost of debt is cheaper. Debt is cheaper when compared to equity. Because it is cheaper, you should not take the debt left, right, center. Just because it is cheaper, don't take the debt left, right, center. Use equity and debt judiciously, or use debt judiciously. So what this traditional approach says is, debt will be cheaper only up to a certain point of time. Debt will only be cheaper up to certain point of time. Like let's say, first you took 1 crore loan from bank at 10%. After that, if you want one more lower loan, means will bank give you at 10%, or they will start charging higher? They'll start charging higher. That means up to a certain level only debt will be cheaper. If you borrow more and more, cost of debt also will increase. So that's the reason this approach says use a debt judiciously. Not that important, quickly running through. Okay. All right. Next is irrelevance theory. It's like our classes. They are saying it is not at all relevant. You know what their irrelevance theory argues? You use debt, you don't use debt. Value will not be affected, meaning value will be same. Whether you use debt, you use less debt, you use more debt, you use no debt, doesn't matter, value will be same. Meaning debt has no impact on the value of the firm. That is your irrelevance theory. And the first person, our great Guruji who was given irrelevance theory is approach. Modi Giuliani Miller approach. A lot of hawa going on for Modi, no? Yeah, this approach. Okay. All right. First, we'll run through this approach. What does Modi Giuliani Miller approach says is the value of the levered firm. If there is no tax world, if there is no tax, if you live in a world where there is no tax, maybe Mauritius or Dubai, Middle East probably. I think in Middle East now they've started charging taxes. What I heard. No, not that. Okay, no worries. At least not relevant to us, India. No? India, we're paying left, right, center tax. Yes, no, full tax for us. So what approach says is, if you live in a country where there is no tax rate, or if you live in a no tax world, then the value of the levered firm and value of unlevered firm will be same. So what is this levered firm? Levered firm means that firm which is using debt. Unlevered firm means that firm which is not using debt. If there is no tax world, this is important. Some question may directly they'll establish the connection of this. Do remember, if there is no tax, then the value of the levered firm and value of unlevered firm will be same. So, however, if there is a tax, then the value of the levered firm is given by value of unlevered firm plus the tax benefit. Because levered firm means what? They're using debt. Debt means they've issued debentures. On debentures, they have to pay interest. On interest, they will get a tax benefit. So, if you have tax means, how do you get value of levered firm? Take the value of unlevered firm. To that, you add tax advantage or tax benefit. Okay, how do you get tax advantage? Simply take the debt value multiplied by the tax rate. Okay, because I know that you get the tax benefit only on interest, but interest you will pay only once or full. Or let's say the debenture term is 10 years. I mean, will you pay the interest only for 1 year or 10 years? 10 years. That's the reason instead of taking interest amount, they have taken the whole debt amount here. Okay, like that. So tax advantage is simply debt amount multiplied by the tax rate. So if the value is not same, what to do? If value is not same, you can do something called arbitrage. You can move around. If you're currently holding shares in levered firm, you can sell that and buy unlevered firm. This one RTP may they've asked arbitrage question. I'll take you through that. Is that fine with you? Sometimes it comes. Arbitrage is not a common question from this topic, but once in a while, pratyaksha can happen there. Okay, we don't. Yeah. All right. So this is about irrelevance theory. Done. Okay. So another point is the more common or the more important ones from this topic is financial break-even point, or for class purpose we used to call it as FBP. What does financial break-even? What does first of all break-even point means? No profit, no loss. So financial break-even point means what should be your EBIT. Financial break-even point means what should be your EBIT so that EPS becomes 0. EPS becomes 0. If it is more than 0, you are earning something. If it is less than 0, you are losing something. Break-even point means no earning also, no loss also. Basically, financial break-even point means EPS should be 0. That we are trying to calculate what should be the EBIT so that your final number of EPS becomes 0. All right. So we have financial break-even point for 3 components. One for equity shares, another for preference shares, and for debt. For equity shares, financial break-even point is what? 0. Meaning only if EBIT is 0, only then EPS will become 0. I proved each one with a numerical with some data in the regular class. For maybe in the interest of time, only this portion I will take you through here. So what does financial break-even point for equity shares? EBIT should be 0. Only if EBIT is 0, then only EPS will become 0. Let's assume that EBIT is 100. You have equity plan, that EBIT is 100. If it is only equity plan means will interest come up? No. That means what is EBT? 100. Let's say tax rate is 30%. 100 ka 30% is how much? 30 rupees. What is earnings after tax? 70. If it is only equity plan means preference dividend will come? No. So what is ish? 70. Number of equity shares assumed to be 100. Tell me how much EPS you got. 0.7. Financial break-even point means EPS should be 0. Did you get EPS to be 0 or something else? something else. That means if you have equity plan, if you have only equity plan, then only if EBIT is 0, then only EPS will become 0. Under no other circumstance it will happen. That's one. Second, if you have a debt plan, if you have a debt plan, if EBIT is equal to interest charges, only if EBIT is equal to interest charges, only then EPS will become 0. And under no other circumstance. I proved it to you. This one I will not take time. Is that okay? Only if EBIT is equal to interest charges. Make common sense. Let's say EBIT is 1 lakh. Interest is also 1 lakh. That means obviously what is EBIT? 0. If this is 0 means all the numbers below that also is 0. That's a funda. So EBIT should be equal to what? Interest charges for only what plan? Debt plan. Only debt plan if you have. Next is preference shares plan. If you have preference shares plan, then how will EPS become 0? For EPS to become 0, EBIT should be equal to one formula as well. Preference dividend divided by 1 minus tax rate. You can do it, okay, normal way also, but instead of hunting for it, you can just remember the formula, which is what? EBIT is nothing but preference dividend divided by 1 minus tax rate. Let's prove it just to be on the safer side. So let's say preference dividend is 70,000. Company wants to pay a preference dividend of 70,000. What does our financial break-even point say? How do you get EBIT? Preference dividend divided by 1 minus tax rate. Preference dividend, I have assumed it to be 70,000. Tax rate, I have assumed it to be 30%. So calculate 70,000 divided by 1 minus 0.3. If you calculate, it will be how much? 1 lakh. What is this? EBIT. So EBIT is how much, sir? 1 lakh. Minus interest. Sir, it's only preference share plan. So interest will come, no. What is earnings before tax? 1 lakh. Minus tax. What is the tax? 1 lakh ka 30% is how much? 30,000. What is earnings after tax? 70. Minus preference dividend you do. What is 50,000? Or what is preference dividend we assume? 70. So what is ESH? 0. That means what is EPS? 0. Isn't the numbers working out? Yeah. So that's it. Quickly. Instead of breaking your head, aram se, if you can just in one line, you can get the answer. For preference shares, it is nothing but preference dividend divided by 1 minus tax rate. So suppose you have everything, means what to do? Company has equity shares also. They have debentures also. They have preference shares. What is FBP for that? For if you have everything, means all the things you need to add. For equity shares, what is the plan? Anything to be added or it is 0? Leave that out. If you have debt, then interest charges. That means if you have all the 3 plan, means EBIT should be equal to interest charges plus preference dividend divided by 1 minus tax rate. Not popularly asked. I think once or twice in the last, I think for 7-8 years back, once this had come. They had given multiple plans and they'd ask you what is overall break-even point. So this you need to do. Usually they will ask financial break-even point for instrument separately. They'll not collate and ask, but if they collate also, are you comfortable? Okay, that is your financial break-even point. Next most important aspect from this topic is indifference point. Name itself is saying indifference. Meaning, let's say you want 10 lakh rupees funds. You have 2 options. 50% of this fund you can raise through equity, other 50% through debt. There is another option, 80% through equity, 20% through debt. What indifference point analysis is trying to do is whether you go for option number 1 or whether you go for option number 2. Both options will give you same EPS. What should be your EBIT so that both the option gives you same EPS? That is what indifference point is trying to calculate. Okay. What should be your EBIT so that both the option give you same EPS? It is given by the fancy formula. How do you get indifference point? EBIT minus I1 into 1 minus tax rate minus preference dividend divided by E1. It should be equal to EBIT minus I2 into 1 minus tax rate minus preference dividend, if any, divided by E2. Equate this. Fancy formula. Is it really fancy? No. This is just what? EPS ka formula. Because what does indifference point mean? Both the option ka EPS should be same. How do you get EPS? How do you get earnings per share? Earnings attributable to equity shareholders, which is nothing but ESH divided by number of equity shares. It is weighted average number of equity shares, but that is AS20 ka funda. Don't bring it in here. Here we'll use total number of equity shares. Fine, now people? Okay. Now let's analyze this formula once again. From EBIT, sir, I1 means interest under option number. Here we have 1 option or 2 options. So I1 means interest under option number 1. From EBIT, if you deduct interest, what are you going to get? You're going to get EBT. We want EBT for EPS calculation or we want ESH? Right now, where are we? EBT. But from here, if you want, you can directly dive into earnings after tax. From EBT, you can directly dive into earnings after tax. How? Just simply do 1 minus tax rate. If you do this, you're going to get earnings before tax. From earnings before tax, if you want to dive into earnings after tax, you simply do 1 minus tax rate. Not a formula, just quickly just check. If earnings before tax is 100, tax rate is 30%. How much will be tax amount? 30. What is earnings after tax? 70. Another way is what? Takes earnings before tax into 1 minus tax rate you do. How much is earnings before tax? 100. Into 1 minus tax rate you do. How much are you getting? 70. That means from here you can jump to here just by one formula, that is multiplying what? 1 minus tax rate. So you multiply 1 minus tax rate to get where, or to go where, to reach where? Earnings after tax. Is that okay? Do we need earnings after tax for EPS calculation or ish? Ish. From earnings after tax, what do we do? Deduct preference dividend. That's what we have done. Fancy formula, but just to what, sir? Just expressed as what? I mean, just it's a EPS formula expressed from here to here. From EBIT, they are trying to express, or they go to ish. That's all. It's just fancy formula. Okay, now everyone. So what is this formula again? EBIT minus I1 into 1 minus tax rate minus preference dividend. So if you do this, you're going to get ish. But we want EPS. So that means you have to divide something. What will you divide? Number of equity shares. That is nothing but your E1. E1 stands for number of equity shares under plan number 1. What is indifference point trying to calculate? Both option having same EPS. That means this is EPS under option number 1. This should be equated with EPS under option number 2. So now we have to find out EPS under option number 2. So what will be the same formula? EBIT minus I2. I2 means interest under option number 2 into 1 minus tax rate minus preference dividend divided by E2. E2 as in number of equity shares under option number 2. Equate that. Every number here will be given except EBIT. EBIT will be missing. So solve this equation. You will get EBIT as a balancing figure. That is indifference point ka EBIT. So at indifference point, your both the option will give you same EPS. Okay, na sir? And there is no indifference point for debt plan and preference shares plan. Between debt plan and preference shares plan, there is no indifference point because debt plan will always dominate preference shares plan. Debt will always dominate. Like let's say cost of preference shares is 10%. Cost of debt is also 10%, or maybe I'll just say like this, not like this. Let's say preference dividend you are paying at the rate of 10%. Interest also you are giving at the rate of 10%. That means both will have same cost. No. Preference shares ka cost may be 10% only because on preference shares you don't get tax benefit. On debentures, though you might be paying 10% interest rate, you will have some savings in the form of tax. So cost of debt will not be 10%. It may be lesser, maybe 8, maybe 7, whatever, depending on the tax rate. Correct? That means debt plan will always have one advantage over preference shares plan, which is what? Tax benefit. That means a debt plan will, if you're comparing debt with preference shares, debt will always give you higher EPS. The reason being, it has a tax advantage. That is what they're trying to say here. There is no indifference point between only equity shares, only debt plan and only preference shares plan. Other plans you could have, between these two plans, you cannot have indifference point because debt plan will always dominate preference shares ka plan. Yes, Saru? Yeah, this is about the overall quick theory around this particular topic. 2 minutes mein, fatafat again, once again we'll revise. Capital structure is the point. What is the overview of capital structure? What we are trying to do is we are trying to find out optimum capital structure, meaning from what source of finance we should pick the money so that the value of the firm is maximized. So how do you get value of the firm? V is equal to EBIT divided by KO. That is one. Or value of the firm denoted by the symbol V is equal to S plus D. S is in market value of equity, D as in market value of debt. How do you find out market value of equity denoted by the symbol S? Simply instead of EBIT substitute ish. Instead of denominator KO substitute with cost of equity. That's all. Okay now. Then we have some relevance and irrelevance theory. Under irrelevance theory, one of the most important one is your approach. So as per approach, if there is no tax, then the value of the levered firm and unlevered firm should be same. Levered firm means that particular entity which has issued debt. Unlevered firm means that entity which has not issued any debt. If there is no tax, both the firm ka value should be same. However, if there is a tax, then the firm which has issued debt, they will get tax advantage. So how do you get value of the levered firm? Take the value of unlevered firm and add the tax advantage. How do you get tax advantage? Total debt multiplied by the tax rate. You do it, we'll get the tax advantage. Okay. If the value is not same, then you can do something called arbitrage. We'll learn it through one question here. Okay. Then we learned financial break-even point. Break-even point means what should be your EBIT so that your EPS becomes 0. What is financial break-even point for equity shares? Only if your EBIT is 0, then only EPS will become 0. For debt plan, only debt plan, EBIT should be equal to interest charges. Only then EPS will become 0. If you have only preference shares plan, then EBIT should be equal to preference dividend divided by 1 minus tax rate. Only then EPS will become 0. If you have multiple plan means add all financial break-even points. That's one. Then we looked at indifference point. Indifference point means if you have multiple options, doesn't matter whether you go for option number 1 or option number 2, you will get same EPS. So you'll have to simply calculate EPS as one fancy formula. EBIT minus I1 into 1 minus tax rate minus preference dividend divided by E1 is equal to EBIT minus I2 into 1 minus tax rate minus preference dividend divided by E2. Always check in majority of the question, preference dividend will not be given. But when you write formula, always deduct preference dividend, because if it is there, it will get captured. That is one. Okay. Anything else, or that's about it? I think that's all we discussed. So let's run through quick questions. First, maybe we'll go through this MTP question. Capital structure in market value terms of companies given below. Market value of debt is how much? 50%. Market value of equity, 50%. They only told, because this is in what? Book value terms or market value terms? Market value terms. Great. Okay, just 1 second. Sir, if market value, if I give the total, if the value of the firm is 10 lakh, assumption, if the value of the firm is 10 lakh, can you tell me what is market value of equity? Obviously, market value of debt is 50%, market value of equity is 50%. If the total value of the firm is 10 lakh means market value of equity will be 50% of that, which is 5. Market value of debt will be another 10 lakh of 50%, which is 5 lakh. Is it so over here, or I have assumed? I've just assumed it. Is that okay? Okay, keep that in mind. Go forward. The following borrowing rate, the borrowing rate for the company is 10%. In a no tax world, sir, if there is no tax means, as per approach, value of both the firms should be same. Capital markets are assumed to be perfect. Okay. If Mr. R, one investor, if he owns 8% equity shares of company, this particular company ka 8% shares is held by this particular individual. Determine the return if company has a net operating income. Operating income means EBIT. Operating income ka another name is EBIT. How much is EBIT? 10 lakh. And overall capitalization rate, stop there. Overall rate means what, sir? KE, KD, KR or KO? KO is given to be what, sir? 20%. The moment you see EBIT and KO, using this, what you can find out? Value of the firm. How do you get value of the firm? EBIT divided by KO. How much is EBIT? 10 lakh. How much is overall cost of capital? 20%. So what is overall value? 50 lakhs. Okay, that means value of the firm is 50 lakh. Got it, sir? If the value of the firm is 50 lakh, can you find out market value of equity and debt? Yeah, market value of equity is 50%. Market value of debt is 50%. Total value is 50 lakh. 50 lakh of 50% is how much? 25 lakh. 25 lakh is market value of equity. 25 lakh is market value of debt. Easy. Now, did they ask you market value of equity and debt, or they asked you investor ka return? They asked you investor ka return. How much percentage equity shares he owns? 8%. So can you multiply 8% of operating income? Does operating income belong to equity shareholders or ish? Does operating income belong to equity shareholders or ish? Ish. That means what we have to do first? Find out ish. From EBIT, how can you find out ish, sir? From EBIT, first, how much is EBIT? 10 lakh. From that, first deduct interest. Do you know the market value of debt? Yes. How much is that? 25 lakh. Do you know on this debt how much interest you are paying? Yeah, they only told the borrowing rate of the company is 10%. Yes, sir. And there is no tax rate. That means cost of debt is 10% only. What is market value of debt? 25 lakh. So 25 lakh into 10% interest rate gives you how much, sir? 2.5 lakh. That is your interest. From EBIT, if you deduct interest, what are you going to get? Earnings before tax. Is there tax here? No. So that means earnings before tax and earnings after tax will be same. Is there preference dividend in this, preference shares in this problem? No. That means earnings after tax in each also will be same. How much is each? 7,50,000. Each belongs to whom? Equity shareholders. Did they ask you entire equity shareholders ka return or one? One shareholder, this particular Mr. R, how much he owns? 8%. If he owns 8%, means 8% of each belongs to him. How much is each of the company? 7.5 lakh. 7.5 lakh ka 8% you do. How much is that? 60,000. So return for this particular vendor or R is 60,000. Any problem? No. Next, what did they ask? Calculate the implied rate of return on equity. Implied rate of return on equity is nothing but your cost of equity. That's all. Okay. Simple. Whenever they give you in this problem, no, the whole drama will be around two formulas. Two formulas. One is equal to value of the firm is EBIT divided by KO. That is one. So whenever you're getting stuck, no people, sometimes it could happen, especially in this topic, leverage topic and ratio analysis. No, you may get stuck. Whenever you get stuck, okay, especially in these topic, in this topic, whatever formula you know, first you write. Just jot down baju mein, so you will get some idea. Now here you want to find out what did they ask you? Cost of equity. Okay. Now don't run your mind through everything. So dividend approach, garden approach, bed, not required. What are they giving you here? Value of the firm. In value of the firm, there is also one more way to get market value of equity. That only we call it as S. How do you get S? Instead of EBIT, it will be ish. Instead of KO, it will be E. Correct? If you know S, if you know ish, can't you find out K? Yes. Therefore, you tell me what is the formula to get K? Ish divided by S. Do you know ish? Yeah, just now we found out. Ish is 7.5 lakh. Ish is 7.5 lakh. Market value of equity also we found out, which is 25 lakh. Somewhere we got it here, no? Now, market value of equity is how much? 25 lakhs. So this is 7.5 lakh. This is 25 lakh. Means how much is cost of equity? 30%. That's all. Okay. This also can come very easily for 5 marks. Doubt or easy? Move on to the next. Working. Next is one we'll quick through. Well, this is our own question because in this RTP I didn't see any indifference point ka question. My favorite topic from this particular, or my favorite concept from this particular topic is indifference point and financial break-even point. They get popularly asked, so I didn't want to skip that. One question we will run through that. This is question number 22 from our class notes. It is there in your study material also. Sun Limited is considering two plans. Funding requirement is 100 lakh. Two options. Plan 1 is 100% of the money you will raise through equity shares. Plan number 2 says 25% you will raise through equity, 75% you will raise through debt. What is the funding requirement? 100 lakhs. Cost of debt is 12%. Tax rate 30%. Equity shares of 10 each. 10 is your face value. Issued at a premium of 50. That means what is issue price? 10 is a face value of the share. You are giving it at a premium of 15. So issue price is 25. Expected EBIT is 40 lakhs. What is the first requirement? EPS in each of the plan. You just need to calculate EPS. That means we need each and we need number of equity shares. So do you know EBIT? Yeah, here only will. This is a fatafat easy question. What is EBIT, sir? Doesn't matter whether you go for plan number 1 or plan number 2. EBIT is 40 lakh only. Okay, from EBIT, if you want to calculate EPS, first we need each. So what we have to do? Deduct the interest. Under first plan, is there any debt? Are you going for debt or only equity? Only equity. So interest is 0. Under second plan, how much money will come through debt? 100 lakh is totally required, and in that 75% you will get through debt. That means how much you will raise the debt? 75 lakhs. What percentage is the cost of debt they told? 12%. So 75 lakh into 12% you do. How much are you getting? 9 lakh. That is your interest amount. That's what they've given you. 9 lakh is the interest. So from this, if you do, you're going to get earnings before tax. Deduct tax rate. What is the tax rate? 30%. If you deduct tax rate, you're going to get earnings after tax to be this much. Okay. Is there any preference dividend? No, that means earnings after tax itself will become your ish divided by what, sir? Number of equity shares. In the first plan, how much money you want? 100 lakh. Entire 100 lakh will come only through equity shares. And one equity shares, you can issue it at what price? One equity shares, you can issue it at what price? 25. 100 lakh totally you want, and by issuing one share, maximum you can raise is 25 rupees. That means how many shares you need to issue? 4 lakh shares you need to issue under plan number 1. Is my statement right? Totally you want to raise 100 lakh. On one share you can issue it at maximum of 25 rupees. So how many shares you need to issue under first plan? 4 lakh shares. That's your plan number 1. So you got your each 28 lakh. You got your number of equity shares to be 4. How do you get EPS? These two got division, which is 7. Easy. Next plan. In the second plan, may entire 100 lakh will come through equity or only 25%? 25%. That means only how much money will come through equity shares? 25 lakh. And on one equity shares, how much money you are raising it for? 25 rupees. So how many equity shares you need to issue? 1 lakh equity shares. Under plan number 2, maximum you will issue 1 lakh equity shares. Each is 21.7. Number of equity shares is 1 lakh. So your EPS will be 21.7 under 2 plan. That's a simple requirement. EPS under both the plans. Can I go for the second requirement? This question was asked in May 19 for 5 marks. Financial break-even point. FBP they have asked individually. You know this already. For equity plan, what is the financial break-even point? EBIT should be equal to 0. For a debt plan, if you want to find out financial break-even point, EBIT should be equal to what? Interest charges. Under first plan, do you have interest charges? No. Under second plan, what is the interest charges? 9 lakh. That means only if your EBIT is equal to interest charges, which is equal to 9 lakh. Only then EPS will become 0. That's what they asked. Manageable. Can I move on to the next? Indifference point between plan 1 and plan 2. Now we have to calculate indifference point. Indifference point means can you take this EBIT or we have to calculate EBIT? Calculate EBIT. Because very essence of indifference point means what? What should be your EBIT so that both the plan will give you same EPS. So given by you know the formula already. EBIT minus I1 into 1 minus tax rate in minus preference dividend divided by E1. Here EBIT do we know, or that's what we are finding. So yeah, EBIT we don't know. Is there any interest in plan number 1? In plan number 1, interest is 0, so I've written 0. Into 1 minus tax rate. Preference dividend is also 0. Divided by number of equity shares. Under first plan, what is the number of equity shares? 4 lakh. So divided by 4 lakh. It should be equal to second plan ka EPS. Again, EBIT minus I2. Under second plan, do you have interest? Yes. You have interest charges. How much? You have interest charges. How much? I means not interest rate. I2 here stands for interest amount. EBIT minus I2. What is interest under second plan? 9 lakh. So EBIT minus 9 lakh you do into 1 minus tax rate divided by number of equity shares. Under second plan, what is the number of equity shares? 1 lakh. Solve this equation. When you solve, you're going to get EBIT to be 12 lakh. Manageable. One quick fix to solve is, here you have 4 lakh. No, here you have 1 lakh. One way to solve is cross multiply. 1 lakh you multiply to this number, 4 lakh you multiply to that number. But the numbers will become huge. Another way is 4 lakh divided by 1 lakh you do. How much are you getting? 4. So directly solve this as 4. Instead of 4 lakh, just write the number itself as 4. That way numbers will become smaller. That is one quick way to solve the equation. If you don't want to do this number, one quick fix is 4 lakh divided by 1 lakh you do. You're going to get 4. Otherwise, multiply 4 lakh to this side, 1 lakh to that side and solve. You'll also get the same answer. Your call, whatever maths you're comfortable with. Okay, Saru. This is one such popular question that can come. Done. Now we'll run through one particular aspect called arbitrage. Arbitrage as per approach. I had given you whole pointers about all that. There are about 4 scenarios. One scenario, the first scenario is usually can come in the examination, which we will run through. Alright, sir, what is this arbitrage process? Sir, what does approach say? If there is no tax rate, then the value of the levered firm should be equal to value of unlevered firm. Both the firms ka value should be same. Sir, if it is not same, what to do? Whichever firm ka value is high, that firm ka shares you sell. You buy other firms ka share whose value is lesser. That's what we call it as arbitrage. Okay. Arbitrage means whatever shares you're holding, you sell it and buy other company ka shares. Okay. Now we'll take you through that with one question. This is an RTP May 24 ka question itself. Following data is available with respect to 2 companies having same business risk. Capital employed is 3 lakh. EBIT 45,000. Cost of equity 12.5%. Company A is a levered firm. Company A is a levered firm means, do they have debt? Yes. B is an unlevered firm. So that debt will obviously be 0. Okay. Equity and debt, their capital composition they have given. Capital employed means how they have raised the money. These two addition you do, how much are you getting? 3 lakh. That is what is capital employed. And this is 0 plus 3 lakh is again 3 lakh. So totally both the firms have raised a total finance of 3 lakh rupees. An investor is holding 20% shares in a levered firm. Levered firm means that firm which is using debt. So currently an investor is in which firm? Levered firm. Calculate the increase in annual earnings. If he switches his holding from levered firm to unlevered firm, that means levered firm, he is currently a shareholder in levered firm. That levered firm ka shares he will sell and he will buy which firm ka shares? Unlevered firm ka shares he will buy. So when he does this, how much extra he will earn? That is what they're asking. Okay, Saru. All right. So now quickly we'll do the thing, math over here. A is holding 20% shares means which shares is he holding? Equity shares. Does EBIT belong to equity shareholders or ish? Ish. Okay. So first step in arbitrage process, or even here also, I know there are 4 kinds of arbitrage. In the interest of time, I can't run through all these things. In regular class, I've given you with steps and we have solved all the 4 cases also. All these are examples in study material, but still I had solved it. Okay. I've given you with steps also. In case you forget, you can go through that and we do it. Okay. You can go through that. But now I'll run through one thing, whatever this case is there. Even if arbitrage process is completely unclear to you, those of you who are watching it for the first time, if you have skipped it before, simple one is, even if you're not able to solve full question, in arbitrage, 2-3 things so easily you can find out. One is, first find out market value of equity, which is denoted by the symbol S. That everybody knows. Yes, how do you find out market value of equity in this chapter? Each divided by cost of equity. 1 mark in your pocket. Existing return. Each if you know means this investor owns entire each or he owns only 20%. 20%. If he's owning 20% means 20% of each is his no. Existing return, you know. Another half a mark. Stop there. Instead of 5, you got 1.5 marks. Good enough. Others I will do. You don't skip. Yeah, I have this only I've taken 2 hours class minimum in regular class there with the steps and notes. So each time I've dictated the steps and we have solved. Almost 2.5 hours we have taken for this. You guys skip madangilla. Okay. Only for the online guys I'm saying. You now also this case anyway which way I'll solve you. Other 3 cases I'm talking about. Alright. So the first thing in these processes to find out market value of equity denoted by the symbol S. For both the firms, let's find out. What have they given in the problem, sir? EBIT. Okay. So EBIT ka both the firms is 45,000. Alright. We need market value of equity means we need each. But right now where are we? EBIT. From EBIT, how do we get to each? First deduct interest. First firm, how much debt they have? 1.5 lakh. What is the interest rate on debt? 10%. 1,50,000 ka 10% you do. How much is that? 15,000. Second firm is unlevered firm. So they don't have debt. So they don't have any interest also. So how much is earnings before tax? 30,000 and 45,000. Minus tax. They only told we live in a no tax world. That means the tax is how much? 0. That means how much what are you going to get? Eat. There is no preference dividend. So earnings after tax and earnings attributable to equity shareholders are same. So how much is each? 30 and 45 respectively. So do you know cost of equity? Yes. Capital employed for both the firms is 3 lakh. EBIT of both the firm is also 45,000. Cost of equity of both the firm is also 12.5%. That's the reason they've given that as a common above. So how much is cost of equity? 12.5%, which is 0.125 and 0.125 if you want to express in full number. Correct? So how do you get market value of equity? How do you find out market value of equity? Each divided by cost of equity. So these two ka division you do. 2,40,000. These two ka division you do. 3,60,000. 1 mark till now got it. Yes, sir. Market value of equity of both levered firm and unlevered firm. Currently you are an investor in which firm? Levered firm. You as an investor are holding how much percentage? 20%. Currently you are in levered firm. From levered you are going to unlevered firm. What is the each of the levered firm? 30,000. Okay. How much percentage you are owning? 20%. That means what is your existing return? 30,000 ka 20%, which is 6,000. Easy now. This is your existing return. Okay. Now, sir, you want to sell levered firm ka share and buy unlevered firm ka shares. What is the total market value of the levered firm? 2,40,000. If you own 100% of levered firm, then you will get, by selling totally, you will get 2,40,000. You as an investor are owning 100% or only 20%? 2,40,000 is the value of market value of entire equity shares, but we own only 20%. So that means what is the market value of equity shares of the investor? What is the market value of equity shares of the investor? 20%. So 2,40,000 ka 20% you do. How much is that? 48,000. That means if this investor sells, means he will get how much? 48,000. Till here, any problem? So this is what first you need to do. First find out market value of equity of both the firms, and then find out by selling the shares totally how much will the investor get. That is one. And what is the existing return of the equity shareholder? That is nothing but each multiplied by the return percentage. Okay now. Now sir, levered firm means there is a debt. There is an element of debt. But when you're moving to debt, levered to unlevered firm, the whole funda is the risk composition should not change. How much ever risk you had before, same risk you should have later also. That's how arbitrage works. Meaning when the risk is same, you should get a higher return. That is the whole process of arbitrage. You are currently in which firm? Levered firm. Does levered firm have debt? Yes. That means you as an investor, are you exposed to debt risk? Yes, because your firm has a debt. But unlevered firm, do they have debt? No. That means you are moving to a less risky firm. Now, that means the risk is reducing. Can it reduce through arbitrage process or it should not? It should not. That means what you have to do here. Earlier investor had debt risk. Now when he goes to unlevered firm, will he have that debt risk or no debt risk? No debt risk. Hence what the investor has to do is, to get that debt risk, he has to borrow the money. To bring that risk element, he has to borrow the money. How much borrowing? Simple. How much is the debt in the levered firm? 1,50,000. Entire debt risk the investor had, or only 20%? Only 20%. That means you take, what is the debt in the levered firm? 150. What is investor ka share? 20%. So take 1,50,000 into 20%. You do. How much is that? 30,000. Basically, to bring in this debt risk element, investor has to borrow 30,000 rupees. How did we get this 30,000 again? The debt in the levered firm. How much is the debt in the levered firm? 1,50,000. But investor does not own 100%. He owns only 20%. That means he is subject to only 20% risk. So take 1,50,000 multiplied by 20%. That will get you how much? 30,000 rupees. So now by selling levered firm ka share, how much will the investor get? 48,000. How much did he borrow? 30,000. That means how much money is available with him now? 30 he borrowed, 48 he will get by selling the shares. That means totally how much he'll get? 78,000. What will he do with this money? Invest. Where? Unlevered firm. What is the market value of unlevered firm? 3,60,000. Sir, 3,60,000 is the market value of the firm, provided you want to buy 100%. Can you buy 100%? No, to buy 100%, we want how much money? 3,60,000. But currently, how much money is available with 78,000? With 78,000, how much percentage shares of unlevered firm can you buy? 78,000 divided by 3,60,000 into 100. How much is that? 21.67%. With the money available of 78, you can buy levered firm ka equity shares to the extent of 21.67%. Manageable. That's all. Now you are owning how many shares? How much percentage shares in unlevered firm? 21.67%. What is the each of the unlevered firm? 45,000. Each belongs to whom? Equity shareholder. Now are you an equity shareholder in unlevered firm? Yes. How much percentage you own? 21.67. That means out of this 45,000, 21.67 belongs to you now. That means what is your new return now? 45,000 into 21.67, which is 9,750. Earlier, how much was your return? 6,000. Don't compare and say I gain and all. Hang on. What is the new return you are getting? 9,750. But did you also borrow? Yeah. How much you borrowed? 30,000. What is the interest rate on borrowing they gave in the question? Where is that? Here. The interest rate on borrowing is 10%. How much did you borrow? 30,000. What is the borrowing rate? 10%. That means how much interest you are receiving or paying? You borrowed. That means you need to pay. How much interest you need to pay? 30,000 is a loan amount. Interest rate is 10%. So 3,000 you have to pay. 9,750 is your return. 3,000 is your payment. That means what is your net return? 6,750. Earlier, how much you used to get? 6,000. That means through this arbitrage process from 6,000 earnings, you're going to 6,750. So how much you increased it by? 750. That's all this arbitrage process works. Yes, sir. So this is an arbitrage process from what to what? Levered firm to unlevered firm. Hence a quick walkthrough again. What do you have to do? First find out market value of equity of both the firms. Basically S you need to find out of both the firms. Then find out share existing return in the levered firm. How do you get that? Each multiplied by the return percentage. And now we are planning to sell. No? That means you want to know by selling how much money will you get. So take the market value of equity of the levered firm multiplied by the shareholding percentage. Here it was 20%. So that means by selling you 20%, you will get that much money. But levered firm had an element of debt. That means it had an element of debt risk. But unlevered firm does not have the debt risk. So can you change the risk composition or you cannot? You cannot. That means what do you have to do? To bring in that debt risk into your picture, we have to borrow. How much borrow? What is the total debt in the levered firm? 1,50,000. Entire 150 you will borrow or only your share? Your share. What is your share? 20%. So 1,50,000 ka 20% is how much? 30. So 30,000 you will borrow. Okay. So that means now you will have a lot more money. By selling you will get money, and through borrowings you will have money. So total money was 78,000. With that 78,000, how much new percentage of shares can you buy in the unlevered firm? Based on that percentage, you will get the new return. There will be a return also, and borrowings you have to pay interest also. Net of these two, and you will get the final return in the new firm. Compare with this with the old firm. Obviously, new return will be a higher one. Because we want higher return, that's the reason we are doing all this arbitrage wala drama. Practically, does it work? Absolutely no. Okay. Theoretically, will it work in exam? Absolutely yes. Okay, now fine. Because yeah, sir, if it was so simple, means everybody would have done and earned some money. I like that. Yeah. So with this, I think chapter number 5 ka revision also we have completed. Yeah. Should we write the steps or just the answer? So it's these sort of problems, no, it's better you write it with steps. Because what happens is you would have trained your mind to write your solution through steps. The moment you change a little bit here and there, no, that confidence will not be there. You will get stuck. So I personally suggest follow the same step, so that it's only 8 to 10 steps now. You know it for write it down so that you have that flow. If you have that flow, these sort of questions you can answer within maximum 10 minutes, not more than that. So I wouldn't say to distract. Follow the same. Sir, can I do one more topic and take a break? Would that be okay with you? Just quickly, about maybe another 45 minutes, that's all. Okay. Next, we would like to take up is ratio analysis. Okay, ratio analysis. Sir, by looking at financial statement like P&L or balance sheet, can you tell me whether company has utilized their funds properly? Company has raised equity shares of 50 lakh. They've raised debentures worth 30 lakh. By looking at P&L balance sheet, can you tell whether they have utilized that money properly or not? No. By looking at balance sheet P&L, can you tell whether the company is utilizing their fixed assets properly or not? Is their credit policy proper or not? Do they have enough coverage? Whether they have enough money to pay interest, whether they have enough money to dividend, etc., etc. Just by looking at pure financial statements, can you tell? Difficult. Hence comes another extra fitting called ratio analysis. Ratio analysis is basically computing some extra data so that user can understand your financial statements a little better. The way of calculating ratio is very simple. One number in the numerator, one number in the denominator. That's one number in the numerator and denominator. Sorry, any random number you can take. No. There has to be a relationship. You can't take some random numbers. They have to be absolutely related. Okay. So now I'll quickly run through few ratios. First is liquidity ratios. Liquidity ratios. Through liquidity ratios, we are trying to ascertain whether the company has enough cash so that they can manage their day-to-day business. That is important. So first such liquidity ratio is current ratio. Current ratio is given by the formula current assets divided by current liability. So ideal current ratio is 2:1. Meaning if you have 1 rupee current liability, you should have 2 rupee worth of current assets. This is the ideal one. Industry average. But some companies could be having more than 2 or they could be having less than 2. That's fine. Is that okay? If they ask ideal, write it as 2:1. Meaning for 1 rupee current liability, you should have 2 rupee worth of current assets. So what is current ratio trying to calculate? Whether the company has enough current assets through which they can settle off current liabilities. That's what it is trying to essentially calculate. Second one is quick ratio. Quick ratio is given by the formula quick assets divided by current liabilities. So how do you get quick assets? Basically take current assets, deduct your prepaid expenses and deduct your inventory. Because inventory, we naturally assume that you cannot sell it quickly. That's the reason we deduct it. Divided by current liability will give you quick ratio, also known as asset test ratio. And the ideal quick ratio or asset test ratio should be 1:1. Meaning if you have 1 rupee worth of current liability, you should have 1 rupee worth of current assets. So this ratio is basically trying to test whether you have enough quick assets through which you can settle your quick or whether you can settle your current liabilities. So the ratios could be umpteen. Okay, I'm discussing the one ratios that gets popularly asked in the examination. Normally around 15 to 20 ratios are there. That only often gets repeatedly asked in exam. So we'll run through that. Rest of the things, have a quick run through. Don't have to spend too much time on that. Next is capital structure ratio. Capital structure ratio is trying to target how have you raised your finance. So first popular capital structure ratio is debt equity ratio. It is trying to compare what is the percentage of debt versus what is the percentage of equity. Debt equity ratio is given with the formula total debt divided by total equity. So total debt here means short-term debt and long-term debt. Total equity here stands for your shareholders equity. Shareholders equity means equity share capital plus reserves in surplus. This is also known as net worth. Another name for this is net worth. So debt equity ratio is nothing but total debt divided by net worth. Okay. So ideally debt equity ratio should be in the ratio of 2:1. This is one of the industry benchmark. Meaning if you have 1 rupee equity, the industry expects that the maximum debt a company should raise is 2. For 1 rupee equity, maximum debt they can raise is 2. If it goes beyond 2, the industry will look at your business as a risky business. So many people analyze this. Is that okay? That's one, debt equity ratio. Another one is proprietary ratio. Proprietary ratio is trying to calculate how much of proprietary funds is utilized to buy fixed assets or to buy assets. Because to buy assets we need funds, no? So how much of that fund has come through proprietors? Proprietor means owners. Now you tell me, sir, who are owners of the company? Shareholders. Who are the shareholders? Equity shareholder and preference shareholders. So how do you get proprietary ratio? Proprietary funds divided by total assets. And how do you get proprietary funds? Equity share capital plus reserves in surplus plus preference share capital. If you add all this, you're going to get proprietary funds. Basically, this ratio is trying to calculate how much of owners' funds are being utilized to buy your assets in the company. Okay. Next is your coverage ratio. Usually providers of finance will pay a close attention to this coverage ratio. One such popular coverage ratio is interest coverage ratio, given by the formula EBIT divided by interest. Interest coverage ratio is simply given by the formula EBIT upon interest. Like let's say EBIT is 10 lakh. Interest is 1 lakh. If you calculate how much are you getting? 10. What does this mean is company has 10 times the profit. Okay, they can pay the interest 10 times because interest payable is only 1 lakh. Profit available is 10 lakh. That means with the available profit, the company can pay the interest 10 times. Almost 10 years ka interest company has the capability to pay. So more and more this coverage ratio, higher the coverage ratio, providers of finance will breathe a sigh of relief. They'll be happy because they have given funds means they would expect return. No? So return they will get only if the company is earning profits. Loss making company means then they will approach bank and say, please, interest reduce kar do, delay my payment, like that 101 dramas, nautankies they will do. No, that's the reason. So many financiers will obviously pay a close attention to this coverage ratio. One such coverage ratio is interest coverage ratio. Meaning interest coverage ratio is basically trying to calculate whether the company has enough profits to pay off interest. Next coverage ratio is preference dividend coverage ratio, given by the formula. See, is EBIT available for preference shareholders? No. What is available for preference shareholders? When will you pay preference dividend? After paying tax. So instead of EBIT, what you should take in the numerator? Earnings after tax. Divided by what coverage ratio you want? Preference dividend. That means the denominator will be preference dividend. Same like that. Let's say this is 1 lakh, preference dividend is 20,000. That means how much are you getting? 5. That means what? Company has enough profit to pay the preference dividend 5 times. That's what same preference dividend coverage ratio is also trying to calculate. Same lines may you can also calculate equity dividend coverage ratio. Given by the formula what now? Now will you take EBIT? Yeah. Now what is available for equity shareholders? Each. So numerator will become each. Denominator will become equity dividend. Same funda. Okay. Next is efficiency ratio. Efficiency ratio is trying to calculate how efficiently company is using their assets or etc. etc. No, basically how efficiently they are functioning. That is what efficiency ratio is trying to calculate. First efficiency ratio is total asset turnover ratio. So many turnover ratios are there. I told you in class, one quick fix or way to remember is, in all, when you read this formula, I mean, what is the name saying? Total asset turnover ratio. So your mind is saying asset divided by turnover, because that's how this the ratio ka structuring is done. But I told one quick way to remember is, in turnover ratio, always turnover will come in your numerator. Other component will come in your denominator. So if you want to calculate total asset turnover ratio, it's given by the formula turnover, as in sales, divided by total assets. If you know average assets, take average assets. If you don't know average assets ka information, take total assets. Because to find out average, we need 2 years ka information. Because first year ka closing balance will become second year ka opening balance. So if they have given you 2 years ka balance sheet, then you will be able to find out the average, TOEIC average. If they have given you only 1 year data, then instead of average total assets, simply cut off average and take only total assets. So depending on the question, you may have to slightly tweak this. Okay, that's one. So basically, let's say this you calculated. Sales was 10 lakh, asset was 2 lakh. That means how much are you getting? 5. So if asset turnover ratio is 5, what it means is, it's asset turnover ratio, right? What it clearly means is, if you invest 1 rupee in assets, if you buy asset worth 1 rupee, that 1 rupee worth of asset will generate revenue of 5 rupees. With just 1 rupee investment in asset, you are able to generate a revenue of 5 rupees. That means what, sir? All this turnover ratio should be on the lower side or higher side? Higher side. So if this is higher, means you are using your assets efficiently. On the same way, if you want, you can also calculate fixed asset turnover ratio. Construct the formula for me. If it is fixed asset turnover ratio, then the formula will be sales divided by fixed assets. If you know average fixed assets, take average fixed assets. So same way, let's say fixed asset turnover ratio, you got it to be 3. You calculated fixed asset turnover ratio and got it to be 3. What is the indication? If you buy a fixed asset by investing 1 rupee, then that 1 rupee worth of fixed asset will generate 3 rupee worth of sales for you. So the more and more this turnover ratio is, better and better the company is effectively and efficiently using their assets. Next is your inventory turnover ratio. Okay, I told you what is the simple fix for turnover ratio. What should be in the numerator? Inventory. So that means normally what is the formula? Turnover divided by average inventory. But what are you trying to calculate? Inventory. Sir, inventory is sales, means it includes profit. Inventory, do you value it at sales value or cost value? Cost value. Hence, the first priority for inventory turnover ratio is always COGS. COGS. Cost of the goods sold. If COGS is missing, then you will go for sales. Check the problem. If they're giving you COGS, take COGS. Or sometimes problem only will tell, calculate inventory turnover ratio based on sales. Like that, they will only specify. In that case, what will you take in the numerator? Sales itself. If nothing is mentioned, if both the information is given, first priority always to COGS. COGS is missing, then you will go for sales. Divided by what, sir? Average inventory. To find out average, we need 2 years ka data. If you don't have 2 years ka data, instead of average inventory, take only closing stock. Fine. Like that way you can find out. Can I move on to the next? Basically, let's say you got inventory turnover ratio. So what is the indication of inventory turnover ratio or inventory turnover ratio? What inventory turnover ratio is trying to calculate is how soon the company is able to sell off their inventory. How soon the company is able to dispose of or sell off their inventory. The quicker they are able to sell this inventory, better it is for the business. Okay. All right. Next is debtor turnover ratio. Now you tell me, sir, debtor turnover ratio. In turnover ratio, what should be in the numerator? Sales. But you're calculating what here? Debtors. Debtor arises on total sales or only credit sales? Credit sales. That means you will tweak the formula as what, sir? Instead of total sales, you will take it as credit sales divided by average accounts receivable. Though the word here is debtors turnover ratio, this is used for both debtor and bill receivable. So always calculate it, use it as, don't take average debtor, take it as average accounts receivable. Accounts receivable means debtor and bill receivable put together. In majority of the problem, bill receivable information will be missing. That's the reason we say accounts receivable and debtors are same. If at all they have given, consider that. Okay. And if they've given you only 1 year data means take only that particular year ka data. If they've given you 2 years data means take the average. That's the thing. Okay. If let's say debtors turnover ratio you calculated and you got it to be 4 by chance, what it means is you are able to collect the money from debtors in the current year 4 times. If your debtors turnover ratio is 4, what it means is in the current year you are able to collect money from debtors 4 times. Okay. Using debtors turnover ratio, you can figure out something called debtors credit period or collection period, also known as debtors velocity. That is simply given with the formula 12 divided by debtors turnover ratio. It's common sense. DTR is how much? 4. What does DTR ka full form? Debtors turnover ratio. How much did you get it to be? 4. That means what is the indication? 4 times you are able to collect from the debtors. That is possible only when the collection period is 3, no sir. 3 plus 3 plus 3 plus 3. 4 times you add, how much is this? 12. Correct? No. That means what is your credit period you're giving to your debtors? 3 months. That only is expressed as formula over here. How do you get debtors collection period? 12 divided by debtors turnover ratio. In my previous example, what is debtors turnover ratio? 4. That means your debtors collection period is 3 months. This 12 means it is in days or months? Months. That means final result also will be in months. Usually this data will be given in months. If at all they give it in days, then instead of 12 months, take it as 365 days. If they give it in weeks, take 52 weeks. Like that you tweak. Most probably they'll give you this data in months. Usually. Not mandatory, usually. Same way you can also calculate creditor turnover ratio. How do you calculate creditor turnover ratio now? Don't say sales. Creditor arises on account. See, ratio analysis means random number or related number. Related number. So is sales and creditor anyway related? No. So instead of sales, what should come? Purchase. Specifically total purchase or credit purchase? Credit purchase. The numerator will become credit purchase divided by average creditors, average accounts payable. Accounts payable means creditors and bills payable put together. Usually bills payable will not be there. They'll only give you creditors information, but just check. And if they don't give you 2 years data, instead of average, take only creditors ka closing balance. Okay. Same, if they give you creditors turnover ratio, can you find out creditors ka velocity or creditors ka payment period? Yes, same way. What is that? 12 divided by creditors turnover ratio. That will give you your creditors payment period. Okay. Few more. Profitability ratio. Profitability ratio, few things you already know. GP ratio. How do you calculate GP ratio? GP upon sales into 100. Gross profit only considers your direct income and direct expenses. Next is your net profit ratio. How do you calculate net profit? Net profit divided by sales into 100. Net profit considers every expense and every income. Next is your operating profit. EBIT only we call it as operating profit. So operating profit ratio is given by the formula EBIT upon sales into 100. So how much income you are getting through your operations is what operating profit ratio is trying to calculate. Okay. And operating cost is given by the formula COGS plus operating expense. Not much relevant, but it's fine. Okay. Next is return on assets. Return on assets is trying to calculate how efficiently are you utilizing your assets. So return on assets, there are 2 formulas. Use this mostly I would suggest in examination. Some problems may study material also uses this. It's fine. In my opinion, you can go for this. So return on assets is given with formula EBIT into 1 minus tax rate divided by either total assets, or if information is there, go for average assets based on what data they have given in the question. Okay, sir. Since it's return we always want it in percentage. Hence we multiply by 100 at the end. Next is ROS, not your Valentine's Day. ROS here stands for return on capital employed. How do you get return on capital employed? EBIT upon capital employed into 100. Capital employed here stands for your long-term finance. Capital employed here stands for your long-term finances. What are your various sources of long-term finance? Equity share capital, reserves and surplus, then preference share capital and your debt. These put together will become your capital employed. So EBIT upon capital employed into 100 if you do, you're going to get ROS. But this ROS is on what basis? Pre-tax basis. Sometimes in the problem they will say calculate return on capital employed on a post-tax basis. If you want to do post-tax basis, I already gave you one shortcut. Simply you have to do 1 minus tax rate. So ROS on an after-tax basis, how do you get, sir? EBIT into 1 minus tax rate divided by capital employed into 100. Okay. Next is return on equity. So now can you take EBIT in the numerator? This is a return on equity. Is EBIT available for equity shareholders or what is available? Each. So instead of EBIT, make it as each. Instead of capital employed, we're calculating equity here. No? Equity here stands for shareholders' equity or net worth. So divided by new denominator. What should be in our denominator? Equity share capital plus reserves and surplus. That only we're calling it as net worth. In fact, I've written here also. Is that fine? Okay. Next is your dividend payout ratio. Okay, dividend payout ratio, as we discussed previously, out of earnings, how much percentage is given as dividend? So how do you get dividend payout ratio? DPS divided by EPS. That will give you your dividend payout ratio. It's trying to calculate out of earnings, how much percentage of earnings is given away as a dividend. That's one. But whenever there is a dividend, sir, there could be three ways this could get asked in the question. I discussed with you in regular class. I'll quickly discuss that as well here. Sir, if they say dividend declared 20% in the question, if they say dividend declared 20% in the question, always apply that dividend declared percentage on the face value because it's a normal dividend declared by the company. Okay, watch out. If they use the word dividend payout is 40%. In the question, if they say dividend payout is 40%, at 40% you will multiply or you will apply it on earnings per share because dividend payout ratio tries to calculate on earnings. Out of earnings, how much percentage is given as dividend? So if they use the word dividend payout, then you apply that percentage on EPS. However, if they use the word yield, dividend yield is 30%. Then this 30% yield stands for market price. And market price is denoted by the symbol yield. So if they say dividend yield is 30%, then apply that 30% on market price per share. So watch out for this. Not too many complexities they've brought in. 1 or 2 times they played around this concept in the examination. Okay. All right. Next is PE ratio. You know all this already. PE ratio. How do you get PE ratio? Name itself is saying price earning ratio. So price earning ratio is given by the formula MPS divided by EPS. Market price per share divided by earnings price per share. So suppose this is 15. Suppose you calculated this and you got it as 15. What is the indication? Price earning ratio, if you calculate and get it to be 15, what it means is for 1 rupee worth of earning, the investors in the market are willing to pay 15 rupees to buy this company ka share. Okay, if PE ratio is multiple as 15 means if company is earning 1 rupee, then shareholders in the market are willing to pay 15 rupees. Or why so high? Because they are buying the shares with not with current earnings expectation, but with future. Currently, maybe the company is earning only 1 rupee, but in future, these investors feel this company will earn a lot higher. That's the reason they're willing to pay a lot of premium. That is what P ratio is trying to calculate. Okay, last is dividend yield. I already told you, whenever they use the word yield, it stands for market price. So dividend yield is given with the formula DPS divided by MPS into 100. So yeah, these are usually the ratios that they play around with. So according to me, these are fine. Okay, for the last minute revision. Other things you can quickly run through if you want. Now, ratio analysis also has some disadvantages. One of the advantages is it gives you extra information with which you can analyze financial statements better. But it also has some disadvantages because ratio is subject to accounting adjustments. Like you made provision for doubtful debts. Provision for doubtful debts affects your debtor. That means it will affect your debtors turnover ratio, debtors collection period, everything. So one number change as per accounts will also cause your ratio analysis also to change. So it is subject to accounting adjustments. Okay, that is one. Accounting adjustments and year-end adjustments and all. And ratio analysis works on garbage in, garbage out principle. Because it works on data. If your data itself is garbage means the result also is garbage, like that. So for you to do proper analysis, the data that you take also should be proper. One more thing is ratio analysis is not a perfect number. Like let's say you calculated asset turnover ratio and you got it to be 10. Good or bad? Brilliant or good? Don't know, sir. Depends. That's what. So if you calculate one ratio and get it to be one number, you can't say with certainty whether this is good or bad. Now you said good. Let me modify the data. This is for A Limited. The market, sir, asset turnover ratio is 20. As per market, the asset turnover ratio is 20. This company is having an asset turnover ratio of 10. That means this is good or bad or no? Bad. That means not garbage, but yeah. So that means the ratio as such does not have value. Ratio gets its value only through comparisons. So if you want to say whether it is good or bad, you need to compare it with the industry average, competitor average. That's one of the limitations of the ratio analysis. Well, a topic, not that important. That's fine. So can we go through a few questions relating to ratio analysis topic? One of the popular questions through ratio analysis is either they will ask you to calculate some ratios directly. Usually 5 marks, 5 cases they will give, ask you to calculate ratios. That is one way. Another popular way they'll ask is they'll ask you to prepare either P&L or balance sheet. These are the 2 ways in which usually ratio analysis chapter questions gets asked for. So check this RTP question. What are they asking? Prepare balance sheet and income statement, as in P&L and balance sheet is what they are asking for this particular company. Okay. Now in ratio analysis, sometimes what could happen is in ratio analysis topic, 3 or 4 working notes you will be able to do. Then you might get stuck. Whenever you're getting stuck in ratio analysis, what did they ask? Balance sheet and P&L. So first thing what you do is, before you start the question, have one balance sheet ka format, have one P&L ka format. As in when you get the data, push the number into balance sheet. That balance sheet or P&L itself will give you some clues. If you are getting stuck, you'll not get it here. When we do the problems, we have seen this. Yeah, I think you should be able to get it. I think. Yeah. All right. So always have that format. So in case you are getting stuck, it will definitely help you. So now let's see about this problem. GP they have given 1,20,000. Do you know GP percentage? Yeah. Sir, with the GP amount and GP percentage, what you can find out? You can find out sales. How do you get GP percentage, sir? How do you get GP percentage? GP margin, how do you get? GP upon sales into 100. So GP amount is 1,20,000. Sales we don't know, but GP percentage they're telling is 40%. Yes, no? Okay, or I have multiplied by 100, so I'll take this as 40 itself. So calculate this. How much is the sales you're getting? So first number is sales. We got it to be 3 lakh. Okay, now they asked income statement. So can we tick off? Would that be okay with you? So in income statement, my first thing I'll tick off is sales. I've got it to be 3 lakh. Okay. Next, let's see what information we can use. Shareholders funds. Shareholders funds comes in P&L or balance sheet? Balance sheet. Check in balance sheet. They've taken shareholders funds as 5 lakh. They've taken directly equity share capital to be 5 lakh. Shareholders funds means equity share capital and reserves in surplus. Sometimes they will give you a breakup between equity share capital and reserves in surplus. They will say net worth is in the ratio of 2:1. Meaning equity share capital and reserves in surplus is in the ratio of 2:1, or maybe for simplicity, I'll take it as 3:2. If they say like that, then what you will do? Then don't write 5 lakh directly. This 5 lakh is shareholders fund. Shareholders funds means your net worth. That means total net worth is how much? 5 lakh. That you have to distribute it in 3:2 ratio. That means your equity share capital will be 5 lakh into 3 by 5, which is 3 lakh. Reserves in surplus will be 5 lakh into 2 by 5, which will be 2 lakh. In this problem, they have not given that breakup. So directly they have written share capital to be 5 lakh. If they give breakup, you need to distribute. Otherwise, distribution or allocation is not required. So in this problem, this is required or not required? Not required. Okay, next one. What is the next one they gave? These are fine. Net profit margins. How do you get net profit margin? Net profit divided by sales into 100. So how do you get, what is sales? You got already sales to be how much? 3 lakh. What is NP margin? 10%. So 3 lakh ka 10% is how much? 30,000. That is your net profit. Net profit means it is always profit after tax. PAT only we call it as, or EAT only we call it as net profit. So how much is that? 30,000. So check, have they taken net profit, that is profit after tax is 30,000. Yes, that's the income statement we have ticked off. Next, what have they given? PBIT divided by PBT is 2:1. PBIT divided by, we'll structure an equation. PBIT divided by PBT, can I write it as 2:1? Therefore, what I can tell? PBIT is 2 times of profit before tax, correct? But check one clear thing here. What do they say? Tax rate is nil. Sir, if tax rate, this is your profit after tax, no? This is your profit after tax. Yes. If there is no tax rate, then profit before tax and profit after tax will be same. Profit before tax and profit after tax will be same. Correct, sir? This is how much now? 30,000. So profit before tax is 30,000. That means what will be PBIT? Double of that, which is 60,000. So have they got earnings before tax is 60,000 or PBIT is 60,000? Yes. So if this is 60,000 and this is 30,000, means obviously interest is how much, sir? 60,000 minus 30,000, which is 30,000. Like this, you go and have to do fill in the blanks wala questions. That's all. Quite easy, but aram se, even if you get stuck also, don't lose your mind. People get one or two, if they don't get the answer for 1 or 2 minutes, automatically they'll start freaking out in exam. Don't do that. It's okay, 1 or 2 minutes extra if you're taking, means think calmly. Still, if you're not getting, means leave some section and move on. Okay, all you need in these questions is 1 or 2 steps. It may be possible that you might get stuck. Think, just quickly visualize it. It should guide you. Okay, you will be able to, but just the more important point is to keep this one very, very cool in examination. Don't freak out. The nervousness will always add more to your things. Okay, it will not do you any good. It will in fact reduce your marks, because due to that nervousness, because many students have seen due to nervousness only kind of not completing the paper, doing 101 crazy things. Okay, write 1 or 2 mock papers. Please do that, and don't write it with your friends. Write it in an atmosphere which is unknown. Now, don't write it in the academy, because academy is like has become your second home now. You've been coming here for 8 to 9 months. That means that is more like you're comfortable with that. Okay. Ideally, choose one place where you have not been and go there and write one mock paper. Because examination is not your daddy's place or anything else. It's a relatively unknown place. So ultimately, I think my personal suggestion to you is when you're writing mock paper, 3 hours or 4 hours, whatever you're planning to write, let it should be written in a place which is totally unknown to you. That way you will get to know what are the things you are going through. Because each one has their own feelings, they'll have their own 101 crazy things that they'll go through. So once if you do that in an alien atmosphere, no, you would have already had experience. Later on when you go to that examination hall, no, it will not freak you out so much. So my personal suggestion is this. Or if you cannot afford it, no problem. At least go to your house or terrace, right there. In your room also, at least lock your doors, throw your phones, make it as absolutely exam atmosphere where nobody disturbs you for the next 3 hours. Write it like that. That is another best shortcut. The best possible way is entirely different atmosphere. If you cannot do that, at least for 3 hours, completely block yourself from everything and just focus only on that paper. And don't worry about the marks. Just your intention of writing mock paper should be mean towards writing speed. Whether are you able to complete the paper? What are the anxieties, fears, etc. you are facing? So that to get yourself acclimatized or get customized to that, you're writing mock papers. Because whatever question, these are all your RTP question, same thing will not come in examination. Maybe few will repeat, but other questions will be on the similar lines with 1 or 2 extra adjustments. Okay, so don't freak out. Aram se take it up. Even if you are not able to solve the question fully, it's absolutely fine. Even 50-60% is good enough to get the exemptions. Now let's come back to this now. So what else is there, sir? We got PBT. Next, they told credit sales to total sales is how much? 80%. So do you know the total sales? Yeah, 3 lakh. That means what will be your credit sales? 3 lakh 80%, which will be 2 lakh 40,000. That is your credit sales. Okay. Next is what? Total asset turnover ratio, which is 0.4. So how do you get total asset turnover ratio? Tell me the formula. Sales divided by, don't write average assets now. Do you have average information here? No, that means what you will take here? Total assets. That only is 0.4. Do you know sales? Yeah, this is 3 lakh. Okay, total assets, do you know? No, that means can I rephrase the equation as total assets is equal to sales, which is 3 lakh divided by 0.4. Correct? How much is this? 7 lakh? 7 lakh 50,000 your total, not your fixed assets. 7 lakh 50,000 is your total assets. Where will total assets come? In the balance sheet, total column. So come to balance sheet. Total assets, have they taken 7.5 lakh? The moment you see the total, no, one always quick fix you have to do is, if total assets is 7.5 lakh means total equity plus liability also should be 7.5 lakh. Immediately write off this. Okay, because this will be a hidden adjustment. This will guide you. If total assets is 7.5 lakh means this side total also should be 7.5 lakh. Write that immediately. Okay, next is what, sir? What is the next one they gave? Where is that? Inventory turnover ratio. Usually for inventory turnover ratio, we give priority to COGS. But what have they told in this problem? Use sales as a turnover. That means what is the formula of inventory turnover ratio here? Here the formula will be sales divided by average. Do we have average information? No, I'll write it as what? Closing stock. Okay, do you know sales? Yeah, sales is 3 lakh. What is inventory turnover ratio? 5. So 3 lakh divided by 5 you do. How much are you going to get? 60,000. So closing stock is 60,000. So closing stock comes in your balance sheet, which is 60,000. So with this, we figured out closing stock. Correct, Asaru? Okay, next what, sir? Where is the next one? Average collection period is 30 days. So how many days credit are we giving to our customer? 30 days. And they're saying use 365 days or 360 days. Sir, do you know total sales? Yeah, total sales is how much? 3 lakh. Debtor will arise on total sales or credit sales? credit sales. What percentage of total sales is credit sales? 80%. That means credit sale is 2,40,000. So 2,40,000 is 1 day ka sale or whole year ka sale? Whole year ka. Here the information is given in days, weeks or months. Here what is the information given in? Its information is given in days. So 2,40,000 is a number for whole year, meaning it's for 360 days. Entire 360 days credit you are giving to your debtors or only 30 days? So if this is 360 means, not 360k, if this is 360 means, this number will be 2,40,000. If this is 30 means, how much is this number? Cross multiply, how much are you going to get? 2,40,000 into 30 divided by 360. How much is this? 40,000. What is that 40,000? Debtors. Because you are giving this 30 days credit to whom? Debtors. Correct? Any problem? Okay, so debtors is how much? 40. Here it's saying 20. 20. No problem. All of you got 20. No issues. No, he probably got excited a little bit. Okay, so debtors is 20,000. Correct? Okay, what is the next one? Okay, no problem. Happens. Let it not happen in exam. That's where this over. Current ratio is 2. But before that, hang on. Current ratio mein I'll be able to calculate current assets and current liabilities. Do I know current liability information? No. So that means let this be on hold. Next, what have they told? Operating expense excluding interest is 60,000. So tell me the breakups are here. Sales minus COGS will give you COGS. COGS minus operating expense will give you PBIT or EBIT. Operating expense have they given in this question? Yes. Operating expense excluding interest, how much are they saying? 60,000. So that they have given 60,000. If this is 60,000, that is 60,000 means obviously the other number will be what, sir? 60 plus 60, which is 1,20,000. We have figured out that. Sales is 3 lakh. GP is 1,20,000 means obviously COGS will be how much? 3 lakh minus 1,20,000, which is 1,80,000. That means our whole P&L is filled out. Okay, next what are they asked? Long-term debt to equity. Sir, how much is your equity? Equity is 5 lakh. Long-term debt to equity is 40%. That means indirectly they're telling you 40% of equity share capital represents your long-term debt. Correct? Equity share capital is 5 lakhs. So 5 lakh of 40% you do, how much is that? 2 lakh. That means long-term debt should be how much? 2 lakh. Check in the balance sheet. Have they taken long-term debt 2 lakh? Yeah. Now I can easily figure out current liability. How? Sir, my total assets was 7.5 lakh. That means my total liability side also should be 7.5 lakh. But if I add these two, what am I getting? 7 lakh. That means obviously current liability is what? 50,000. Arrived as a balancing figure. That's the reason I told keep the guiding factor is the format. You would have never figured out this if you had not put up the format. Because they have not given expressed anywhere in words. So that's the reason the clue is to make the format. And whenever they give you total assets, always also write it on the total on the other side also. If they give you total liabilities, make sure you write the total on the asset side also. That will be a hidden adjustment here and there. You will be able to connect. So this is fully figured out. Now you can use current ratio. They told what is the current ratio? Current ratio is 2. That means what, sir? Current assets is equal to, can I say 2 times of current liability? Okay. How much is current liability? Just now we got current liability is 50,000. That means what is your current assets? 1 lakh. Total current assets is 1 lakh. In that current asset, stock is 60, debtors is 20. We already got. I mean something else should come for 20,000. Stock over, debtor over. What remains? Cash. So cash is arrived as what? Calculated or balancing figure. So basically they took 1 lakh minus 60,000 inventory, 20,000 receivable and got 20,000 as a balancing figure. They put up a working note quickly telling me. Okay. Then the remaining is what, sir? Balance sheet is not matching. 6.5 lakh is still coming. We'll only have current assets on the balance sheet or also other assets. So fixed assets is arrived as a balancing figure. That's what is your balance sheet all about. Okay, sir Ji. Okay. One more fadafat we'll do off. Like this, the ratio analysis question will be very much straightforward in my view, especially balance sheet and P&L preparation. 1 or 2, they may bring in a trickier things, but otherwise 60 to 75% of the whole question will be very straightforward. So all you need to remember in FM is basically formulas and formats and formulas and back to formulas. That's it. Okay. The whole crux, this particular syllabus is structured to test your memory. Okay. There's not too much of logic play around here, because even if you know the logic, somebody else 50 years back would have constructed some formula. We will not have all the data to find out what he did, especially Modi MM approach and all is 1948, 1958, 1960 wala. Okay, but still we are doing. Don't ask me why. Mother body said karne ka matlab karne ka. That's all. Okay, so we can't say. If it is there in our syllabus, we have to compulsorily ಮಾಡಲೇಬೇಕು. ಅವಳದ. Okay, Paklama. Adha question. NV Limited ante. They have furnished the following ratios and information. Equity share capital they have given. First, let's read the requirement. You are required to prepare balance sheet. So first they give you equity share capital. So we'll directly update that off in balance sheet. Yeah, done. Updated. Next, relevant ratios they have given. Current debt is to total debt is 0.5. So if the total debt is 1 rupee means current debt will be 50% of that, which will be 50 paisa. That's what they say. Yes, sir. Total debt is to equity share capital is 0.6. That means indirectly what they're saying, 60% of equity share capital constitutes total debt. Is my statement right? What is equity share capital? 2 lakh. 2 lakh is 60%. You calculate. How much is that? 1,20,000. That 1,20,000 is a current debt, long-term debt, or total debt? Total debt is 1,20,000. And what did they say? Current debt is to total debt is how much, sir? 0.5. Or if you're getting confused in terms of interpretation, you can represent it in equation like this. Current debt to total debt. So the structure will be current debt divided by total debt is equal to how much they say? 0.5. Now you structure, what is current debt? 0.5 times of total debt, like that. So do you know total debt? Yes. Total debt is 1,20,000. So that means what will be your current debt? 60,000. Okay, that's the way to figure it out. Done. So total debt is 120. In that, if current debt is 60 means long-term debt also will be 60,000. So that means the balance sheet full side over. No, current debt 60, long-term debt is 60. So 1 minute. What is the total? 3,20,000. Immediately write the total on the other side also. Total assets is also 3,20,000. Do not forget this. Okay, next what have they told, sir? Fixed asset to equity share capital is 0.7. If you wanted an equation, it will be fixed assets divided by equity share capital is 0.7. Therefore, what is fixed assets? 0.5 times of equity share capital. What is the equity share capital? 2 lakh. So 2 lakh into 0.7 is how much? 1,40,000. This is your fixed assets. Have they taken? Yes. Okay. Next, what did they tell? Total assets turnover ratio is 2.5 times. So how do you get total asset turnover ratio? Sales divided by total assets is 2.5. Okay. So that means therefore what will be your sales? 2.5 times the total assets. Do you know total assets? Yes. Total liability was 3,20,000. So total assets also will be 3,20,000. So if total assets is 3,20,000, what will be sales? 2.5 times of that, which will be 8 lakh. That will be your sales. Next, inventory turnover ratio is 10 times. Sir, inventory turnover ratio ka first priority is COGS. COGS given or missing? Missing. If COGS is missing and if sales information is available, we'll go for the next best priority, which is sales. So how do you get inventory turnover ratio here in this product? Sales divided by average inventory or closing stock? Closing stock, because we don't have 2 years information, so average cannot be used. So the formula here will be turnover divided by inventory, which is equal to how much? 10. Do you know sales are? Yeah, sales is 8 lakh. So 8 lakh divided by 10 will give you inventory of how much? 80,000. Yes, sir. Alright, remaining cash, they have assumed it as a balancing figure. Instead of cash, you can also write it as debtor, because we don't know what sort of current is it. Here they have assumed it as cash. That's all is your balance sheet ka whole drama about. Okay, people. So with this, your ratio analysis topic also quickly we have done, and damar. Yes, people, welcome back after that short break. So next we'll be starting with the revision of next topic, which is leverages. Leverage is a very simple topic. It only measures this, how one financial variable affects another financial variable. How one financial variable influences or affects another financial variable is all about leverage ka study. So which financial variable ka influence are we talking about? We are trying to study how due to fixed cost, due to fixed expense, how your EBIT and EPS will change. Due to fixed cost, how your EBIT and EPS will change is all about leverage ka study. So if fixed asset is not there, if fixed itself is not there, then the leverage ka whole topic will be cut off. Okay, leverage analysis will only come into picture if the company has one and only one component called fixed cost. there are three types of leverages which we have to remember and apply it in this particular topic. That is operating leverage, financial leverage, and combined leverage. Before going into the formulas and formats of those leverages, let's understand. This is what I used to tell in our regular class as well. Let's say last year, I've assumed the numbers. We know the table, no? One you can either call sales minus COGS and GP. There is another format through which you can present your income statement. One is sales minus variable cost is contribution. Contribution less fixed operating cost will give you EBIT. From EBIT, if you deduct interest, you're going to get EBIT. Then deduct tax. Accordingly, you're going to get EAT. In these problems, preference dividend will not be there. So EAT itself will become your EAT. So I've assumed some random numbers. Let's say last year sales is 10,000. Let's say last year ka variable cost is 70% of sales. So 10,000 ka 70% is how much? 7,000. So how much is contribution? 10,000 minus 7,000, which is 3,000. Okay. Fixed operating cost, I've assumed it to be 2,000. So how much are you going to get it as EBIT? 1,000. Interest, I've assumed this to be 500. That means how much is your earnings before tax? 500. Tax rate is 30%. So 500 ka 30% is 150. So your EAT or EASH is 350. Number of shares, I've assumed it to be 100. That gives you your EPS of 3.5. This is your basic data which some assume, some calculated, correct? Now let's assume that compared to last year, this year sales has increased by 10%. If sales has increased by 10%, what will happen? If the sales was last year was 10,000, means current year it will be 10% more. So it will become 11,000, correct? And how do you get variable cost? 70% of sales. So 11,000 ka 70% is how much? 7,700. Sales minus variable cost is how much? What? Contribution. So contribution, you got it to be 3,300. So compare. Sales increased by how much, sir? 10,000. What about variable cost? From 7,000 it became 7,700. That means this also indirectly increased by how much? 10% only. If you want, you can prove 7,000 plus 10% you do in your calculator. What number you will get? 7,700 itself. What was contribution in the last year? 3,000. How much is it in this year? 3,300. So contribution also increased by 10%. That means what am I indirectly trying to say? All these go hand in hand. If this increases by 10, all the other three will also increase by 10% itself. Okay, now let's go for the other things. How much was fixed operating cost in the last year? 2,000. Sir, it is fixed cost. That means will it change? Just because sales increased by 10%, will fixed cost in the current year change or it is constant? That means this in the current year also is 2,000. So how much is EBIT now? 1,300. So how much was EBIT last year? 1,000. How much is it in the current year? 1,300. Calculate the increase percentage. How do you calculate increase percentage? 1,000 became 1,300 means what is the change amount? 300 divided by original amount. What is the original amount? 1,000 into 100 you do. How much are you getting? 30%. Yes or no? That means sales increased just by 10%, but EBIT increased by 30%. Okay, keep that in mind. Interest is a fixed cost. Will it change? No. That means this year also it will be 500. So what is your EBT? 500 last year. This year it has become 800. Sir, 500 has become 800. So how much has it increased by? 300. So that means the change amount is 300 divided by original amount is how much? 500 into 100 if you do. Increase percentage is 60%. So EBT has increased by 60%. Tax same 30% you have calculated. Each 350 has become 560. That means this also has increased by 60%. EPS from 3.5 has become 5.6. So this also has increased by 60%. Okay. So if I give you this data, you will be able to calculate from the beginning till top all these numbers, correct? Leverage is trying to calculate the same thing as one shortcut. Leverage is trying to calculate the same thing as one shortcut. What is the first leverage we discussed? Operating leverage. So operating leverage. Leverage analysis is a study of two financial variables. How one financial variable affects another financial variable. Operating leverage is trying to analyze the relationship between sales and EBIT. Operating leverage is trying to analyze this relationship between sales and EBIT. Okay. So how do you get operating leverage? Simple. What is the one easy trick to remember operating leverage ka formula is take one number above your fixed cost. Take now one number below fixed cost. What is the first fixed cost you got? Fixed operating cost. What is one number above that? Contribution. What is one number below that? EBIT. That goes your operating leverage ka formula. So what is operating leverage? Contribution divided by EBIT. Or in our class purpose, I used to say OLC. Not ALC, OLC. OLCE. Operating O for OL for operating leverage, C for contribution, E for EBIT. Okay, now do it, sir. Contribution divided by EBIT, you do. How much is that? 3000 divided by 1000. How much are you getting? 3. Okay, so you're getting operating leverage to be 3. What operating leverage is trying to study is about what and what it is trying to establish connection? Sales and EBIT. So what operating leverage ka final synopsis is, if operating leverage is 3, that means for 1% change in or 1% increase in sales will lead to 3 times. If operating leverage is 3, then it will lead to 3 times increase in EBIT. For 1% change in sales, there will be 3 times or 3% change in EBIT. That change could be increase or it could be decrease. That is what operating leverage is trying to calculate. And it works also. Check. How much is operating leverage we got? 3. How much did sales increase by? Sales increased by 10%. So if sales has increased by 10%, means as per operating leverage, what should happen to EBIT? EBIT will not increase by 10%. Operating leverage is 3. So it will increase by thrice of that. That means this will be what, sir? This will increase by 30%. As per operating leverage analysis. Correct? So in reality also what happened? Sales increased by 10%. EBIT also increased by 30%. I mean same number we are able to calculate as one shortcut formula. Instead of putting up the whole P&L, you will be able to get the data in a quick way. That's your synopsis. Okay, na sir? Then, operating leverage you can find out through another formula also. That we call it as the degree of operating leverage. Degree of operating leverage. What is operating leverage trying to measure? Sales and EBIT. Okay, so degree of operating leverage is given by the formula. Same 2 components. Percentage change in EBIT divided by percentage change in sales. Percentage change in EBIT divided by percentage change in sales. How much is the percentage change in EBIT? 30%. Okay. How much is the percentage change in sales? 10%. So 30% divided by 10%. In fact, already done here. 30% divided by 10% you do. How much are you getting? 3. Whether you go for formula number 1 or formula number 2, answer will be same. So when to go for what formula? Sir, if you want to find out percentage change you can only find out when you have one set of data or 2 sets of data. 2 sets of data. If they give you current year data, last year data, then you can follow degree of operating leverage for the formula. If they give you only 1 year data, then follow normal operating leverage data. Is that okay? Or if they directly give you formula, or if they directly give you percentage, if they directly give you percentage change, then you can go for degree of operating leverage. Is that okay, sir? So it's don't be misled by the term operating leverage and degree of operating leverage. It is one and the same. Just another way to calculate the same answer. That's all it is. Okay, sir. So operating leverage measures something called business risk. It measures business risk because the sales or variable cost, all these are whose decision? Business ka decision. At what price will they sell? What product will they sell? What should be the cost of the product? All that is a business decision that you take, right? So operating leverage, we say, denotes business risk in one line. Okay. All right. Next, after operating leverage, what is the next one we have, sir? Financial leverage. So financial leverage measures financial risk. Financial leverage measures financial risk. So financial leverage starts when operating leverage is stopped. Operating leverage measured what and all? Sales and EBIT. It stopped at EBIT. So financial leverage will pick from there. So financial leverage measures the relationship between EBIT and bottommost number. What is the bottommost number? EPS. So financial leverage is trying to measure the relationship between EBIT and EPS. Is that okay? Again, one easy way to construct financial leverage ka formula is, now one fixed cost is already over. Identify what is the next fixed cost? Interest. Take one number above this fixed cost. Take one number below this fixed cost. So what is the formula for financial leverage? EBIT divided by EBT. That's all. EBIT upon EBT. So calculate what is EBIT of the last year, sir? 1000. What is EBT, sir? 500. So 1000 divided by 500 euro. How much are you getting? 2. Correct? So that means financial leverage is 2. Okay. Financial leverage measures what to what risk? Measures the relationship between EBIT and EPS. Now check. EBIT increased by how much percentage? As per your formula, EBIT increased by 30%. So financial leverage, we got it to be 2. If EBIT increases by 30%, then what will happen to EPS? EPS also will increase by 30% or twice of that? Twice. Why twice? Because financial leverage is twice, like that. So that means EPS will increase by 30% into 2, which will be what, sir? EPS will increase by 60%. That is as per formula. Is that what happened? Yes, that's what happened. So same, it's just a shortcut way of calculating a lot sooner things. Is that fine? Now for operating leverage, we had two components. One is operating leverage, another one is degree of operating leverage. Even for financial leverage also, there is another formula, which we call it as the degree of financial leverage. When you're confused, always go for this. What is financial leverage trying to measure? Relationship between EBIT and EPS. So the formula of degree of financial leverage is percentage change in EPS divided by percentage change in EBIT. That's all is your degree of financial leverage. So when to go for what formula? If they give you 1 year data, normal financial leverage ka formula, that is EBIT divided by EBT. If they give you 2 years data, then you use degree of financial leverage for a formula. Or if they give you percentage change itself, then you go for degree of financial leverage. And financial leverage measures what risk? Financial risk. Easy. And the last one is combined leverage. Combined leverage takes into account total risk. It considers total risk. Combined leverage is simply given by the formula operating leverage multiplied by financial leverage. If you want it as, you can bring in formula, because how do you get operating leverage? Contribution divided by EBIT. How do you get financial leverage? EBIT divided by EBT. So EBIT will get struck off. So what remains? Contribution divided by EBIT. Don't use this formula. Use the other one only. A lot easier. No? So combined leverage is nothing but operating leverage multiplied by financial leverage. So combined leverage is trying to measure the relationship between topmost number and bottommost number. What is the topmost number? Sales. Bottommost number? Say EPS. So operating leverage, combined leverage measures basically a relationship between sales and EPS. That's all is combined leverage ka whole drama. Yes, sir. Okay. Next is, there is another way. Normally they'll play around this. Sometimes they jadify or bring in some costing concept also. What is that costing concept is? Sir, they will give you something called margin of safety. They will give something called margin of safety. If they give you margin of safety, you can also find out operating leverage. I proved it to you with scenario in regular class. Now I'll just stick to formula. Operating leverage is given by what, sir? 1 divided by margin of safety. If you do 1 divided by margin of safety, that itself will lead to operating leverage. Okay. So how do you find out margin of safety? For that you need a break-even point. That means how do you get break-even point? That you need to know whether it's break-even point in units or in value. Units you don't need, but just I brought in. So if you want to find out break-even point in, first of all, what does break-even point mean? Break-even point means no profit, no loss. So if you want break-even point in units, that's given by fixed cost divided by contribution per unit. Total fixed cost divided by contribution per unit. If you do, you're going to get break-even point in units. Suppose the same break-even point, if you want it in value, then fixed cost divided by PV ratio, as in price volume ratio. So how do you get PV ratio now? It's nothing but contribution percentage on sale. That is what we call it as price volume ratio. So PV ratio is given by the formula contribution upon sales into 100. So do that, you're going to get break-even point in value. We don't want break-even point. We want margin of safety. Now let's say sales is 1,50,000. Sales is 1,50,000. Break-even point is 1 lakh. Not in units, but in value. Sir, break-even point means the company will start making profit or no profit, no loss. That means still 1 lakh, will the company make any profit or it is recovery of cost? That means, can I say this is cost zone? Break-even point deals with cost recovery zone. So in 1,50,000, 1 lakh will go towards only cost recovery. That means profit the company will start making after 1 lakh. So what is the difference between 1,50,000 and 1,50,000? That only we refer to as what? Margin of safety. Basically, margin of safety means it represents your profit zone. Break-even point means it is in your recovery of cost zone. Margin of safety means profit zone. So how do you calculate margin of safety? Total sales minus break-even point ka sales. Yes. Now the same margin of safety, if I ask you to express it in percentage, how do you get GP percentage? GP divided by sales into 100. If I ask you margin of safety ka percentage, margin of safety divided by sales into 100. Now reconstruct the whole formula for me. How do you calculate margin of safety? Actual sales minus break-even point sales divided by actual sales or total sales into 100. That is all is your margin of safety ka formula. If you want to express it in percentage, multiply by 100. If you want to express as it is, don't multiply by 100. Is that okay, sir? That's all is your margin of safety ka draw. But whole problem is they'll not ask you all this. They will directly give you margin of safety in the problem. If they give you margin of safety, then operating leverage is given by the formula 1 upon or 1 divided by margin of safety. That they have enough asked. Sometimes they'll also give it in percentage. If break-even point is 80%, then margin of safety will be 20%. Because we know that total sales is always 100%. No? So break-even point represents 80% means up to 80% we are recovering only cost. We'll start making profit only on the balance 20%. So sometimes they play around with percentage also. Some question has been tested like this. So keep this also in mind. Okay. That's all you need to remember as far as leverage is concerned. Hardly 3 to 4 components. And aram se you can do the remaining questions. So quick review and then we'll go to the questions. So leverage analysis deals with what, sir? Influence of one financial variable over another financial variable. Which variable are we talking about here? Fixed cost. What are the 3 types of leverages? Operating leverage, financial leverage, combined leverage. Okay. How do you calculate operating leverage? Contribution divided by EBIT. That's one. Or another way, what is operating leverage trying to measure? The relationship between sales and EBIT. So if you want, you can find out degree of operating leverage as percentage change in EBIT divided by percentage change in sales. Or also operating leverage is given by the formula 1 divided by margin of safety. Okay. Operating leverage measures business risk. Next is financial leverage, which measures finance risk, given by the formula EBIT divided by EBT. If you forget about the formula, visualize income statement or write down income statement in your paper. It's okay. Later on, you can cut it off. It's fine. Take one number above fixed cost, one number below fixed cost. There goes your formula. In case you forget it, it's fine. Or you can also find out degree of financial leverage through another way, which is what does financial leverage first of all try to measure? The relationship between EBIT and EPS. So financial leverage is given by the formula percentage change in EPS divided by percentage change in EBIT. Okay. The last one is combined leverage, which measures total risk, which is nothing but operating leverage multiplied by financial leverage. So combined leverage basically measures the relationship between sales and EPS. Okay. And if you want margin of safety, how do you find out margin of safety? But before that, we need break-even point. If you want break-even point in units, it is fixed cost upon contribution per unit. If you want it in value, fixed cost divided by PV ratio. And how do you get PV ratio? Contribution upon sales into 100. And how do you get margin of safety? Actual sales minus break-even point sales. That will give you margin of safety ka value. If you want it in percentage, what do you do? Divided by actual sales into 100 in percentage, or don't multiply by 100 if you want it as is. Okay. So now quickly can we go ahead and apply it in few questions? From the, again, sir, most probably what they'll do in my opinion is, now anyway, I think earlier the FM used to be for 60 marks and Eco used to be for 40. Now they made it as 50. So that means the FM portion has got reduced. So I personally feel now they'll focus more towards combining the topics. Because we have almost what, sir, about 9 topics we have. In that 2 is theory, it's fine. So practically we have 7 topics. In terms of numerically or value driven topics are 7. But maximum question is what? Hardly anything. Because in that almost 30% is MCQ again. So in 50 marks, almost 15 marks is MCQ. Remaining is only 35 marks. So with 35 marks, you have so many topics, right? So probably what I feel going forward is they'll combine the topics and start framing the questions. Like leverage and ratio analysis will go a lot of hand in hand. Aram se leverage and ratio can be combined here and there. So I mean, combination, no extra concepts, just that they'll phrase a question with that and this. So don't freak out. Whatever we are learning it as individually, they've just collated. So I think this is one such question. You can look at it. I'm not sure. From the following financial data of company A and B, prepare their income statement. Okay. Again, fill in the blanks. Wala question. All these are. Variable cost is 88,000. The variable cost is for B is 50% of sales. Fixed cost is this. Interest expense, financial leverage they've given, margin of safety they've given. The moment you see margin of safety, what you click? You can find out operating leverage as what? 1 divided by margin of safety. Income tax rate they've given, EBIT they've given. One again problem here with many students face here is, sir, what to start with or how do I get that flow? So one easy trick I always say in comes to these topics is first always drop. I mean, see here we know that they've given margin of safety means easily you can find out operating leverage. So better way to establish the connection is anyway they've asked income statement. First to draw income statement ka format, whatever data they have given, first plug that. That will give you a good idea. Like here, see, I've given a format over here. This is for company A and company B. Whatever data they have given, I only plugged in that, not full value. So, have they given sales? No. But have they given variable cost? For company A, they have given variable cost, which is what, sir? 88,000. Whatever I've given, I've directly written. Would that be okay with you? Then they have given fixed operating cost. Then they have given interest. This is what they've given for company A. For company B, no, sir, they told this way. Variable cost is 50% of sales. Now, they say moment the 50%. Suppose sales is 100 rupees. Okay, then what will be variable cost? 100 ka 50%, which is what, sir? 50. That means what will be contribution? 50. Since variable cost is 50% of sales, contribution also will be 50%. That means these two numbers will differ or it will be same. If one number, if you find out, other number also it will be same. That's a trick. That's one. Okay, so from this we can make out all this. Okay, now we'll see. For company A, let's align, see what and all they've ticked off. They've given financial leverage. So how do you find out financial leverage? Financial leverage is basically EBIT divided by EBT. Correct? Check in the question. Have they given EBIT or EBT? No, both are question marks. No problem. Do you know interest? Yeah. Sir, tell me, how do you get EBT? How in equation, how do you get EBT? Can I write EBT as EBIT minus interest? From EBIT, if you deduct interest, then only you're going to get EBT, no? So they have given financial leverage, correct? So financial leverage is how much they told, sir? 5:1. 5:1 means indirectly they're telling financial leverage is 5. EBIT, I'll keep it as it is. Instead of, I think I wrote both same. So this is what? EBIT divided by EBT, correct? Yes. Instead of EBT, can I rephrase this equation as EBIT minus interest? Correct? No, earnings before tax is nothing but what, sir? Earnings before tax is nothing but EBIT minus interest. So I've just rephrased this equation this way. So now, do you know EBIT? No. But do I know interest? For company A, do I know interest? Yes, the interest is given to be 14,000. So plug in the numbers now. This is 14. So cross multiply. This 5 into EBIT will give you 5 times EBIT. 14 5s are 70. So this is 70k is equal to EBIT. Send this EBIT to this side. So 5 minus EBIT will become 4 times. EBIT is equal to 70. Therefore, EBIT will be equal to 70,000 divided by 4, which will be how much? 17,000. You got your EBIT. That's all. So now plug in these numbers. So this is 17,500. If this is 17,500 means obviously EBT will be 3,500. Tax rate is 30%. No. So calculate 3,500 ka 30%. 1050. That will give us earnings after tax to be 2450. So I know EBIT, I know fixed operating cost means what will be contribution? These two addition, no. So what is these two addition? 44,000. This is 44,000. This is contribution is 88,000 means this sales minus VC only is contribution. No? That means what will be your sales? 1,32,000. The whole thing got filled out. That's one. So one, if you properly identify the whole things, it's like domino effect. One card fell means all card will go on fall. That's all is all about here. Now this is for company A, it is over. Next we have to do it for company B. Company B, what have they linked? What data they have given? They have given margin of safety. We know that operating leverage is nothing but 1 upon margin of safety. So how much is operating leverage? 1 divided by 0.25. So how much is operating leverage? 4. Operating leverage is 4. So how do you get operating leverage? Contribution divided by EBIT. Any number you know? Yes, we know EBIT. Correct? You know EBIT. So this is 4. This is 14,000. Correct? That means what will be your contribution? 14 4s are 56. So contribution is 56,000. So automatically one number if you know. So contribution is 56,000. So what will be your fixed operating cost then? This is 42,000. So what is this now? 14,000 minus 11,000 is how much? 3,000. This is 900. So this will become 2,100. And they told in the problem variable cost is 50%. That means contribution and variable cost will be same. So this will also be 56,000. So this will become 1 lakh. That's all this. This will be like not every question will be tricky. 1 or 2 definitely will be tricky. Go with that attitude. But majority of them will be around this. The only trick is to solve within time. So time speed has to be extremely good, people. It doesn't matter for what paper. 1 or 2 papers according to me will be definitely on the lengthier side. Okay, don't go on cribbing later on that I didn't have time to complete paper and all. It is expected. Okay. So do practice some questions to make sure that you are able to solve everything within the necessary time. Excuse me. Next, this is done. I think this was MTP question. It come from a case study. They've just give a case study and they give some leverage ka one case they brought in. There's an interesting question. Check this. If EBIT, simple only, but maybe a little difficult to, on a quick read, you may not be able to establish that connection. If EBIT increases by 6%, net profit, sir, when they use a net profit, then what we mean is the PAT, meaning profit after tax. Net profit increases by 6.9%. Sales increases by 6%, net profit will increase by 24%. Like that, they've given some data. They're asking you financial leverage is how much? Financial leverage is how much? Okay. Now your mind will say what? Financial leverage is basically, the moment, yeah, they've given percentage means obviously you will apply degree of financial leverage. So degree of financial leverage ka what is formula? What does financial leverage trying to measure? Percentage change in EPS divided by percentage change in EBIT. EBIT we already know, which is 6%. So denominator is already 6, that we know. But what is numerator? Percentage change in EPS. We need percentage change in EPS. Did they give you EPS ka percentage increase or net profit ka? Net profit ka. That means what should I take? You should take same only. Why? That's the reason I gave you first case study. Check. Here check how much is profit after tax. How much profit after tax increased by? 60%. How much each increased by? 60%. How much EPS increased by? 60%. That means all this will go what, sir? Hand in hand. So in this problem, they have not given EPS ka increase. Directly they have given you what? Earnings after tax ka increase. But those are all what, sir? Same. Is that okay? If profit after tax is increased by, in this question, coming back to this question, if profit after tax is increased by 6.9% means EPS also has increased by 6.9% only. Okay, so that means you can reconstruct this equation like this. Percentage change in EPS divided by percentage change in EBIT is a usual formula. If that data is not given, you can also substitute EPS with the each or net profit also. Okay, so how much is each or net profit here? 6.9. So do this. 6.9 divided by 6 is how much you're getting? 1.15. So financial leverage is D for daily 1.15. That way this question is little better, little good. Because yeah, on quick read, you'll not be able to figure it out. That's the reason I thought. I think this was asked in the MTP this time. One more, we'll quickly run it by. Company had the following balance sheet as on 31st March 2021. Equity share capital is 10 rupees per share. All the numbers are in crores. So total value of equity share capital is 5 crores. Each share ka face value is 10. That means how many shares, sir? 50 lakh shares this particular company has. Reserves and surplus is there. 15% debentures is there. That's all right. Additional information is given as follows. Fixed cost per annum excluding interest is 4 crore. Excluding interest, fixed cost only, we call it as fixed operating cost. That is 4 crore. Variable operating cost ratio is 65%. That means indirectly they're telling you variable cost is 65% of sales. Total asset turnover ratio is 2.5. This is a click. Do you know total assets? Yeah. Sir, how do you get total asset turnover ratio? Total asset turnover ratio is nothing but your sales divided by average assets here. Can we use average information? No, because they have given only one information. That means what will we take? Divided by total assets. Sales we don't know. What is total asset turnover ratio? 2.5. This we don't know. Sales is as it is. Total assets, how much is in the balance sheet? 20. So therefore, what is your sales? Sales is 50 crores. Okay. All right. Next, what have they asked? In fact, look at the requirement. You need to calculate EPS and the 3 leverages. For EPS, we need the whole data. Even for leverages, we need whole data. So first we'll start with what, sir? Sales. How much is sales given here? Sales is, or we only just now found out sales to be 50 crore. Do you know variable cost? Yeah. Variable cost they told in the problem is 65% of sales. 50 crore ka 65% you calculate. How much is that? 32.5. So sales minus variable cost is what, sir? Contribution. From contribution, what do? Deduct fixed operating cost. It is given in the problem. How much is a fixed operating cost given in the question? Fixed operating cost is 4 crores. So deduct that. What are you going to get? EBIT. So this we got. Deduct the interest. Interest, do you know that? Do we have debentures? Yeah. What is the debenture ka value? 10 crore. What percentage debentures are these? 15%. So 10 crore ka 15% you do. How much are you going to get? 1.5 crore. So earnings before taxes. This much tax you do, or I'm saying you'll get the each. Correct? Now it's a simple fund. How do you calculate EPS? Each divided by number of equity shares. Each is 8.5 crores. Number of equity shares is 50 lakh. So EPS is 16.8. Next is operating leverage. How do you find operating leverage? Contribution divided by EBIT. 17.5 divided by 13.5. That is your number. Financial leverage. EBIT divided by EBIT. Combined leverage is these two ka multiplication. Okay. Leverage ka question, most probably they'll play around on the safe zone. Okay. So that's all you need to keep that in mind. Okay. So yeah, with this operating leverage ka revision also dumb. Damar. Focus more towards remembering everything, okay? Especially that's what matters in FMCA terminologies. In the two chapters, they can bring little complex question. One is your investment decision, another one could be your working capital management. There, you may get some tricky question. That I'm planning to do tomorrow with lot more little bigger question. These are all pretty straightforward topics. The main things you need to do it is, remember, is the formats and formula. Okay, most probably these chapter question will be straightforward. Don't lose out marks on this. Okay, all right. So we'll take up the next chapter, dividend decisions. I think we are on time, so that's good. Good to know. I thought I underestimated, so apologies. So it is okay. All right. So next chapter we'll be revising is our dividend decisions. Okay. So dividend decisions ka whole funda is how much dividend should we pay and how often should we pay so that the price of the share is maximized. That's all is the overview of a dividend wala chapter. Okay. Here also we have some Mahanubhavas giving their own theories. We have two types of theories, that is relevance theory, irrelevance theory. What irrelevance theory? Same old Guruji, which is yum yum. Modi Giuliani Miller approach. So our theory ka argument is pretty much the same. Whether you pay dividend or don't pay dividend, value or the price of the shares will be same. Okay, no, whatever, the price will not get affected by the dividend policy is what ka approach is all about. Okay, so approach may you'll have to remember two things. One is the price, P0. P0 as in current market price. Current market price is given with the formula P1 plus D1 divided by 1 plus cost of equity. Okay, P0 is equal to P1 plus D1 whole thing divided by 1 plus cost of equity. That is one. Second, value of the firm is given by the formula N plus delta N multiplied by P1 minus investment plus earnings whole thing divided by 1 plus cost of equity. All right, yeah, that's, I know initially, yes, because these things and all, no, if you don't revise it often, you tend to forget it. That's the reason the easy way to do it is, if you feel some formulas, it could happen. One or two formulas you may feel no matter how many times you are revising and writing, you are still forgetting. That particular formula, always write it in one book or one sheet till the last moment, have one go through that. Okay. In fact, one practice I used to do was one or two things. I think probably I don't remember which one. Probably costing. I don't remember what I think, or maybe in income tax. There was always one section I used to always forget. So no matter how many times I used to study or this thing, I used to forget. What I used to do was, the moment I used to get answer booklet, no, on one side I used to write it off. I was so scared that I forget it. Whether they asked that question or is irrelevant. First I used to write it off, because sometimes what happens, no, people, no matter what we say, last minute, ideally you should not study anything. Especially in last 2-3 days, no, are meant only to revise. But we know that students being students, they would have missed out lot of things. Last 2-3 days only is bumper days for them. Okay, everything they try to accumulate on that day only. That means when you're trying to bombard your mind with so much data, it happens that what happens, sometimes you juggle the things. Instead of this formula, no, you'll write something else. Like that, it could happen. So this one trick I used to do is, till the last moment, I used to have that in one piece of paper, review it. Still, if I feel something was wrong, I used to write it off, not in the question paper. In the solution paper. Don't write anything on the question paper, because now it's an MCQ driven pattern. Okay, so small tick also can be considered as a cheating. So please don't. Even I know I'm now even scared to tell you to underline. Previously I used to tell no underline like crazy and all. No, don't underline. Yeah, because we don't know what could be considered as a cheating and all that stuff. Because ideally I'm thinking MCQ ka booklet will be different and the normal ka booklet will be different is what I'm thinking, because I feel MCQs will be corrected by the automated machines and OMR sheets basically, yeah. And the descriptive questions probably we need a human intervention. It's what I am thinking, but we still need to wait. Let one attempt pass by, then we will get to know. I'll ask you only. They give you 2, 1. You tell, next batch I will tell that. Okay? Yeah. Okay. Can I come back to this now? Okay. Sir, N here stands for what? Number of existing shares. Delta N stands for number of new shares issued. P1 stands for P0 is current market price. P1 is expected future price. I here for investment. E for total earnings. Okay. So what is this delta N ka whole funda is? Now let's say company has earned about 10 lakh rupees and they are planning to give a dividend of 3 lakh rupees. So how much money is available with them? They earned 10 lakh. They are planning to give how much dividend? 3 lakh. So how much money is available? 7 lakh. But company wants, let's say 15 lakh for further investment. They want to do a new project that will cost how much? That investment requirement is 15 lakh. Available is only how much, sir? 7 lakh. Requirement is how much? 15 lakh. So we have enough money or we have shortage? Shortage. How much shortage we have? 8 lakh. If we have shortage, what to do? Company has to issue new shares. That new shares only we call it as delta N. That's all. Okay. So that's what we need to plug in this particular bucket. And approach uses some assumption that information is freely available to everybody. Whatever information you want to know about whatever company, they're saying it is freely available. There is no tax or there is no flotation cost. All these in today's environment is outdated. Now you want to know Reliance ka information. Can you call up Mukesh Ambani and say, hey, macha, tell da? I own 1 share of Reliance. I want to know. Yeah, can you tell? No. Right? But suppose another person, or if Mukesh Ambani wants to know about Reliance ka shares, can he ask? Or if let's say there is a big investor. Earlier we had one big bull of Indian market. We have no more there. Rakesh Jhunjhunwala. Right? If Rakesh Jhunjhunwala wanted to know about some company ka information, he can directly call up that company ka CEO, because big investor. He will have a extra shot. But you and I, can we call up? First of all, we will not have number only. Yeah, if at all we get number also, going the only. Correct? So like that. So all these assumptions may be valid many years ago. Now and all these are waste. But still we have these are all there. Wonderful questions, wonderful marks wala questions. So for marks we have to completely do it. So let's do a thing. Let's directly apply this often straightforward question. Thing again, it's asked in RTP question only. Let's take it up. MCO Limited has a paid up share capital of 10 lakh. Face value is 10 each. Total share capital is 10 lakh. Each share ka face value is how much? 10 rupees. So how much is the number of shares, sir? 10 lakh divided by 10. The company currently has about 1 lakh shares. So existing shares only we denoted by the symbol N. So the number of existing shares of this company is 1 lakh. Current market price is 20. Current market price means P1 or P0. P0. P1 is expected future price. P0 is current market price. They have given current market price. So this 20 rupees is P0. The board of directors have an agenda of a meeting to pay a dividend of 25% to the shareholder. Did they use the word dividend payout ratio? They only said they have an agenda to pay a dividend at the rate of 25%. So if they don't use the word dividend payout, the 25% you will always calculate on the face value. How much is face value of each share? 10 rupees. How much dividend they want to give? 25%. So 10 ka 25% is how much? 2.5 rupees. That's what dividend they want to pay. Okay. The company expects to have a net income of 5,20,000. That is your earnings. And the capital expenditure for the next financial year is 7,50,000. Capital expenditure means the future investment required. That is how much, sir? 7.5 lakh. Company's desired rate of return is 15%. This is nothing but your cost of equity. So now under approach, you need to determine the value of the company when the company does not pay the dividend, and second case company pays the dividend. Theory is relevance theory or irrelevance theory? Irrelevance theory. What is irrelevance theory ka argument? Whether you pay dividend or you don't pay dividend, value should be same. That's all is the whole funda. So now the point is we have two formula. Value of the firm is given by one formula. But to find out value of the firm, we want P1. We want P1. Do you know P1 or we have P0? You know, that means the first formula is usually plugged in to find out the value of P1. So what is our first formula? P0 is equal to P1 plus D1 divided by 1 per cost of equity. Okay, so let's plug in that. First case we will solve. So when the dividend is not paid. So first formula to find out, first working note is to find out P1. So that's given by the formula P0 is equal to P1 plus D1 divided by 1 plus cost of equity. How much is P0? 20. Do you know P1 or that is only the thing we are trying to find? That is what we're going to get from this particular working note. D1. Sir, in this case, a dividend is paid or not paid? Not paid. That means the D1 will be how much? 0. Cost of equity, they've only told it to be 15%. So plug in, how much are you going to get? P is equal, or P1 is equal to 23 rupees. This is the current market price or expected price? Expected price. Next thing is we need to know whether we have to issue new shares because of any shortage. That means we are trying to calculate delta N. Sir, how much is the earnings of the company? Earnings expected is how much? 5,20,000. Okay. Earnings is 5,20,000. In the first case, are we expecting to pay any dividend? The case is what? Dividend not paid. That means the dividend expected to be paid is 0. So how much earnings is available with us? 5,20,000. So entire 520 is available. But how much you needed for your investment? 7,50,000. You have 520, but you need 750. That means do you have shortage? Now we have a shortage of how much? 2,30,000. Okay, sir. So how do you make good of this shortage, or what are you going to do about this shortage? For 2,30,000, you have to issue new shares. Are you going to issue it immediately or in future? Future. That means you should not take P0. We should take P1. Okay. So that means how do you get delta N? The shortage divided by P1. How much is P1? Just now we got 23. So 2,30,000 divided by 23. You plug in. You'll get it in decimals. Don't work with the decimals. It will get nullified. So when you're getting this odd numbers, keep it as it is. Don't put it in decimals. Is it okay? Then how do you find out value of the firm, sir? Value of the firm is given by the formula N plus delta N into P1 minus investment plus earnings divided by 1 plus cost of equity. Okay. Whenever we are calling out formula, if you don't want to say it out loud, that is fine. Repeat it in your mind. The more your things, the more you write, the more you memorize, you tend to remember it longer. All these are very, very key in FM terminology. I mean, it's required. So how much is N, sir? What is the existing number of shares? We already found out. 1 lakh. So 1 lakh is N plus delta N. Did we already get delta N? So take it as it is. 2,30,000 divided by 23. Multiplied by what? P1. P1 is how much? 23. I asked you to keep this as it is because this 23, that 23 will get nullified. So you will not get any decimals. Minus your investment. How much is your investment? 750. Plus earnings. How much is your earnings? 5,20,000. Whole thing divided by 1 plus cost of equity. If you solve this, you're going to get value of the firm to be 20 lakh rupees. None. This is the value of the firm when the dividend is not paid. Next is a case when the dividend is paid out. When the dividend is paid, what will happen? Let's work it out. Same thing. First, we have to find out P1. So how do you find that out? P0 is equal to P1 plus D1 whole thing divided by 1 plus cost of equity. P0 is current market price, which is given in the question to be 20. P1 we don't know. Dividend. Now can I take dividend to be 0? No. This is what case? Dividend. This is actually ulta case. This is a dividend paid. It should be my bad. This is dividend paid wala scenario. So how much dividend you're planning to give, sir? 25%. What is the face value of each share? 10. So what is the dividend per share? 10 ka 25% dividend per share is 2.5 rupees. Because all this we want it on a per share basis. We don't want total amount. Because this is what, sir? 20 is the total value or 1 share ka value? 1 share ka value. So you should always take a dividend per share here. So what is the dividend on 1 share? 2.5. Cost of equity, they've only given it to be 15%. So if you work out this, you're going to get P1 to be 20.5. Same. We have to check whether there is any shortage. If there is any shortage, we will come across delta N. So first, how much is the earnings? Same, 5,20,000. How much dividend are you planning to give on 1 share? 2.5. How many shares does the company have? 1 lakh shares. On 1 share, 2.5 rupees. On 1 lakh shares, how much? 1 lakh into 2.5, total dividend expected to be paid is 2.5 lakh. So in 5,20,000, 2.5 lakh dividend will be paid out. So how much amount is available? 2,70,000 only is available for investment. But how much is the investment required? 750. So do we have shortage? Yeah, we need 750, but we have only 270. So we have a shortage of 4,80,000. What are you going to do about this shortage? Raise that shortage by issuing new equity shares. So for 4,80,000, we need to raise, and price of one new equity shares is expected to be 20.5. Should we have to work it out in decimals or keep it as it is? Keep it as it is. Next, we can find out the value of the firm given by the same thing, n plus delta n into P1 minus investment plus earnings, whole thing divided by 1 plus cost of equity. N is number of equity shares, which is 1 lakh. Delta n, just now we got it to be 4,80,000 divided by 20.5 into P1, same 20.5 minus investment 750 plus earnings 520. Plug in whole thing divided by cost of equity. If you plug, the answer will be still 20 lakh. In the previous case also you got 20. Now also you got 20. That's what the whole point about theory ka approach. Value of the firm will not change based on your dividend policy. This is one popular question that can come from this particular aspect or this particular chapter. Okay. So this is about irrelevance theory. Next will be about relevance theory. Now relevance theory ka argument is no. Dividend policies are important. By affecting your dividend policies or by changing your dividend policies, price of the share can be increased or price of the shares could be decreased. So under this relevance theory, two Mahanubhavas have given their viewpoint. One is the Walter and the other one is Gordon. First we'll go over Walter's model. So as per Walter's model, the price of the share P0 is given by the formula D plus R into E minus D divided by K, whole thing divided by cost of equity. I used to tell you in the class that you can remember it as the red K. The red K. D for dividend per share. R for rate of return. E for earnings per share. D is dividend per share. Divided by cost of equity. Whole thing again divided by cost of equity. So if you do this, you can, I remember it like this. If you feel, you can remember it like that. The red K. This is as per your Walter's model. Walter also has the same assumption as in the approach. Information are freely available. There is no tax as well as there is no flotation cost. This is about Walter. Walter and Gordon model are more popular from this chapter than approach. Okay, it's come a lot more often. So let's go for Walter ka one question immediately. Then we'll go for the other one maybe. This is an MTP question. This attempt ka only. Following figures have been extracted from the annual report of Z Limited. They have given net profit. I told whenever they give you net profit in the problem, it is nothing but your profit after tax, PAT. Outstanding preference shares is 200 lakhs. And outstanding what percentage preference shares? 12%. Why have they given 12%? For us to calculate preference dividend. Because what they have given in the problem is not EISH. What they have given is PAT. How do you get EISH? From profit after tax, you need to deduct preference dividend. Number of equity shares is 2 lakh. Rate of return on investment, which is nothing but R, is 22%. Cost of equity is 15%. Compute the approximate dividend payout ratios. Sir, whenever they use over dividend payout ratio, you will apply it on face value or an EPS. You have to apply it on EPS because payout ratio is expressed on EPS. What percentage of EPS is given as dividend? That's what dividend payout ratio signifies. Okay. So compute the approximate dividend payout ratio so as to keep the share price at 120 using Walter's model. Oh, so normally using Walter's model, we find out share price. Here, they only given share price. They are saying what should be the dividend payout ratio. To find out dividend payout ratio, we need two things. What are those? One, you need dividend per share, missing, and you need earnings per share, missing, but we can calculate. So first working note is to calculate what's a EPS. How do you get EPS? EISH divided by number of equity shares. Have they given EISH or they've given PAT? So they have given PAT. How much is PAT? 54 lakhs. From PAT, deduct the preference dividend. How much is the preference share capital? 200 lakh. What percentage preference shares are these? 12%. So 200 lakh ka 12% if you do, that will be 24 lakhs. So if you do this, what are you going to get, sir? EISH is earnings attributable to equity shareholders is 30 lakh. Number of equity shares I think is given in the question. Number of equity shares is given to be, where is that? 2 lakh shares. That means how much is your EPS, sir? You call this as 1, I'll call this maybe as 2. EPS is nothing but 1 divided by 2. 30 lakh divided by 2 lakh, which is nothing but 50. So earnings per share we've got is 15. Now let's write down Walter ka formula. So as per Walter's model, how do you get the price of the share, sir? The red K. So D plus R into E minus D divided by cost of equity, whole thing divided by cost of equity. Whenever you get a chance, as much as possible, write or practice by writing. That is the best way to remember things. Sir, do you know the price of the share? Yeah, they only given. How much is the price of the share? 120. Do you know dividend? No, that's what we need to calculate. Dividend payout ratio is the requirement. So dividend we don't know. R, do you know? Yes. R is how much? 22%. If you want to express 22% in full number, it will be 0.22 divided by cost of equity. How much is cost of equity? 15%. 15% is nothing but 0.15 into E. E stands here for earnings per share. How much is earnings per share? 15 minus D we don't know. Whole thing divided by cost of equity, which is 15. So cross this. These two, 0.22 divided by 0.15 you do offer. 0.22 divided by 0.15. How much is that? 1.0. No. Okay, this is 1.467 into 15 minus D. Whole thing divided by 0.15. So let's simplify it further. So here maybe I'll calculate it here. This is 120 is equal to D plus this. These two come multiplication is how much? 1.467 into 15 is how much? 22 point. Okay, 22 I'll take it. Minus 1.467 D. Whole thing divided by 0.15. So 0.15 you multiply to that side. 120. How much it will become? 18. 18 is equal to this will be what, sir? D minus 1.067 D will give you what, sir? 22 minus 0.467 D, can I call it? So 0.467 D, we will send it to that side. That will become 22 minus 18, which is 4. Therefore, D is how much? 8.56. What is your D? Dividend per share. That's your formula. It's just quickly solving. That's all. Okay. But they did not ask dividend per share. They asked dividend payout ratio. How do you get dividend payout ratio? Dividend per share divided by earnings per share. What is the dividend per share? 8.56. How much is the earnings per share we got? 15. So this divided by 15 will give us how much? We normally express this in percentage. So multiply by 100 if you do. How much are you going to get? 57.06. So what as per the Walter formula is, if your dividend payout ratio is 57.06%, then the price of the share will become 120. Otherwise, that's what they asked. To make the share price 120, what should be your dividend policy? That's another way of structuring. Usually, they will only give out dividend and they'll ask you to find out price of the share. Here, they've given the price and asking us to find out dividend, like that. Okay, another popular question, usually it's not asked in this RTP, but usually gets asked is, they ask you something to calculate called optimum payout ratio. They ask you to calculate something called optimum payout ratio. So as per Walter as well as Gordon, both have the same funda over here. If R is greater than cost of equity, then optimum payout ratio is 0%. If R is lesser than cost of equity, optimum payout ratio is 100%. If R is equal to K, then there is no optimum payout ratio, or whatever you pay, everything is optimum payout ratio. If this is the case, means whatever be your dividend policy, share price will not get affected. Usually they ask this. Let's find it off. No problem for this one. How much is R over here? 22%. How much is the cost of capital? 15%. So R is what, sir, here? R is greater than cost of equity. So optimum dividend payout ratio should be 0%. So let's find out the price of the share. Usually they say like this. What is the optimum dividend payout ratio? And what is the price of the share at that optimum dividend payout ratio? First they'll phrase some question. Then they will say calculate this. Now since optimum R is greater than cost of equity, optimum payout ratio should be 0%. Meaning dividend paid should be what, sir? 0. So if this is the data, means you need to calculate the revised price as per Walter's model. Again, the same data. So how do you get? D into R into E minus D divided by cost of equity. Whole thing divided by cost of equity. Don't say price is 120. We are recalculating that. So how much is the D now? D is 0 plus R. R is how much, sir? 0.22 divided by cost of equity is 0.15. E is 15, right? Minus 0, whole thing divided by 0.15. So calculate here, sir. How much is 140? 146.7. 1.67. Just check what is the price of the share before this. When you are paying 57% as dividend payout ratio, price of the share was 120. When you went for optimum payout ratio, price of the share is 120 or it is 146. 146. That means by altering your dividend payout ratio, share price can be altered. So share price will be maximum in this case when the optimum dividend payout ratio is 0%. That is as per the Walters model. They've not asked this usually in this problem, but they generally do. Usually 5 to 6 marks may they ask, and this last may they will fit in that. So I think it's good practice to know this. Can we go for the other one? Now this is about Walter. Next there is another one called Gordon. Gordon is not a new one for us. Gordon we already know. Okay, we already calculated. How do you calculate cost of equity as per Gordon model, sir? D, if they give you D naught, it will be D naught into 1 plus growth rate divided by P naught minus flotation cost plus the growth rate. Okay. Now 1 minute. This is the formula, correct? Now in the previous case, maybe we were finding out cost of equity. Here cost of equity we are not trying to find out. We are trying to find out price of the share. We want P naught. We want P naught. That means we will have to reshuffle or rejuggle the equation. So what do? G, send it to the other side. What it will become? Cost of equity minus growth rate divided by D naught into 1 plus growth rate divided by P naught. Therefore, how do you get P naught? D naught into 1 plus growth rate divided by K minus G. So it is the same equation, but we are rejuggling to get the price of the equity share as per the Gordon. This is one way. But Gordon has given two formulas there. One is with respect to this. Another one is E1 into 1 minus B whole thing divided by K minus BR. This is another formula. Either you will be going for this or you will be going for this one. Okay. Or instead of this, D0 into 1 plus growth rate, you will get what, sir? D0 into 1 plus growth rate effectively will lead to what, sir? D1. So if they give you directly D1 in the problem, you can do D1 divided by K minus G. Either this or this you will go. That is anyway same variation. If growth rate is missing, then you will have to apply. If growth rate is given, one of these two will come into picture. Because for both of them you need growth rate. If growth rate is missing, you can go for another one called this first formula, E1 into 1 minus B divided by K minus, it's usually K minus G. But we know how do you get growth rate. It has another formula to get growth rate. Growth rate is nothing but B multiplied by R. So instead of G, we are writing it as BR. What does B stands for here? Retention ratio. R for rate of return. Okay, and E1 is your expected EPS. K is your cost of equity. Okay, that's what we need to remember. Actually, this is not a fancy formula. If you do this, if you do E1 into 1 minus B, what effectively you're going to get is D1. So check if you want, I'll just prove it to you here. EPS expected is 10 rupees. Company is expecting EPS of 10 rupees. D as in retention ratio is 70%. That means whatever they are earning, 70% they are keeping. Okay. Now, 70% if they are retaining means, so how much have they earned? 10 rupees. That means what will be your B? How much will they pay off? 100 ka, whatever they earn, 70% they will keep. That means how much will they retain? 7 rupees they will retain. So how much will they pay off? 3 rupees. This is paid off data or expected? Expected. If expected earnings is 10 rupees, if expected payout is 7 rupees, that means what will be this 3 rupees? Dividend already paid or dividend expected? Dividend expected, which is nothing but your D1. One way to calculate is this. Or another way is the formula which they are telling. What does the Gordon formula say? E1 into 1 minus B. So do that. E1 is how much, sir? 10 rupees. Into 1 minus B. What is B? Retention ratio, which is 70%. 70% if you want to express in full number, it will be 0.7. 1 minus 0.7 you do, how much you're going to get? 0.3. 10 into 0.3 is how much? 3. So that means effectively this first numerator is trying to calculate what? D1. That's another way to calculate D1. That's all. Okay. So just check the data. If they give you growth rate, use the conventional formula which you have been used to it. If growth rate is missing, if retention ratio and all they've given means, go for the first formula. That's how to remember whether to go for the first one or the second one. Depends. Each problem may case to case basis may the application may vary. Can we quickly dive into the question, one question and see? This one. Let's go for question number 4. Following figures are collected from the annual report of XYZ. Net profit. Sir, whenever they use the word net profit, it means profit after tax. How much is that? 30 lakhs. Outstanding preference shares is 100 lakhs. So obviously we can't take, can we take PAT itself as ish? No, because there is preference dividend. Since there is preference dividend, we need to deduct that and then only we will get each. So how much is preference dividend, by the way, sir? 100 ka 12%, which will be 12 lakhs. Great. Number of equity shares is 3 lakh. Rate of return on investment, they have given it to be 20%. Cost of equity, they have given it to be 16%. Okay, what you need to do is calculate the price of the share using Gordon's model under 3 scenarios. When the dividend payout ratio, is first case 25%, second case 50%, third case 100%. Okay. All right. So since they have they given, do you see any growth rate there? Growth rate directly have they given? No. That means which formula you have to use? The first one, E1 into 1 minus B, whole thing divided by cost of equity minus BR. Yes, that we have to use. So can we plug in those numbers and do it? But E1 here stands for EPS. First we need EPS. Have they given that, or we need to find out? So first you need to put a one working note for EPS. So I think we can look through this. I think I've solved it. So how much is profit after tax they've given? 30 lakhs. How much is preference dividend? 12 lakhs. So 30 lakhs minus 12 lakh you do. You're going to get each to be 18 lakh. What is the number of equity shares given in the question? 3 lakh. So each is 18 lakh. The number of equity shares is 3 lakh. That gives us EPS how much? 18 lakh divided by 3 lakh, which is 6 rupees. Earnings per share is 6 rupees. Now just go ahead and blindly apply it in the formula. First case, dividend payout ratio is 25%. So when they're talking about payout ratio, that 25% is what? It's applied on what? Earnings. Yes. So how much ever you're earning, 25% of that in the first case you're distributing as dividend. So 25% if you're paying means how much are you retaining? 75%. That means indirectly can I say B is 75% or 0.75? Because we need B for this data. Okay. So how do you calculate price of the share as per Gordon? E1. How much is the E1? 6 into 1 minus B. How much is B? 0.75. Whole thing divided by cost of equity. Cost of equity they have given it to be 16% minus BR. B is 0.75. R is given to be 20%. So apply it. You will get the price of the share to be 150. Second case, same drama. Now the dividend payout ratio is 50%. Every data same except payout ratio has become 50%. So if dividend, if you are paying 50% means how much are you retaining? 50%. So in the second case, B is 0.5. Rest every data same, only B has become 0.75. If you do that, you're going to get 50. And this proves also our model. Why? Sir, how much is R? 20%. How much is cost of equity? That means what is R is greater than cost of equity. What does Walter and Gordon ka same analysis with respect to payout? If R is greater than cost of equity, price of the share or optimum dividend payout ratio should be 0%. If you pay 0% dividend, then max share price will be at the maximum level. More and more dividend you give, share price will go on falling. Okay, see, first case mein you paid 25%. Share price was 150. Second case mein you are paying 50%. From 150 share prices become 50. In the third case mein you are paying 100%. If you are paying 100% dividend means retention ratio is 0%. So plug in the same number, you will get the price to be 37.5. So as you and when you pay the dividend, share price will go on falling. That's all is a Walter and Gordon ka same formula. Expected. Yes, ideally E1 is expected earnings, but in some problems what happens is they will give you the exact data, actual data. That is one. Usually E1 because we want D1. So that means ideally what, sir? What they have to tell us this. There's a small typo. This should not be annual report. This should be expected data. They should use. But study material they're not using that. Maybe by mistake or not, they have not yet corrected. In 1 or 2 times examination also this has got repeated. So we can't question the question. So what we have to do is E1 and E substituted interchangeably in these sort of questions. Ideally what you're saying is right. This should not be as per annual report. Annual report means the data has already happened. But we don't want E1. We don't want E. We want E1. But if they don't give the data means take it as it is and just go with it. But ideally what you're saying is absolutely right. Okay, can I come back to the other one? Yes, this is about our 3 Mahanubhavas. Other than this, we have a few other guys also brought in their own analysis. They are not living behind. One is Graham and Dodda model. Graham and Dodd model. What does Graham and Dodd model says? So price of the share is given by, he has brought in some multiplier model, mathematical formula. Okay. So that is given by, again, you have to remember, okay, all this, nobody will give you. So as per Graham and Dodd model, price of the share is given by MDE3 we used to say. So M into E plus D divided by 3. MDE3. That's how I remember. I asked you to remember as well. So M here stands for multiplier. D here stands for dividend per share. E here stands for earnings per share. So what is this multiplier? Based on his analysis, he took one multiplier. All this will be given to you in the question. So plug it in. Right now, I think this has been removed or shifted to the last section, but we have some MCQ questions, so don't take a chance. Go through it. Simple only. Hardly 1 mark. Maximum they may ask. One formula extra. What is there to kind of go through it? No? Just to be on the safer side. Okay. Next is the linter, the sprinter. So what is our Mr. Linter Garu telling? Linter Gar's linter model ka funda is he is not trying to give out price of the share. He did a survey among finance managers. As per his survey, what came out is finance managers are hesitant to increase the dividend. Finance managers are hesitant to increase the dividend. Meaning, let's say last year a dividend was 10 rupees. This year also they don't mind paying 10 rupees. Or next year, let's say this year if the dividend is 10 rupees, next year also they don't mind paying 10 rupees. But instead of 10, if they have to pay 15 rupees, as per his model, finance managers are not comfortable. That's what he found as per his survey with the finance manager. So he gave up a formula how to find out only D1, not price of the share. How to find out only D1, he gave a fancy formula. So D1 as per the expected dividend as per Linter is D0 plus EPS into target payout ratio minus D0 multiplied minus DO into adjustment factor. Very, very simple formula. This is made very complex. We will just go one by one. D0 is expected dividend. EPS multiplied by target payout ratio. Let's say EPS is 20 rupees. Okay, or maybe we'll work out from the beginning. D1. So dividend you already paid 10 rupees. If you have already paid dividend means what is that? D0. D0 is how much? 10 hours. Plus EPS. Let's say EPS is 20 rupees. Into target payout ratio. Target payout ratio means how much are you planning to give as dividend in the next year? It will be given to you in the question. Next year, let's say dividend target payout ratio is 70%. How much is the earnings expected? 20. How much dividend are you planning to give? 70%. So how much is the dividend expected to be paid next year? 20 ka 70%, which is 40. Sir, we want increase in dividend. How much is the dividend last year? 10. How much are you planning to give this year? 14. So how much dividend are you planning to increase it next year? 4 rupees. What Linter said is he'll multiply last with something called adjustment factor, which is nothing but your probability percentage or chance percentage. So Linter is simply saying how much dividend are you planning to increase by? 4 rupees. There is a 50% chance that we will increase the dividend in the next year. That's all. So simple formula could have been take current year dividend, multiply by what? Increase in dividend multiplied by probability percentage. You could have framed like that. It would have been very, very easy. But instead of that, he told what? D1 is equal to D0 plus EPS into target payout ratio. If you take EPS into target payout ratio, you're going to get D1. We want increase amount. How do you get increase amount? D1 minus D0. Okay, you get increase amount now. Will the 100% chance that you will increase the dividend or probability is there? So multiply AF. That AF is nothing but your probability factor. All the data will be given. You just have to plug in and find out that. So basically Linter's model does not give you the price of the share. Rather, it only gives you expected dividend. Okay, Saru. Optimum dividend payout ratio we already covered. As per Walter and model, it is the same thing. If R is greater than cost of equity, 0%. And it's common sense also. Check over here. Let's say if R is 15%, cost of equity is 10%. Return from the project is 15%. But the cost which you are raising for the, obviously if you want to do a project means you will raise finance. And finance is having how much cost? 10%. Cost is 10, return is 15% means it's a loss-making project or a profitable project. That means it's a profitable project. Sir, if you're running a profitable project, will you run it only once and keep quiet, or you want to run it frequently? Let's say for us now CA is a profitable venture, let's assume. We'll run one batch and keep quiet, or we'll go on increasing the batches? We'll go on increasing the batches because it is profitable. That is what this particular equation is saying. Cost is only 10%, return is 15%. If project is a profitable project, would you like to waste the money by giving away as dividend, or would you like to do this more projects? Obviously, you would want to do these projects more and more so that you can earn more and more. That's the reason they said the optimum dividend payout ratio should be 0%. So don't give any money as dividend. Invest the money in this project itself because it's a very profit making project. However, if it's other equation, R is lesser than cost of equity, optimum dividend payout ratio should be 100%. Last one we already discussed. Okay, sir. Yeah, I think these are the questions and things that I came across. So yeah, with this, all the chapters we had, I think target in mind, we have completed. Thank you. Yes, people, welcome back. And now we'll be starting the revision of the next topic, that is investment decision. Okay, before we start, one important message. Happy Ugadi. Happy Ugadi. So in spite of being festival, all of you are here. That's wonderful to see. I thought all of you will bunk, so I'll also do online. You put Kallu on my plans also. You also came. Okay, that's nice of you. Anyways, we'll celebrate Ugadi with the help of our FM ka syllabus. Yeah. Okay. So now before, let's get started with this topic. Investment decision. The whole crux of this particular chapter is whether should we take that investment decision or not. Like let's say we have an asset. This asset is already existing one. Should we replace this asset with a new advanced version laptop? Or should we open another branch in, let's say, Delhi or Hyderabad? So, should we expand or not? Should we replace an asset or not? Etc. is all we are concerned with the investment decision wala topic. Okay. For that, we have various techniques. First techniques are your non-discounting techniques, meaning they don't use any discount factor. They don't give a damn about time value of money ka concept. They take the data as it is. So first such technique is payback period. So payback period simply says what, sir? Name itself is saying payback period. So in how many months or in how many years will you recover your initial investment? Because to start a project or to buy an asset, you have to put in some money. In how many months or in how many years you will recover that particular investment. That's all is payback period trying to calculate. Okay. So how do you calculate this payback period? But that first check, sir, whether your cash inflow. So if you're doing any project, you will get cash inflow every year. Whether it is same every year or whether it is fluctuating. If the cash inflow that you're getting every year, if it is constant, meaning if it is same every year, then payback period is simply given by the formula initial investment divided by annual net cash flow. Like to give you an example, let's say you invested 3 lakh rupees to buy an asset. From that asset, every year you're getting a cash inflow of 1 lakh. Every year, is it changing or same? Same. That means in how many months or how many years will you recover this 3 lakh? Every year you're getting 1 lakh. That means by the end of third year, you will recover off your investment. That only we are trying to express as formula. What is the formula here? Initial investment divided by annual net cash flow. Basically 3 lakh divided by 1 lakh, which will give you a payback period of 3 years. That's one. So what if it is cash inflow every year if it is changing? If it is not constant, rather it is changing. In that case, what to do? In that case, we have to find out something called cumulative cash flow. Like first year, how much is, I'm assuming that first year cash flow is 80, second year 90, third year 130, and fourth year is 1 lakh 50,000. Initial investment is still the same. How much is that? 3 lakh. In this case, is the cash flow same every year or changing? Changing. If cash flow changes every year, we have to calculate something called cumulative cash flow. And how do we calculate cumulative cash flow? First year, what is the total cash flow you got? 80,000. Second year, what is the total cash flow you got? Second year ka 90 you got, first year ka 80 you have already got. So 80 plus 90 is how much, sir? 80,000 plus 90,000 summation will give you 1 lakh 70,000. Like that, go on adding all the years. Now if you are in the end of third year, means add all the 3 years ka cash flow. 80 plus 90 plus 130 is how much? 3 lakh rupees. Like if you are in the end of fourth year, means add all the 4 years ka cash flows. That will be your 4 lakh 50,000. That only we call it as cumulative cash flow. What was your initial investment? We have assumed 3 lakh. When are you recovering that 3 lakh? By the end of third year. So again, payback period is 3 years. Sir, what if the initial investment is, let's say, 3 lakh 50,000? 3 lakh 50,000. That means, is any number here 3 lakh 50,000? No. That means what, sir? By the end of third year, you have recovered 3 lakh. By the end of fourth year, you have recovered 4 lakh 50,000. That means, can I say payback period is somewhere between year 3 and year 4? So you need to check. From year 3 to year 4, you went. From year 3, you went to year 4. How many months have you increased? 12 months, can I say? Or 1 year, can I say? You increased by your year by 1 year. From year 3, you went to year 4. That means how many years has increased? 1 year. What happened to your cumulative cash flow? From 3.5, it became 4 lakh 50,000. How much did it increase? From 3 lakh, it became 4.5 lakh, means it increased by 1.5 lakh. Correct? No? Now, how many months or how many years I should change my years so that from 3 lakh, what is the number I'm looking at? Payback period means in how many months or years you will recover initial investment. What is the initial investment here? 3 lakh 50,000. So that means from 3 lakh, it should become 3 lakh 50,000. So what is the increase I'm looking at? 50,000. So by how many years the data should change? That means so that my cash flow should increase by 50,000. That is that X method. How do you calculate X here? 50,000 divided by 1,50,000. That is how much, sir? 0.33 years. That means what is your payback period? 3 plus 0.33 years. So if you want, you can express this data in months also, or you can stop it at 3.33 years. That is your payback period. Okay, everybody? All right. So all this will come doubtful, but can come. We don't know. What can come, what can not come is not our ideology. Our ideology is just to revise whatever it is. Okay, next one is payback reciprocal. We don't see payback reciprocal any question. They ask you normally, I've seen a couple of times theory question coming on a payback reciprocal. So name itself is saying payback reciprocal. So how do you calculate payback reciprocal? 1 ulta of payback period. So basically you have to do 1 divided by payback period. If you do that, you're going to get something called payback reciprocal. Why do we calculate payback reciprocal? Is theoretically it is argued that payback reciprocal will be more or less equal to IRR. Payback reciprocal will be more or less equal to IRR provided one condition is satisfied. What is that condition? Is the life of the project should be twice of the payback period. Life of the project should be twice of the payback period. Suppose payback period is 3 years. Then the project life should be twice. What is 3 into 2? 6 years. So if the life of the project is at least twice of the payback period, then payback reciprocal we say will be more or less equal to IRR. That's as per the studies. So there's another quick way to calculate IRR. For our IRR, we have a fancy formula. So instead of using fancy formula, you can find out payback reciprocal also, because they say payback reciprocal and IRR will be more or less same, provided life is twice of the payback period. Just note down 2-3 points just in case if it comes with a theory question, you should be able to answer them. Alright, that is one. Next is ARR. ARR is for accounting rate of return, or also known as average rate of return. So accounting rate of return as per P&L. So take the profit. The name itself is saying average rate of return. That means what do we need? We need total profit or we want average profit. So take your average net income. That is nothing but your profit as per P&L account. Sir, if they give you 3 years ka profit, let's say first year ka profit is 80,000, second year ka is 90,000, third year ka is 1 lakh. How do you find out average? Add all the years ka profit and divide by 3. How much are you going to get over here? 90,000. Yes, no? That becomes your average profit, which is nothing but your numerator. Okay. Then denominator could be, there are 2 ways in which you can calculate ARR. Either you can take initial investment, or if you want, you can take average investment. Both are acceptable. Initial investment means to start the project, how much you need the money. How do you get average investment? Average investment, there is a shortcut. How do you find out average investment? Opening balance or initial investment plus salvage value divided by 2. Basically, how do you find out? Basically, these are assets, no? How do you find out average balance of assets? Opening balance of asset plus closing balance of asset divided by 2. Let's say you bought an asset for 1 lakh rupees. You purchased an asset for 1 lakh. Residual value or salvage value is 10,000. I assume life is 3 years. What is depreciation, sir? What is first year ka depreciation? 1 lakh minus 10,000 divided by 3. If you do, you're going to get first year ka depreciation to be 30,000. What is the life of the project? 3 years. That means what is the total depreciation for 3 years? 90,000. Can you tell me what is asset ka opening balance? 1 lakh. Can you tell me what is asset ka closing balance at the end of year 3? You bought the asset for 1 lakh. You depreciated it totally by 90,000. So what is asset ka closing balance? 10,000. That means indirectly, what is that 10,000? Residual value. So residual value is nothing but your closing balance. Hence, how do you find out average investment as a shortcut? Simply take initial investment plus salvage value divided by 2. That if you want, you can do. That gives you your ARR. Also, sometimes in the problem, they will not give you P&L data. They will not give you P&L data. But to find out average ARR, we need average profits. There is a workaround or as another method to find out average profit. What is that? Cash inflow minus cash outflow. Meaning, check here. For you're doing a project for 10 years. Let's say for 10 years, the total cash inflow is 1 lakh rupees. For all the 10 years put together, totally how much inflows are you expecting to get from the project? 1 lakh. To start the project, there has to be some outflow. Let's say outflow of the project is 20,000. So outflow is 20,000 initially. Totally, how much are you expecting to get? 1 lakh. How do you find out average profit? Is simply, how do you find profit? Income minus expense. Do you have income and expense data? No. If you don't have income and expense data, substitute with inflow and outflow ka data. What is the total inflow? 1 lakh. What is the total outflow? 20,000. So that means what is the net inflow? 80,000. this net inflow of 80,000 is for 1 year or 10 years? This net inflow of 80,000 is for 10 years. Hence, how do you find out average profit? 80,000 divided by 10. What is that 10 here? Project ka life. That you will get how much, sir? 8,000. This 8,000 only you can substitute it as what? Average profit. Is that okay? If they give you income and expense data, find it out normally. Or if they give you P&L data, find out average profit normally. If they don't give you income and expense data, or if they don't give you P&L data, you can find out P&L through another way, which is nothing but total inflow minus total outflow divided by N. N here stands for total life of the project. That's another workaround to get it. We have done a couple of questions in our regular class through this also. Right now, I don't have time to do every question, so I've assumed small examples and covering all that. Is that okay, sir? Great. Okay, this is about ARR. ARR ka another name is average rate of return. So all these techniques are non-discounting techniques, meaning they don't worry about the discount factor or time value of money ka concept. Okay, next techniques that is more popular and gets asked more frequently in exams are the discounting techniques, meaning they consider the time value of money. And the first such technique is net present value, or popularly called as NPV. How do you calculate NPV? Its name itself is saying net present value. So simply you have to take what, sir? Present value of cash inflow minus present value of cash outflow. That gives you your final number of net present value. So basic decision rule is, if you want to do a particular project, calculate the NPV of that particular project. If that project is having a positive NPV, meaning if NPV is greater than 0, accept the project. Otherwise, reject the project. That's how you're going to base your decision. Okay. Now here, sir, check here. Why do we consider this is, let's say you want to do a particular project, and to do that project, you need an investment of 1 lakh. If you do that project, first year you will get 80,000 as inflow, 70,000 you will get in second year as inflow. What is the total inflow you will get? 1,50,000. So total inflow for a period of 2 years is 1.5 lakh. But to start the project, how much money you need? 1 lakh. Sir, can't I straight away compare these two numbers? I'm investing 1 lakh, I'm getting 1.5 lakh. So it's a profitable project. So why can't I directly do that? I can't directly do that because 1 lakh is an investment to be made now, meaning it is on what terms? Present value terms. But this 1,50,000 I'm not going to get now. I'm going to get it over a period of 2 years. That means there is there on what platform? Future value terms. So one is there on present value terms, another one on future value terms. So straight away comparing and taking the decision is not right. That's where NPV comes into picture. So you have to find out the present value of this 1 lakh also, which is nothing but present value of cash outflow. You have to find out present value of 1,50,000 also, which is nothing but present value of cash inflow. Compare. If inflow ka present value is greater than outflow, then accept the project. Otherwise, reject it. That's all. It's a simple funda. And how do we find out? Simple. Take the cash flow. And how do you find out present value? You have done all this. Simply take the cash flow and multiply by the discount factor. Discount factor will be usually given to you in the question. And how do you calculate discount factor, people? 1 divided by 1 plus I whole power n. So first year ka, for year 0, when we say year 0, what does it mean in FM terminology? Year 0 means now, immediately. So this 1 lakh, should I have to find out the present value of this 1 lakh? I'm doing the project now. I'm investing the money now. That means this 1 lakh is already there on present value terms. That means what is the discount factor for year 0? For year 0, discount factor is always 1. So 1 into 1, if you do, you will be negative. So in case of NPV calculation, outflow we presented as a negative number, inflow we presented as positive number. So first year, how much inflow I've assumed? 80,000. Second year, how much inflow? 70,000. What is the discount factor I've assumed? 10%. So calculate that. So what will be the first year ka discount factor? 1 divided by 1.1, which gives you a discount factor of 0.9090. Again, press equals to button. All of you are, I hope, remember the discount factor wala calculation. Simply do 1 divided by 1.1. Go on pressing equals to button. You will go on getting the forward years ka discount factor. So second year ka discount factor is 0.8264. So how do you get the present value of cash inflow? Simply take the cash flow and multiply it by the discount factor. You will get the present value of cash inflow. Present value of cash flow. So when you sum up everything, what are you getting here? 30,568. Negative number or positive number? Positive. So NPV is positive. So can you go ahead with this project? Yes. That's your final decision. That's all as NPV ka decision all about. So much chintu question mostly will not come from, especially from this topic. They generally ask a little tricky questions from this topic. Usually all previous topic we taka finished because most of them are driven by formats and formula, and it will be pretty straightforward question. From this one and working capital management, these two are generally they try to make it little tricky, usually. Not saying every attempt, usually that's the case. Okay, if all this question comes, big smile on your face. Okay, you should have it definitely. Huh? Even otherwise also smile. You have a beautiful teeth. No, once in a while you should flash. Yeah. Okay. Now the next one is a present value index, also known as PI. So there is multiple names for this. You can call it as present value index. We can call it as profitability index, or also sometimes they call it as the desirability factor. It is nothing but an extension of NPV. How did you find out NPV? Present value of cash inflow minus present value of cash outflow. Instead of minusing it, divide it. So present value index is nothing but, or PI is given by present value of cash inflow divided by present value of cash outflow. So decision rule here is, if profitability index is greater than 1, accept the project. If profitability index is lesser than 1, reject the project. If profitability index is exactly 1, either you can accept or you can reject. Totally the choices belonging to the company in that particular case. Okay, sir. Alright, next is IRR. IRR is your internal rate of return. Some books may initially, in accounts may, we also refer to this as implicit rate of return also sometimes. But here we will call it as internal rate of return. So internal rate of return simply means the rate at which, it is like break-even point. It's a rate at which present value of cash inflow will be equal to present value of cash outflow. At what rate present value of cash inflow will equate to present value of cash outflow? Such a rate only we call it as IRR. And how do we do this IRR, sir? For this simple step is, you can assume any two discount factor, because we only have to find out the rate. IRR means normally in all our NPV calculation and all, they would have given the rate. But in IRR, we are only trying to find out the rate. So way to do it is assume any two discount factor. Okay. So and calculate what, sir? NPV. You know how to calculate NPV? Calculate that. And just plug in the numbers in one formula. Actually, IRR we can do it without any formula, with logic also, aram se. Just it's a pure comparison X method it is. But our study material uses only formula. That's the reason I will not even mention logic. Always in exam present formula only. So how do you find IRR ka? I mean, what is IRR ka formula, people? IRR is given by lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate, whole thing multiplied by higher rate minus lower rate. So what is this higher rate and lower rate? Sir, you are assuming two rates. No, let's say you are assuming 10% and you are assuming 15%. Which is the lower rate among 10 and 15? Obviously 10. So 10 becomes your lower rate. That is denoted by the symbol in this formula as L. Okay, or you can write LR, whatever it is. So 15% becomes your higher rate. Okay. Alright, so if I have quickly shown over here, or if you want, you can calculate IRR also. We don't have time, so quickly I'll run through the IRR calculation. I know most of you know this, just quickly running through. Initial investment is 1 lakh. Okay, initial investment of a particular project, I've assumed it to be 1 lakh. From this project, you are expecting 3 years ka cash inflow this much, 30, 40 and 60. All we have to do is find out IRR. So what will we do? Assume any two rates. So first rate, I've assumed is 10%. At 10%, let's calculate. So all these cash flows are there on present value terms or future value terms? All this 30,000 you will get at the end of year 1, 40,000 you will get at the end of year 2, 60,000 you will get at the end of year 3. That means all these are on there on which platform? Future value for terms. We want present value. How do you find out present value? Take the future cash flows multiplied by the discount factor. First discount factor I've assumed is 10%. I've calculated. How much is it? Sir, what is IRR, you tell me? Again, IRR is a rate at which present value of cash inflow will be equal to present value of cash outflow. Sir, if present value of cash inflow will be equal to present value of cash outflow means IRR is basically a rate at which NPV will become 0. Because if inflow and outflow, if it is same, means how do you get NPV? Inflow minus outflow. If inflow is 1 lakh and outflow is also 1 lakh means obviously what will be NPV? 0. Basically, IRR is a rate at which NPV should become 0. Now you assumed a 10%. If 10% is IRR, then NPV should become how much? 0. Did you get 0? No, you got 5,404. That means is 10% my IRR? No. Assume another rate. Usually the way we do it IRR is, or general way of putting an IRR is, one NPV should be positive, another NPV should be negative. That's how usually we take it. So let's assume another rate. Maybe let's take it at 13%. Now test it at 13% now. This is your cash flow and the discount factor at 13%. How do you find out discount factor again? 1 divided by 1 plus I whole power n. So 1 divided by 1.13 you do. Press equals to button 3 times. You're going to get or go on pressing equals to button. You'll get the respective years ka discount factor. So take the cash flow multiplied by the new discount factor now. You're getting how much now? The final NPV you're getting is 549. So is 13% my IRR? No. If 13% was IRR means NPV should have become 0. It is not 0. It has become negative. So how do you? Just substitute the numbers in your formula now. So what is the formula? Lower rate. I've assumed two rates, 10 and 13. Which is the lower among this? 10%. Plus NPV at lower rate. What is NPV at lower rate? 5404. Divided by NPV at lower rate, which is 5404, minus NPV at higher rate. Higher rate ka NPV is already negative. Negative of negative will become what, sir? Minus of minus will become positive. So here you'll have to add 549. Whole thing multiplied by higher rate minus lower rate. Higher rate is 13%, lower rate is 10%. So 13 minus 10 will give you how much? 3%. So plug in these numbers and finally you will get the IRR of 12.72%. This turn all they will ask us, sir. Yes. Not as it is. They will give you a big question. Okay. Then they will say whether the project can be accepted using NPV, and add on they will say also calculate. While you're doing so much, also calculate off IRR. Like that they will ask. Separately IRR question most probably will not come, because this for your standard, these are all very, very simple. Okay. So again, if it comes, good for you. Majja madi. Okay. This is about your IRR. So, okay, next one is MIRR, as in modified internal rate of return. What is MIRR ka whole funda is? Now, let's take the one hypothetical example. Let's say to do a particular project, we need an outflow of 1,50,000. The rate of return is 10%. I'm assuming. Now, first year, let's say from this project, you'll get 80,000. Cash inflow from this project is 80,000. Second year, we are expecting that we will receive 70,000. Third year, we are expecting to receive 50,000. Now, basic common sense. At the end, project will run for how many years? Project will run for 3 years. At the end of first year, how much money you got? 80,000. Now, in all our NPV and IRR calculation, no, they are forgetting one factor. That is the reinvestment element. They're forgetting one element called reinvestment. Now, you think you're doing a project is going on. At the end of first year, how much money you got? 80,000. This 80,000 money, will you keep quiet or will you reinvest? This 80,000 money, you got it from the project. Will you keep it idle or will you reinvest it into the project? Reinvest into the project. But other techniques considers this reinvestment factor or they ignore? They ignore. MIRR considers this reinvestment wala element. That's the reason the name of this is modified internal rate of return. So, sir, if you're reinvesting means obviously you'll get some return. So that return they would have given to you in the question. In this example, I've assumed it to be 10%. Now you tell me 80,000. When are you expecting to receive? Now or at the end of first year? End of first year. For how many years the project will run? 3 years. You are at the end of first year. You got 80,000. So how many years? How many more years can you invest this 80,000? 2 more years, because project will end by the end of year 3. That means if you invest this 80,000 for 2 more years, how much return will you get? If 10%, you will get 1 year. So you can invest it for 2 years. How to find out that? 80,000 plus 10% plus 10%. That way you can do it. So that means how much finally it will become? 96,800. Is that okay? Or you can find out. So this is 80,000 now, no? How many more years can you invest this? 2 years. We already know this mathematically, no, sir? How do you find out future value? Present value into 1 plus I whole power n. So that 1 plus I whole power n only study material calls it as reinvestment factor. What is I here? 10%. So calculate that 1 plus I whole power n. What is I? 10%. Whole power n. How many years can you invest this 80,000 for? 2 years. So basically 1.1 whole square you have to do. 1.1 into 1.1 if you're doing a calculator. How much is that? 1.21. 80,000 into 1.21 you do. How much are you getting? 96,800. Either you can multiply reinvestment factor and get this 96,800, or simply you can do 80,000 plus 10% and 10%. Study material presents like this. If you feel this is simpler, you can follow the other method, whatever it is. Is that okay? So at the end of third year, how much will be this cash flow ka value? 96,800. Now same drama. This 70,000, when did you get? By the end of second year. How many more years can you invest this 70,000 now? Project will end by the end of year 3. That means how many more years can you invest? 1 more year. If you invest for 1 more year, how much return will you get on this 70,000? 10%. That means how much its value will become by the end of year 3? 70,000 plus 10%, which will be 77,000. Now, this 50,000, when are you getting? At the end of year 3, and project is getting over by the end of year 3. So, can you reinvest this money? No. That means this value will still be same, 50,000 only. So, add up all this. How much are you getting? 2,23,800. This we call it as terminal cash flow. This we call it as terminal cash flow. MIRR simply means at what rate, what should be the rate so that the present value of terminal cash flow will be equal to present value of cash outflow. How did you find out IRR? Present value of cash inflow will be equal to present value of cash outflow. Now, when you're calculating MIRR, we are not taking inflows and outflows. We'll take MIRR is a rate at which present value of terminal cash flow will be equal to present value of cash outflow. At what rate these two will be equal? That is what is your MIRR ka whole drama. Okay. So how do you calculate that? Same IRR ka steps. I've just put it up over here. Now, how much you have to invest by the end of first year? How much you have to invest? 1,50,000. Now you have to compare these two. MIRR means what, sir? What at rate at which terminal cash flow, which is 2,23,800, that should be equal to present value of cash outflow. When will you get this 2,23,800? Now or at the end of year 3? End of year 3. So year 3 ka how much is the cash flow? This is your terminal cash flow. What is the total terminal cash flow? 2,23,800. How much is your initial cash outflow? 1,50,000. Repeat the same step of IRR. Assume any two random discount factors. First discount factor I've assumed it as 14%. So first year, what is the discount factor? 1 only. For third year, what is the discount factor? 1 divided by 1.14. Press equals to button 3 times. How much are you getting? 0.6749. So multiply these two. This is negative and this will be 1,51,058. So how much are you getting? 1058. So is 14% your MIRR? No. If 14% was MIRR, means this final number should have become 0. Are you getting 0 or are you getting a different number? Different number. That means, is this your MIRR? No. Continue the process. Assume another rate. Since the rate is closer, I've assumed 15% now. When you use 15%, what am I getting? 2851. Negative that too. So is 15% my MIRR? No. So MIRR is lying between 14% and 15%. So now use your IRR formula to get your MIRR. What is IRR ka formula? Lower rate. What is the lower rate? I've assumed 14 and 15%. Which is the lower rate among this? 14%. Plus NPV at lower rate. What is NPV at lower rate? 1058. Divided by NPV at lower rate 1058 minus NPV at higher rate. NPV at higher rate is already negative. So negative of negative will become positive. So add it into higher rate minus lower rate. So calculate that. How much are you getting? 14.27%. That is your, it's the same step. But in your normal IRR, what do? We try to equate present value of cash inflow with present value of cash outflow. But in MIRR, we try to equate what? Present value of terminal cash flow should be equal to present value of cash outflow. That's the only difference. Okay. First find out terminal cash flow and repeat the IRR steps and then you'll get MIRR. Not popular, but could be asked easily because now it's all MCQ based. No people. Aram se all this can be asked for 2 marks. Okay. If they can just keep the life like I've assumed here. Life I've assumed it to be only 3 years. No. So if you take a smaller life means all this calculation also becomes very simple. In 2 to 3 minutes mein or 5 minutes mein maximum you can pull out all the data. So all this also can come in examination. Okay, can I proceed? Okay, next. The next one is capital budgeting under capital rationing. Capital budgeting under capital rationing. What is the funda of this is? Okay, let's take 3 projects, sir. These 3 projects ka NPV is this much. Project A ka NPV is 1 lakh, B ka is 80,000, C ka is 50,000. What is the decision rule? Normal decision rule is what? If NPV is greater than 0, accept the project. If they give you multiple projects, how will you do the selection? Whichever project gives you the highest NPV or higher NPV, select that. So according to you, which is having the highest NPV? Project A. Yes. And B is having how much? 80,000. So and C is having the lowest NPV compared to the 3. Yes, no? Correct. What capital budgeting under capital rationing says is check. Okay, NPV you have got it, no problem. But is all 3 projects having same cash outflow or different cash outflows? Different cash outflow. Check what is the initial investment for project A? 1,80,000. For B it is 1 lakh. For C it is 75,000. So obviously, sir, if you invest more money, you will be able to earn more money also. Correct, sir. Now suppose I want to open coaching center in one location. That means how many students can I target? Maybe 50, maybe 100, maybe 200. Now I want to open coaching center all over India. How many students can I target? Thousands of students? Yes or no? So bigger the project, bigger your NPV is. Correct, no people? So capital budgeting under capital rationing is also saying like that. Don't blindly go by NPV. Also give preference to initial investment. Keep that also in mind. So here just check. Based on this, blindly don't select project A. what capital budgeting, they will clearly mention this, okay, in the question, how to go about these sort of problems. So what does capital budgeting under capital rationing says is like this. For how much is NPV of project A? 1 lakh. But to do this project A, how much initial investment you need? 1,80,000. So if you are ready to invest 1,80,000, then you can expect an NPV of 1 lakh. What capital budgeting says is, for 1 rupee outflow, find out NPV. For 1,80,000 outflow, NPV is how much? 1 lakh. For 1,80,000 outflow, how much is NPV? 1 lakh. For if you just invest 1 rupee, if your initial investment is only 1 rupee, then how much is your NPV? So for 1,80,000 initial investment, NPV is 1 lakh. For 1 rupee, how much is it? How do you calculate X here? How do you calculate X here? 1 lakh divided by 1,80,000. That you express in formula now. What is that 1 lakh? NPV. What is that 1,80,000? Initial investment or cash outflow. So calculate that. What is NPV for 1 rupee investment? 1 lakh divided by 1,80,000, which is 0.55. So here it will be 80 divided by 1 lakh, which is 0.8. Here it will be 50 divided by 75, which is 0.66. Correct? Now check, sir. If you invest just 1 rupee in project, which is giving you the highest NPV. Now you tell me now, outflow is on different platform now or same platform? All the project outflow is on same platform. What platform is that? 1 rupee wala platform. So if you invest only 1 rupee, how much NPV A is giving? 0.55, B 0.8, C 0.66. So just for 1 rupee investment, which project is giving you the highest NPV? Which project is giving you the highest NPV? Project B. So that means the first preference should be given to project B. So if you have money, first ideally you should take up project B, because for 1 rupee worth of investment, project B is giving the highest NPV. Next, which project is having the higher one? Project C. So that means second rank will be given to project C. Last rank will be given to project A. That is your capital budgeting under capital rationing wala funda. Is that okay? So what is the whole one line? If I have to summarize this, what is this now? Don't do the decision based on total NPV. Base your decision based on, for 1 rupee investment, how much is the NPV? Based on that, you take the decision, is what capital budgeting under capital rationing is trying to say. Is that okay? We have done a couple of questions on this also. But overall got it, no? It's quite a simple affair. Yes? Okay. Next one is project with unequal life. Project with the unequal life. You want to do 2 projects. One project ka life is 5 years. Another one ka is 8 years. So straight away, can you compare based on NPV? No, because one ka life is only 5. Another ka life is 8 years. So since the project has different life, we have to calculate something called EAC. Equivalent Annualized Criterion. So how do you calculate that? Same funda. Let's say discount factor is 10% assumption. We have 3 projects X, Y, Z. X ka NPV is 1. All these numbers I've assumed just to explain. All this data will be given to you in the question. But I don't want to run through a whole question, because if you solve all the question, it will take 10 minutes. But if I take an example, I can explain it within 2 or 3 minutes and move on. So, but the funda is we should get it. How we get it is irrelevant. Or more relevant is whether are we getting within the shortest possible time. Okay. So let's say NPV of project X is 1 lakh, Y is 80 and Z is 1 lakh 20,000. For project X ka life is only 4, Y ka is 3 and Z ka is 5 years. So normally the rule is whichever project gives you the highest NPV, select that. But unfortunately over here, all the projects have same life or different life? Different life. So what if they have unequal life or projects have different life, then you have to find out something called equivalent annualized criterion. Before that, first we need something called PVAF, present value annuity factor. So what is this PVAF? Sir, do you know what is the discount factor here? 10%. So what is the project life here, sir? Total life is how much? 5 years. So each year ka, first year ka, what is the discount factor? 1 divided by 1 plus I whole power n. So if you do 1 divided by 1.1, how much are you going to get? 0.9090. Second year it will be 0.8264. Like this, if you go on pressing equals to button, all these numbers you're going to get. Each year ka discount factor, we call it as PVIF. 1 year ka discount factor or any 1 year ka discount factor, we call it as PVIF, as in present value interest factor. But if you collate everything, if you add everything, if you add 5 years ka discount factor, that added number we call it as PVAF, as in present value annuity factor. Even if you add 2 years ka discount factor, then also we call it as what? PVAF. So if you're summing up discount factor, the total number or that summed up number only we call it as PVAF. Full form is present value annuity factor. So first you need to find out something called present value annuity factor. Here life is how many years? 4 years. So do in your calculator, 1 divided by 1.1, press equals to button 4 times. Either you can do M plus button, that is one option, or press equals to button 4 times and press GT button if you have in your calculator. That also works, whatever way. So do 1 divided by 1.1, press equals to button 4 times and press GT button. How much are you getting? 3.1698. That is your added 4 years put together discount factor is how much? 3.1698. Similarly for Y you calculate 1 divided by 1.1, press equals to button 3 times and press GT button in your calculator, grand total button. You're going to get 2.4868. For 5 years, find out the discount factor at 10% for me. Same. 1 divided by 1.1, press equals to button 5 times and then GT button. You're going to get 3.7907. So you got PV AF for the respective project. So how do you get EAC is simple. How do you get NPV or how do you get EAC? NPV divided by PV AF. Simple. You will get this much NPV provided you run the project for how many years? 4 years. You will get 1 lakh NPV of project X provided you complete the project X for over how many years? 4 years. EAC means what is your average NPV for 1 year? What is the average NPV for 1 year? Okay. So here each year ka discount factor is same or it changes? Changes. Because how do you find out NPV? Using simple average or using time value money concept? Time value. That's the reason we don't directly do 1 lakh divided by 4. Because that becomes simple average. We don't find out NPV using simple average. We find out using discount factor. Trying to find out simple average or average NPV here, what do we do is take NPV divided by PVAF. So 1 lakh divided by 3.1698 you do. How much are you getting? 31,548. So for project X, no sir, it is giving you an average NPV of 31,548. Similarly, project Y, NPV divided by PVAF you do. 80,000 divided by 2.4868. How much are you getting average NPV to be? 32,160. Same thing here, 1,20,000 divided by 3.7907 if you do. 31,656. So which project is giving you highest average NPV? Which project is giving you highest average NPV? Project Y. So that's what EAC says. So find out EAC, whichever project is having you the highest EAC, select that. In this particular example, project Y is having the highest EAC and you will select that. Okay, done. Okay, this is one. Another way you need to be, don't blindly mug up the formula and apply. Sometimes you also calculate EAC from cost angle. Sometimes in the problem, they will give you data only relating to inflow. That means you will be able to find out what? NPV. Because to find out NPV, we need inflow also, we need outflow also. So if you're finding out EAC, EAC is basically average number. Average could be for NPV also, average could be for cost also, average could be for anything. So here average was for NPV. That means it was work from the outflow angle or inflow angle. Inflow angle. That's the reason the decision is what, sir? You will select that project which has highest NPV. Suppose they give you only cost ka data. They give you 3 projects. We have done one such question in our regular class. They give you only cost ka data, no inflow, only cost. Okay, but life is different. Which project will you do? Again, you will find out EAC, but this time you are working EAC from inflow angle or cost angle. Cost angle. Same drama, but selection rule be what? Rule will be what? The project with the highest EAC will you select or lowest EAC? If you're working from the cost angle, you will select that project which has the lowest EAC. So keep that in mind. From which angle are you finding out EAC? Both the problems we have done. One from the inflow angle, another one from the cost angle. Both kinds of problems we have targeted. Is that fine? Okay. Decision rule you already know. I've just summed up everything. First is payback period. What is the payback period ka decision rule? First check whether the decision rule is for the individual projects or multiple projects. Individual project means, sir, let's say I have one project. I want to start ACCA coaching in Chennai. I want to start only ACCA coaching in Chennai. So that means what is the rule? Whether to start it or reject it. Whether to accept it or reject it. So I have multiple projects or only one project? One project. So if you have only one project, what is the decision rule? The payback period, based on payback period, if you have to decide, means you have to check the expected period. If the project ka payback period is lesser than expected period, then I can accept it. Otherwise, reject it. Let's say I feel as a company, I want to recover my investment within 5 years. As of any project as a company, if we do, I'm not talking about profit. Any project that we do, investment we want to recover within 5 years. But we are planning to do one project that has a payback period of 7 years. Now you tell me, will I accept this project or reject it? I'll accept this or reject it. Reject. Why? Sir, we have a cutoff of what? 5 years. We want to do only that project wherein we will recover our investment within 5 years. But this particular project is able to recover the investment only after 5 years, that is 7 years. So in this case, you will accept it or reject it? You will reject it. If I modify this example, if I say, this project will help me to recover my investment only within 3 years, then accept it, because my cutoff period is what, sir? 5 years. But the project is, I'm able to recover the investment from the project only within 3 years. In that case, you will accept it. That's what I've written over here. If the payback period is lower than expected period, you can accept the project. Otherwise, the project will get rejected. However, if you have multiple projects, then based on payback period, how will you do the selection? If you have two projects, A and B, A ka payback period is 5 years, B ka payback period is 4 years. How will you do the selection? Payback period means recovering the investment. Think logically. You want to recover the investment at as late as possible or as early as possible? As early as possible. Which is giving you the early recovery? B. So that means what, sir? If you have multiple projects, the decision rule is you will go for that project which has a lower payback period. Same. ARR. Sir, ARR is nothing but a return. Okay. So for individual project, what is the acceptance rule? If ARR is higher than expected return, then you can accept the project. Like let's say I want to do any particular project, provided project gives me minimum of 12% return. As a company, I want to take only those projects which gives me a minimum return of 12%. That's the benchmark we have set. Internal deadline this is. One particular project ka return is only 10%. Accept or reject. One particular project ka ARR is only 10%. Accept or reject. Reject. Why? Minimum expectation is 12, but this project is giving a return of only 10. So it is giving lower than expected return. So if it is giving lower than expected return, reject it. Suppose the project return is 15%, then accept it, because minimum expectation is 12. This project is giving me 15, Andre. You can go ahead and accept the project. That's your decision rule. However, if you have multiple projects based on ARR, how can you select? It's a return. So you would want a lower return or higher return. So if you have multiple projects, means you will select that project which has a highest ARR. Okay. Next is NPV. What is the decision rule for NPV, sir? For single project, if NPV is greater than 0, accept. If NPV is lesser than 0, reject. If NPV is exactly 0, accept or reject based on company ka. Either they can accept it or they can reject it. Totally management call. However, if you have multiple projects, how will you do the decision? You'll compare whichever has the higher NPV or highest NPV, you will select that. Profitability index also same rule. For individual, what is the decision rule? If profitability index is greater than 1, accept it. Lesser than 1, reject. For multiple project based on profitability index, how will you select? Whichever project has the highest profitability index, that particular project will be selected. IRR also same thing. For multiple projects, how will you select IRR? IRR is also return. So multiple projects based on IRR, how can you select? Whichever project has the highest IRR. For individual projects, how will you select? IRR is a return. No? To do a particular project, you will have some cost also. So compare IRR with cost of capital. If IRR is greater than cost of capital, accept the project. Otherwise, reject. So let's say project return is 15%. But to do this project, we need a cost of, our overall cost of capital is 12%. That means this is a profitable project or loss-making project. Profit or loss? Cost is only 12%. Return is 15%. So loss, profit. So that means, can you go ahead and accept the project? Yes. So if IRR is greater than overall cost of capital, accept it. If IRR is lesser than overall cost of capital, reject it. Not asked much, but just saying it out. Just quickly review that. Or sometimes you can base your decision if overall cost of capital is not there. Compare IRR with expected return. Based on that also, you can do the decision. Okay now? All right. Correct. At what rate? Correct. No. Which? No. See, when you're doing inflow, right? Inflow with outflow, right? See, outflow is what's initial investment. Okay. I'm doing one project. Let's say I'm doing a CA project. Okay. So for that CA project, I'm arranging your funds. Let's say my expected return is 15%. Does it mean my banker should give me the finance also at 15%, or it could be different? It could be different. That's what it's saying. So overall cost of capital is a cost to raise the finance. So the IRR is a return that you're expecting. Return and the cost may be same or may not be same. So straight away we cannot be able to straight away compare. It could be same. I'm not denying that, but it may not be also. Okay. All right. So that is the thing. So now let's have a quick recap and then we'll dive into the question. So what is the chapter name? investment decision. So overall fund of investment decision is what? Should we replace the project, or should we expand the project, or should we take up the project in the first place? For this, we have various techniques. The first technique is what? Payback period. So payback period means what? In how many months or in how many years will you be able to recover your initial investment? For this, first you will check in your annual cash inflow is constant or fluctuating. If it is constant, then payback period is simply given by the formula initial investment divided by annual net cash flow. If it is fluctuating, then you'll have to find out cumulative cash flows and accordingly do it. Okay, next is payback reciprocal. How do you calculate payback reciprocal? 1 divided by payback period. Why do we calculate payback reciprocal? Because we say payback reciprocal will be equal to or will approximate to IRR, provided one condition is satisfied. What is that? Life of the project should be minimum what, sir? It should be twice of the payback period. Then accounting rate of return or average rate of return given by the formula average profit divided by either initial investment or average investment. How do you find out average profit? If they give you 5 years profit, add all the 5 years profit divided by 5. If they don't give you profit, find out total inflow minus total outflow divided by the total number of years. Like here in my example, total cash inflow was 1 lakh. Total cash outflow was 20,000. So 1 lakh minus 20,000 euro. How much are you getting? 80,000. This 80,000 you got it for 1 year or 10 years? 10 years. So divided by 10. That is your project life. So that 8,000 only will become your average profit. Then how do you find out average investment? Average investment is nothing but one shortcut way is opening basically initial investment plus salvage value divided by 2. Perfect. Next is your discounting technique. Certain discounting techniques, or first discounting techniques is NPV. NPV is given by the formula present value of cash inflow minus present value of cash outflow. That's one. Okay, next is profitability index given by the formula present value of cash inflow divided by present value of cash outflow. Next is IRR, full form is internal rate of return. IRR is basically a rate at which present value of cash inflow will be equal to present value of cash outflow, meaning NPV should be equal to 0. That's one. Next is MIRR. So MIRR considers one element which other techniques are missing to consider, which is reinvestment factor. So in MIRR, what do you have to do? All the inflows we have to get it to which platform? Terminal cash flow. So MIRR is basically a rate at which present value of terminal cash flow will be equal to present value of cash outflow. Okay. How do you get terminal cash flow? Simply take the cash inflow and add the reinvestment factor. Like here, you're getting this 80,000 by the end of year 1. Project will end by the end of year 3. So this 80,000 you can invest for 2 more years. If you invest for 2 more years, you will get a return of 10%. So that means terminal cash flow for this will become 96,800. Like this, each year ka terminal cash flow you find out and sum it up, you will get the total terminal cash flow and accordingly find out MIRR. Okay, next is what did we learn? Capital budgeting under capital rationing. So what does capital budgeting under capital rationing say? If the projects have a different initial investment, you have to find out NPV for 1 rupee investment. Find out how much is the NPV for 1 rupee investment. Based on that, you do the selection. And what is the selection rule? Whichever project has a highest NPV for 1 rupee investment, that select or first rank will be given or awarded to that particular project. Accordingly, the rankings will be made. Next is projects with unequal life. If you have multiple projects and if they don't have same life, then we have to calculate something called EAC, equivalent annualized criteria. You can work out EAC from inflow angle or from NPV angle you can work out, or cost angle. If you're working out from NPV angle, how do you find out EAC? Basically NPV divided by present value annuity factor. So what is EAC trying to calculate here? Average NPV. So what is the decision rule? So whichever project has the highest EAC or highest average NPV, you'll go for that. However, if you same data, if you're working from cost angle, you'll select that project which has the lowest EAC. Great. Decision rule we already gone through. Okay, na sir? There are a couple of extra pointers which will come through. All that are part of bigger problems. So straight away we'll learn 1 or 2 extra concepts with the help of bigger questions. There's an RTP question. So let's take up this. Excuse me. HMR is considering replacing a manually operated old machine with a fully automatic new machine. Old machine was fully depreciated for tax purpose, but it has a book value of 2,50,000, but it is fully depreciated. That means if it is fully depreciated means can you claim any extra depreciation or over? Okay. The machine has begun causing problems with breakdowns and it cannot fetch more than 40,000 if sold in the market currently. Okay. It will have no realizable value after 10 years. So if you don't sell it now, but if you sell it after 10 years, then its salvage value will become 0. The company has been offered 1,50,000 for the old machine as a trade-in for new machine. So if you buy a new machine, that vendor is saying old machine, I'll pick it up by paying 1,50,000. Great. That new machine has a price of how much? 6 lakh rupees before allowance for trade. Meaning new machinery ka value is 6 lakh. Okay, if you sell the old machinery to that vendor, he will give you 1,50,000 extra. That means net cost will become 4.5 lakh. 6 lakh is the value of new machinery. Old machinery will fetch you 1.5 lakh. So net cost will become 6 lakh minus 1.5 lakh, which will be 4.5 lakh. The expected life of the new machinery is 10 years and salvage value will be 35,000. The company follows WDV method depreciation at 10%, but for tax purpose, straight line method is used. Okay. Sir, okay, 1 minute, I'll tell you that. Straight line method is used. Okay. Then working capital of 50,000 is needed and it will be released at the end of 10th year. So when you're working on these problems, working capital initially it will be considered as an outflow. At the end of the project, you will consider it as an inflow. Because whenever you're doing a particular project, sir, you need only money for your fixed assets or you need money for day-to-day affairs also. Let's say we are starting CA coaching. To start CA coaching, we need to buy laptops, so TV, AC, etc., etc. But at the same time, we also need to pay rent, electricity, salary, staff. All that is what, sir? Day-to-day expense. That means you need money not only for your fixed asset, but also you need money for your day-to-day business. That means you have to invest. So initially, working capital will be considered as an outflow. But once the project is over, you tell me now. I've invested some money into rent. Will I keep it as it is or I would like to recover that also? If I'm doing a particular project, means every cost I would like to recover. So hence at the end of the project, working capital will be considered as an inflow. That's what they're trying to say over here. Working capital will be needed. It will be released by the end of 10th year. It will be released means indirectly they're asking us to consider it as an inflow. That any which way, even if they don't tell, we will anyway be doing the same. Given below are the expected sales and the cost from both old and new machinery. Old machinery ka output is 60, new ka is 18,000 or 80,000. Selling price is same, 18 per unit. Annual operating hours is 2,800. Material cost they've given, labor cost they've given, indirect cash cost they've given. Okay. From the above information, analyze whether the old machinery should be replaced or not. Opportunity cost of capital is 10%. So basically your discount factor they have told it is 10%. Income tax rate they are saying is 30%. Further assume book profit is treated as ordinary income for tax purpose. Also estimate IR. First do the decision and then they are saying extra fitting also calculate off. While you're doing so much, one extra activity of IRR also you do it off. They're saying calculate or take only 3 decimals. That is good enough. When question says take only 3 decimals, we should definitely take 3 only. Okay. If they don't tell 3, 4, 2, it's fine. Usually in our class we used to take 4. But that's fine. I'll leave the call to you. But if question says something, do that only. Now in these sort of decision, replacement decision, no, you have old machinery ka data, you have new machinery ka data. In this problem, no, we work out something called under which approach? Incremental approach. That means we don't want, normally how do you find out NPV? Because the decision is usually based on NPV. How do you find out NPV? Present value of cash inflow minus present value of cash outflow. Now we have 2 machinery. No? One way to do the data is calculate NPV of old machinery. Calculate NPV of new machinery separately. If new machinery ka NPV is higher than old machinery ka NPV, then you will replace it or reject it. Better way which our ICA study material follows in almost every problem is incremental approach. Incremental approach means now we don't want cash inflow, we want incremental cash inflow. Meaning compare the cash inflow of old machinery. Let's say new machinery is giving a cash inflow of 1 lakh. Old machinery is giving a cash inflow of 80,000. That means compared to old, new one is giving extra now. Compared to old, is new giving extra? Yes. How much extra? 20,000 extra. That only we call it as incremental. Now you take only incremental data and do your calculation. So instead of inflows and outflows, we will calculate incremental cash inflows and we will calculate incremental cash outflows. That means we will get NPV or we will get incremental NPV. We will get incremental NPV. If this incremental NPV is positive, then accept, meaning replace the old machinery. Otherwise, do not replace it. That way we need to work it out. Okay. Now each data we need to work out on a incremental basis. First, what is the cost of new machinery, sir? If you buy a new machinery, means how much it will cost? 6 lakh rupees it will cost extra. So the 6 lakh, just observe, that's good enough. 6 lakh rupees is an inflow or outflow? The 6 lakh rupees. You have to buy a new machinery. So it's an outflow. Correct? But is this the only outflow? No. But if you, now you think, if you are buying a new machinery, means what will you do with the old machinery? Sell it off. How much can you sell this for? How much is that vendor ready to give you? 1,50,000. That means you tell me this 1,50,000 is outflow or inflow. So 6 lakh is an outflow, but 1.5 lakh is an inflow. Agreed? Okay. So that means what is the net outflow? 6 lakh minus 1.5 lakh, which is 4.5 lakh. Usually that is the thing. But in this problem, one culprit they told is further assume book profit is treated as ordinary income. What is this book profit they're talking about is old machinery, no sir. Is it fully depreciated? Yeah. Old machinery is fully depreciated. That means book value as per tax record is what? 0. But you sold it for how much value? 1,50,000. Book value is 0 as per tax, because you have to pay tax based on accounting profit or taxable profit. Taxable profit. As per tax, old machinery is fully depreciated. So book value is how much? 0. But how much did you sell it for? 1,50,000. So you made loss or you made profit? Profit. And what are they telling? On profit, you have to pay tax. You have to pay tax. You don't apply LTCG, STCG and all. They're asking us to treat it as ordinary income. And ordinary income are taxable at what rate? 30%. How much is the profit you made on old machinery ka sale? 1,50,000. How much tax you need to pay? 30%. So calculate 1,50,000 ka 30%. 45,000. So 45,000 tax you need to pay. That means what is the net outflow? 6 lakh is outflow. 45,000 tax is outflow. 1,50,000 is cash inflow. That means net mein how much are you getting? 4,95,000. What is this? It is incremental cash outflow. Got the first data now? Okay. So every problem, no matter how big or small it is, 1 or 2 working notes will be very straightforward and very simple. So don't skip the problems entirely. Read it little bit at least, because I do understand that some of you may be time pressed and you may not have time to go through all the questions. Even if it is completely new, at least 10 to 20% of that question will be something which you should be able to manage. At least try to manage that. This and all we have done. You and all full. Okay. So working note number 1, we got it. Incremental cash outflow. Next, what do we need? Inflows we need. But before that, check. Sir, old machinery, does it have any salvage value? If you continue to use the old machinery for 10 years, what will be the salvage value they told? Somewhere there only you don't know. It will have no realizable value. So what is the salvage value of old machinery if you continue to use? 0. But however, new machinery, does it have salvage value? Yeah. New machinery ka salvage value is 35,000. Old machinery ka salvage value is 0. That means, did you get incremental salvage value? Yes. How much is incremental salvage value? 35,000. Everything we need incremental. Comfortable? Work. Next, find out every year ka net cash inflows. How, sir? Have they given some problems where directly they'll give you? But here have they given or missing? Missing. Here just check, sir. Did they give you cash inflow data or they started from sales? If they started from sales, means we need to work from the beginning. What is that? Sales minus variable cost contribution, less fixed cost, EBIT. Like that we have to go. Arrive till profit after tax. Some problems where directly they will give you profit. So that means aram se you can take it, maybe 1 or 2 extra steps if you do, good enough. But here they have given data of profit or they have given data of sales. Sales. That means you have to start with sales and arrive at profit. So let's calculate. How much is the sale value of old machinery? How many units can you produce? 60,000. Fatafat, keep your calculator, everybody. 60,000 into 18 you do. What is the selling price? Just calculate and we go on ticking. How much is the sale value? 10 lakh? 80,000. Okay. What is the units you can produce for new machinery? 80,000. What is the selling price per unit? 18. So these two come multiplication you do. How much? 14 lakh? 40,000. Correct? All right. Let's not do incremental for everything. We'll do it at the end. That's good enough. Fine. All right. This is about sales revenue. Any other revenue is there? No. Next, they've given the cost. What is the material cost for 1 unit? 5 rupees. How many units are you producing? 60,000. So 60,000 into 5 you do. How much is that? 3 lakh. Okay. 80,000 into 5 you do. How much is it? 4 lakh. So this is your 3 lakh and this is your 4 lakh. Okay. Next, what is the next one we have? Labor cost. For 1 hour, how much labor cost you're paying? 50 rupees. How many hours you have to use old machinery? 2,800. For 1 hour, 50 rupees. For 2,800 hours, how much is the cost? 1 lakh? 1,40,000. Okay. New machinery. How many hours we have to use? 2,800. And for 1 hour, how much we need to pay? 75. 2,800 into 75 is how much? 2,10,000 rupees. Okay now. All right. Any other cost they've given? They've given indirect cash cost, which is 1 lakh and 1,75,000. That is directly given to us in the problem. So we'll take off that. 1 lakh and 1,75,000. Any problem? So they've added up all the cost and they've got total cost. Sales, you know, Total cost, you know, from sales, if you deduct cost, what are you going to get? Profit. But this is a profit before depreciation, because machinery means you have to calculate depreciation. So they have calculated profit before depreciation. Basically, sales minus cost they have done. Can they trust that number? Now, what do we need to consider? Depreciation. Old machinery, will it have any depreciation, or it is fully depreciated? It's fully depreciation. So that means what is the depreciation on old machinery? 0. What about new machinery? You bought it for how much value? 6 lakh. What is its salvage value? 35,000. For how many years can you use new machinery? 10 years. So what is the depreciation on new machinery? 56,500. Old machinery ka depre is 0. New machinery ka it is 56,500. That means you are getting extra depreciation. So from profit before depreciation, if you deduct depreciation, what are you going to get? Profit before tax. Now onwards, we will take the incremental number. I don't need the exact all this data. Directly we'll start with incremental. What is incremental profit before tax? 58,500. Okay now. Now what is the tax rate, sir? 30%. Reduce that. 58,500 into 30% is how much? 17,550. How much is profit after tax? 40,950. Comfortable, everybody? 40,950 is profit after tax. We can't take this and do the calculation. We can't take this and do the calculation. Why? If you remember payback period also, what is the formula I told? Initial investment not divided by PAT. I did not say initial investment divided by PAT. What did we say? Initial investment divided by annual net cash flow. So all this decision is based on cash flow data. It is not based on profit. So why can't we use P&L? Because P&L will include cash data also, non-cash data also. Like perfect example is depreciation. Is depreciation an expense? Yes. Due to expense, what happens to your profit? Reduces. But due to depreciation, profit may have reduced. Did cash go out? Suppose you charged 1 lakh depreciation. Did that 1 lakh rupees cash go out, or this is only bookish expense? Bookish expense. But for our decision making, we don't want profit. We want only cash flow. Hence, first, don't take directly profit after tax. Last step, what you have to do is add back depreciation. So why do we deduct then initially? You will deduct the depreciation because depreciation is an expense. On that expense, you will get tax benefit. So to get tax benefit, initially we will reduce. Then since depreciation is a non-cash expense, at the end, simply you need to add back because it's a non-cash expense. So if you take profit after tax and add back non-cash expenditure, that added number only we call it as annual net cash flow. Okay, now sir, everybody. So every year, how much is the net cash flow here? 97,450. Comfortable? Now take this data and work out your NPV. Okay. Now NPV. How much is year 0 ka investment? To buy new machinery, should we have to work out initial investment or already done? Already done. What is your initial investment, sir? 4,95,000. Only 495 or one more? Can somebody point out one more? Let me see who remembers this. Is it 495? I'll show you the working again. Perfect. I can't take 495 because this is 495 is towards the new machinery. Do we have any working capital in this problem? Yes. How much is the working capital they told in the question? Working capital is 50,000. That means initial investment will be 495 or 50,000 more. Where is that part? Yeah. 1 second. Yeah. 4,95,000 plus 50,000. What is this 50,000 for? Working capital. Do not forget that. Initially, working capital is considered as an outflow. At the end of the project, you will consider working capital as an inflow. So that means initial investment will be 495 plus 50, which is 5,45,000. Should we have to find out present value of this, or it is already there on present value terms? So discount factor for year 0 is always 1. Got that. And every year, how much are you getting as annual net cash flow, sir? 97,450. How many years is this project alive? 10 years. Now, one way to do it is have 10 columns. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Or we are not crazy. Every year cash flow is same. If every year cash flow is same, that means instead of taking PVIF, we will use PVAF. So every year from year 1 to year 10, you will get a cash inflow of 97,450. At 10%, find out PVAF for 10 years. So do 1 divided by 1.1, press equals to button 10 times, and then press GT button. How much are you getting? 6.14. So multiply this, you're going to get the present value of cash inflow. This is 1 year ka present value of cash inflow or all the 10 years put together? All the 10 years put together. Then at the 10th year, some extra dramas will happen. This is what we used to remind ourselves. So do not forget salvage value. Do not forget working capital. These two will come as an extra. So why can't we add this to above number? No. 97,450, you will get it every year from year 1 to year 10. But salvage value and all, you will get it every year or only once. Only once. That too at the end of the project. Here project ending life is 10 years. So in the end of 10th year, how much is the salvage value of new machinery? 35,000. Consider. Then at the end of 10th year, how much is working capital released? 30,000. Consider here now. This is what, sir? This is PVAF or PVIF? This is PVIF at 10% for 10th year. So you do that and you will get the present value. Yes. So finally you will get the NPV because outflow is also considered, inflow is also considered. How much is NPV? 86,543. Negative or positive? Positive. So what is the decision rule? If NPV is positive, go ahead and accept the project. That's all is the decision. Done now. They only asked NPV or also IRR? Also IRR. One trick is you already calculated at 10%. No, for IRR we need two rates. At 10 we have already done. Maybe let's try it out at 20% because number looks a little higher. Okay. At 20% again I've discounted and I've got what number now? Same data, same number now. Instead of discounting at 10%, you discounted at 20%. How much are you getting as NPV? 1,22,070. So is 20% my IRR? No. If 20% was IRR means NPV should have become 0. And 10% is also not IRR because at 10% are you getting 0 or 86,000? That means NPV is somewhere between 10 and 20. How do you find out IRR? Plug the data in the formula. That is this formula. Plug the data and you'll get IRR to be 14.14%. Manageable. That's all. Okay, give me a quick walkthrough of this question once again. These are quite popular questions. I don't have time to cover every question. So that's the reason I picked a few questions I feel has a higher chance of coming and that I want you to learn properly. We can't solve everything because if I solve everything, half an hour this only will take. But time allocated for revision per topic is only on an average 45 to 50 minutes. I've crossed this big time, but that's okay because these are little bigger topics, has higher weightage. So time I'm not considering for this one as well as for the next topic. So now, whenever they give you replacement decision, you have to work with existing data or incremental data. Incremental data. So you want incremental cash inflow as well as incremental cash outflows. Okay. So that's what we did. So when you're buying a new machinery means old machinery you will sell. That means there will be an inflow as well as there will be an outflow. Okay. And when you sell an old asset, you will also have to pay some tax. Here may book value of that asset as per tax was 0, but you sold it for 1,50,000. That means you have to pay tax on 1,50,000 profit. So you have to consider those three elements to find out your initial investment. Second one is do not forget to consider incremental salvage value. Salvage value of old machinery was 0. New machinery was 35,000. So incremental salvage value is 35. Then every year ka cash inflow you need to do. We don't want profit. We don't want profit after tax. We want annual net cash flow. How do you find out net cash flow? Till profit after tax, same working. Last step, what do you do? Add back non-cash expenditures like depreciation, amortization, etc., if at all they're there. So then you will get annual net cash flows. Okay, that you will consider for old and new separately or incremental. Incremental. That's all. Plug in that numbers and accordingly do your NPV and accordingly you can take your decision. Now can I move on to the next question? Great. Excuse me. Last 3 weeks has been non-stop 7 hours, 8 hours classes. My throat is kind of giving up. It was especially final and I used to start at 10 and go up till 5:30s and all. So continuous. So even advanced accounting also. Advanced accounting syllabus, that is like another marathon. Big, huge syllabus. Every standard they put off now. Okay, that's become like earlier it was 2 subjects. So for me also it was easy. Now it is like everything in one. So that also has become a huge topic only. Unfortunately for me, whatever subject I've taken, it's all lengthier side only. Okay. I took up accounts thinking, nothing will change. Oh, it'll be very easy for me. But looks like institute is putting blade Allah. They're adding content after content after content. Okay, nonetheless. Maybe after today I'll get some break. Much needed break. I will take some break. Yeah. Okay, let's go for next question. NC Limited is considering purchasing a new machinery to increase the production facility. At present, it uses old machinery and can process how many units? 5,000 units. This is an MTP question, by the way, latest MTP. So, how many TVs can you produce using old machinery? 5,000. And this 5,000 is not total, it is per week. Using old machinery, you can produce 5,000 TV every week. NC, the company, could replace it with new machinery, and the new machinery has a capacity to produce 15,000 units per week. New machinery ka cost is 100 crore. It requires a working capital of 3 crore. So the moment you see working capital, tell me, sir, what and all? Initially, you will consider it as an outflow, meaning you will consider it as a negative. At the end, you will consider it as an inflow, meaning you will take it as a positive number. Okay. Next, New machinery ka salvage value is 20 crore. Perfect. Company expects a demand for TV to be 10,000 units per week. Okay, stop there only. Currently, how many units are you producing? 5,000. But new machinery has a capacity to produce how much? 15. It has capacity to produce 15. But do we have the capacity to sell 15? No. Demand is only how much, sir? They said demand is only 10. That means you will consider 15 and do the calculation, or only 10 and do the calculation? Only 10. Though you have the new machinery has a capacity to produce 15, we can only, demand is only 10 means we will only utilize it at the new machinery and produce only 10. That means this 15,000 is irrelevant for as far as this concerned. Things are concerned. Okay. All right. And each TV will sell for 30,000. Profit volume ratio is 10%. How do you get profit volume ratio? Contribution divided by sales into 100. That means indirectly can I say contribution is 10%? Because PV ratio is nothing but contribution upon sales into 100. 0.1 is nothing but 10%. No? So contribution indirectly they're telling is what, sir? 10% of sales. Like that they have told. Okay. The company works for 56 weeks. Sir, they're crazy, sir. In a year there are only 52. One, don't question the better dialogue is don't question the question, or probably why they have arrived at 56. Sometimes no, many companies works on a double shift mode. Morning shift as well as night shift. That way they're saying they're able to use it for more capacity. So still take, it's not a typo. Don't take, I will only use 52 and do the calculation. They have given 56 means 56 only you use. Okay, additional fixed cost excluding depreciation is 10 crore. Okay, that is your incremental additional data they're talking about is incremental fixed cost. The company is subject to 40% tax rate and after tax cost of capital is 20%, meaning your discount factor is 20%. Depreciation rate is 25% for both taxation and accounts, but you're using what method? WDV method. This is crazy. The reason is, if it is straight line method, every year ka depreciation is same. So easily you can compare and you can do everything in one working note. But even if it is WDV method, no, dabba fellow, depreciation goes on changing. That means profit every year also will go on changing. That means we need to have a separate working note first for depreciation. And there are multiple ways to present this. I've showed you one way in class. Probably I like to stick to the same thing here also. But you can follow other methods also. Sir, working notes, no sir, there is no hard and fast rule that you have to present it in any particular format. You can do it in the way you feel comfortable. But final answer should match. That's all is a crux. So they're using WDV method and they're saying so no salvage value and all that. And advise whether the company should replace the machinery, and they're saying take decimals only up till 2 units. Okay, first one. Sir, currently what is the production? I want to know basically by going for new machinery, will I get some extra profit? Forget about depreciation. Depreciation is same every year or changes? Changes. That means I will first try to calculate what is the profit before depreciation. Depreciation may change, but profit before depreciation every year will be same. No. First, at least let's calculate that. So currently from old machinery, how many units can you produce? 15,000, 5,000. From new machinery, how much capacity it has? 15. But demand, how much is there? 10. That means is 15 relevant or irrelevant? Irrelevant. So we only produce how much now? 10,000. Old machinery has a capacity to produce only 5. New machinery, you can produce 10. So that means is there extra you are producing? Oh, yes. How much extra units you will be able to produce and sell? 5,000 more units you will be able to sell. Comfortable? This 5,000 is the value or units? This is a 5,000 TVs extra you can produce and sell if you go for new machinery. Okay. Sir, one way is don't be misled. Like normally, how do we find out profit before tax? We'll start with sales. But here sales data and all. Ideally, what you need is profit before depreciation. Either you can start with sales or directly you can start with contribution or EBIT. Anything is okay. So don't have a fixed number that I want to start only with a starting number. Here directly contribution is given. No. How much is contribution? 10% of sales. Directly given or they gave PV ratio? They gave PV ratio to be 0.1. That is nothing but 10%. If PV ratio is 10%, indirectly they're telling contribution is also 10% on sales. Sir, if you go for new machinery, how much additional sales you can make? 5,000. This is the total or incremental? Incremental. And we want total or we want incremental? Incremental. You got incremental? How much incremental units you can sell? 5,000. And how much extra incremental contribution you're going to get? 10%. So 5,000 ka 10% you do. How much is that? 500. Yes, sir. On one TV, you will get an extra contribution of 500. On one TV, you'll get an extra contribution of 500. Sir, are you producing only one TV? No, sir. In fact, sir, rather this is the TV. What is the TV ka selling price? Each TV ka selling price, how much they told? Somewhere they told, no? Yeah, each TV has a selling price of 30,000. So on one TV, it is how much? 500. How many TV? What is the selling price of each TV? 30,000. And this 30,000, sir, this 500 and all is a production for the whole year or 1 week? This extra 5,000 that you're producing, no, sir, it's for one day, one whole year or 1 week. They gave all this data in 1 week. Just check 5,000 units per week. If you go and buy new machinery, I'll tell this once again if you're confused. If you buy new machinery, how much TVs you can produce in a week extra? Existing you can produce only 5, but with new machinery you can produce 10. So how much extra TV can you produce every week? 5,000. Comfortable? 5,000 TVs you can produce extra. So if you're producing 5,000 extra means, will you get same amount of contribution or extra contribution? Extra contribution. How much is contribution? 10%. Or if you want it like this only you do. How much extra TVs you can produce? 5,000. What is each TV ka selling price? 30,000. Correct? And this 5,000 TVs you will produce in the whole year or 1 week? 1 week. And a year mein how many weeks they told? 52 ala 56. That means what is the extra sales? Like this only if you want you can calculate. How much is the extra sales? This one. 5,000. 84 ala 840 crores it should be mostly. Sure, right? I have taken this number as 84 crores, no? How? No, once again. 840 number you tell, I think whole calculation will change. 840 crores, okay, fine. This is your extra sales. Okay, extra sales. How much is the extra contribution you're going to get? What is contribution? Contribution is 10% of sales. 840 crore ka 10% is how much? 84 crores. That's how. Is that okay? Either you can find out extra sales and from that you can get extra contribution, or directly you can start with contribution only. How many units like this? How to do this is, how many units extra you're selling? 5,000 units. How much is extra contribution? 10%. So 500 ka 10% you calculate. How much is that? 500. Is that okay? That 500 is what? Number of TVs. It's a contribution per TV. What is each TV ka selling price? 30,000. And how many TVs you can produce in this? Is this a yearly data or weekly data? Weekly. So multiply by the number of weeks. You'll get the same thing. Either first calculate extra sales. Using that you can calculate extra contribution, or directly you can calculate extra contribution like this. Your choice. Done with everybody? Okay, no? They've given extra if you go with the new project or new machinery, you will get an extra contribution of 84 crore. We want extra contribution or we want extra profit? Profit. So have they given any extra cost? Check. Yeah, there is an incremental fixed cost. How much? If you go and buy the new machinery, you have to increase. They said use how it is incremental. Check the word. What have they told? Additional fixed cost. If you go for new machinery, you will incur an additional fixed cost of how much? 10 crore. So from contribution, deduct additional fixed cost. How much is that? 74 crores. Any other data they have given? No. That means this itself is what? Profit before depreciation. This number will change every year or same every year? Same every year. Done. Profit. Depreciation will change. But this profit before depreciation every year is same. Comfortable. Now, but the problem is depreciation same every year or it will change? Change. Now we need to have the same format I used to do in class also. How much is the life? How many years life the project life is they told here? At the end of 5th year they are saying, no? That means this project will run for how many years? 5 years. So I've had 5 years ka call. Done. Sir, initially, what is the new machinery ka cost? How much will the new machinery cost, sir? 100 crore. Okay, 100 crore is the value of new machinery at the beginning. What is the rate of depreciation on new machinery? They said 25%. Somewhere they told you. What is the depreciation rate? 25%. So what will be depreciation for first year? 100 ka 25%. How much is that? 25. Any okay? Any problem? Good. So how much is profit before depreciation for first year? 74. Will this data change or every year same? Every year same. Copied it. But depreciation every year will be same or goes on changing? Goes on changing. So first you bought the asset for 100 crore. You will get an extra depreciation of 25%. 100 ka 25% is how much? 25. So deduct depreciation, sir. How much are you going to get? Profit before tax. How much is that? 74 minus 25 is how much? 49. Okay. How much tax rate this company is subject to? 40%. So 49 ka 40% is how much? 19.6. So profit after tax will be how much? 29.4. We want profit after tax or we want annual cash flow? Annual cash flow. How do you get annual cash flow? Take profit after tax and add back depreciation. That's what I've written here. 7 is equal to 6 plus 3. 6 is your profit after tax, 3 is your depreciation. These two if you add, what are you going to get? 54.4. Same exercise you have to do it for 5 years. Can we do that? Now, to calculate second year ka depreciation, we first need opening WDV. How much was the first year ka cost? 100. How much it got depreciated by? 25. That means what is WDV at the year 2 beginning? 75 crore. What is the rate of depreciation? 25%. That's what I've expressed in formula here. 3 is equal to 1 multiplied by 25%. 1 is the 75. 75 ka 25% is how much? 18.75. Repeat the same step and you will get net cash flow how much? 51.9. Okay, now third year also same. Fourth year also same. Manageable. I'm just revising. Okay, now fifth year, 1 second, hang on. Sir, excuse me. Normally, I think this is one you need to keep in mind. Whenever there is a WDV method, this is not FM concept, this is taxation concept. Sir, tax ka depreciation works on block method. Tax ka depreciation works on block method. You will calculate depreciation as long as you have the block. If block is not there means you will either calculate it as STCL or STCG, short-term capital loss or short-term capital gain. Now, in WDV method, they don't assume in fact, in many of the problems, there is no clarity whether block is there or block is not there. So, in exam, what you do is, if there is straight line method, if it is straight line method, don't bother about STCL, STCG. However, if it is WDV method, consider short-term capital loss or short-term capital gain. This is how you can do it in FM question, because in many questions, they don't tell whether block is there or not, but they apply it like this. On all SLM method, they are not applying, or we will also not apply. Only on WDV method, we will think that block is not there and calculate STCL as in short-term capital loss or short-term capital gain. Now, which method of depreciation goes here? The straight line method or WDV method? WDV method. Now, last year, you will tell me the treatment. WDV method. So, block is there or not there? Block is not there. If block is not there in the last year, means last year, will you calculate depreciation or no depreciation? No depreciation. This is FM rule, accounts rule or tax ka rule? Tax ka rule. In WDV method, we assume that the block is not there. So, last year, will you calculate depreciation? No. But what is opening WDV? 31.64. Okay, yes. How do you calculate short-term capital loss? Book value is 31.64. You don't calculate depreciation. How do you get STCL? Perfect. You will take the book value minus salvage value, or that only in tax purpose you used to call it as sale value. Here they will not call it as sale value, they will call it as salvage value. Value of the asset is 31.64. Does the new machinery have salvage value? Yeah. In some problems, I think in the question, in the class problem we had done, salvage value was 0. Hence the entire WDV we took it as short-term capital loss. But in this problem, you just check, does the new machinery have salvage value? Yes. How much is the salvage value? 20 crore. What is the WDV in the last year, sir? 31.64. How much can you sell it for? 20. That means how much is short-term capital loss? 11.64. So don't calculate last year made depreciation, but account it as STCL. Because value is 31.64. You sold it only for 20 crores. Means it is a gain or it's a case of loss. It's a case of loss. That only we call it a short-term capital loss. But the treatment for depreciation and short-term capital loss as far as this decision is same. Why? On depreciation also you will get tax benefit. On short-term capital loss also you will get tax benefit. Because short-term capital loss means you will carry it forward and utilize it. That means in future your tax will be more or less. That means on STCL also you will get tax benefit. So that means the treatment is ditto, ditto, ditto. Instead of depreciation, here you will account it as what's the short-term capital loss. How much value? Full WDV? No, WDV minus salvage value. Don't say in the class you did not do this. In the class salvage value was 0. Hence entire WDV I have accounted as STCL if you open the class problem. Okay now, but here salvage value is 20. So hence this will become 11.64. Repeat the same step and you will get profit after tax. Will you take PAT or you will add back? Add back. What do you will add back? Don't say just depreciation. You will say you will add back depreciation and STCL. It's anyway there in the same column. Add it back. You will get cash net cash flow. How much, sir? 49.66. Yes, sir. This is your cash flow for respective years. Done. But at the last year, you should not forget two more things. You should not forget two more things. What is this? One is a working capital. Another one is salvage value. If you want, you can bring that into this working note only, or you can bring it in your NPV calculation. It is fine. Your choice. If you are a forgetful person, you bring it up here only. So here, do we have working capital? Yes. How much is the working capital? 20 crore. Do you have salvage value? Yes. How much is that? In fact, salvage value was 20 crore. What is the working capital they told? Working capital is somewhere that we did, no? Where is that? Here. Working capital is 3 crore. Both we have considered. So working capital and salvage value put together is how much? 23 crore. That means every year ka net cash flow is this. Once you have got this, remaining is your straightforward NPV calculation. The crux is this. Is that okay with you? All right. Okay. Once quickly we'll revise this. This is the most important working note. Okay. Rest everything is all right. So one quick summary of this question. So what is it here? Using old TV, you could have produced only 5, but with new TV, you can produce 10. That means you will get some extra sales. We need to go with extra sale, or directly we can do extra contribution. We calculate extra contribution, and there was some extra fixed cost also, which we consider. Then another one is what, sir? Profit before depreciation every year will change or same? Profit before depreciation every year will be same. But since we are depreciating this asset under WDV method, every year ka depreciation will go on changing. That's the reason we're having one column of 5 columns. 5 columns. So go on depreciating, usual way, same thing, no change. Okay. But the last year, if you're following WDV method, what will you do? Last year, you will assume that the block is not there. If block is not there, what do you do? Entire WDV, will you take it as short-term capital loss? No. WDV minus salvage value, you will take it as short-term capital loss. And is the treatment for depreciation and short-term capital loss different or same? Same. So that means whatever you have written in terms of numbers and all, everything will be same. Bring that in. And in the last year, extra checkpoint for you is do not forget the salvage value and release of working capital and work out the NPV. Here, finally, you got the NPV to be 59.12. So NPV is positive, means what you can do? Replace that. Okay. If you check the solution, there is a slight difference because one problem, I think MTP, there is an error. They calculated on capital loss, short-term capital loss, they calculated at 30%. Typo, it should have been calculated at 40%. That's the reason slight answer, there is a slight change. It's fine. Don't worry about that. But overall, did you get the steps of this? Okay. This is another, or these sort of questions are popular in examination. Replacement decisions are basically quite popular. Can I move on to the next one? There is one more concept which I would like to address through one more question. That's pretty much sums it up. So simple question only. Check this. A hospital is considering a purchase of a diagnostic machine. It's a class problem, study material question basically. Machine ka cost is how much? 80,000. Life of the machinery is 8 years. Salvage value is 60,000. Great. The annual operating cost of the machinery is 7,500. Inflow or outflow? Outflow. It is expected to generate a revenue of 40,000 per year. I mean, this 40,000 is what? Inflow. Changing or same every year? Same every year. Presently, the hospital is outsourcing the diagnostic work and it is earning a commission of 12,000 per annum. Currently, one hospital, they are whatever X-rays and other things, whatever diagnostic work they are getting, are they doing it on their own or are they giving it to somebody? They're giving it to somebody. Are they giving it to somebody and letting go, or out of this they're generating some income? Income, obviously, we say no, referral bonus we say. So hospital is saying, diagnostic center, since I am referring my patient to your center, give me commission. How much commission they are earning currently, sir? 12,000 rupees one time or every year? Every year. Now they are buying a diagnostic machine. Sir, if they buy the diagnostic machine, now will they, for X-ray and all, will they send it to some other diagnostic center or they themselves will do it? They themselves will do it. This we call it as opportunity cost. This we call it as opportunity cost. Opportunity cost means the cost of letting go of something. Like here, I used to give the example. Right now, I am teaching. Can I work in corporate? No. If I had worked in corporate, I would have got salary. That salary, am I getting now or I am letting go of that? Letting go of that. That is your opportunity cost. Now here, what is the hospital letting go? Commission. That is nothing but your opportunity cost. What we should do for opportunity cost? Test your memory and tell me. Opportunity cost, you will treat it as an outflow. Opportunity cost, you should consider it as an outflow because you are not getting something. No? One inflow you are not getting. Till now, you used to earn a commission every year. How much? 12,000. That inflow is coming to you now, or henceforth it will not come. Henceforth it will not come. One inflow, if it is not coming, means you will treat it as what, sir? An outflow. Like that. Is that fine with you? So the whole crux of this particular question is, if there is any opportunity cost, it should be considered as an outflow. So which year outflow? You are getting this commission only once or every year? Every year. That means this should be considered as an outflow every year. Is that okay? How to work this out? It's a very straightforward question. You have to recommend, should we purchase the machinery or not? So we have here, do we already have a machinery here? So is it a replacement decision or purchasing a new asset? It's purchasing a new asset. So should we have to use incremental approach or normal approach? Normal approach. So first one, excuse me. 1 second. First, let's calculate every year ka cash inflows. So if you buy this machinery, will it generate some revenue? Yes. How much revenue it generates? 40,000 every year. That is your inflow. But if you have a machinery means, is there any outflow associated with this machinery? Yeah, there is an operating cost. How much? Every year there is an operating cost of 7,500. So 40,000 is inflow, operating cost is 7,500. So what is your, it's basically sales minus operating cost. How much is that? 32,500. So this you can call it as profit before depreciation. Profit before depreciation. So machinery means obviously it will be depreciated. So how much is the value of that asset, sir? How much did you buy it for? 80,000. What is the salvage value? 6,000. What is the life of the asset? 8 years. How much is the depreciation? 80,000 minus 6,000 divided by 8. That gives you how much depreciation every year? 9250. So what is profit after depreciation? Profit after depreciation only we call it as profit before tax. So how much is that, sir? 23,250. How much is the tax rate this particular company is subject to? Somewhere they must have told. Where is that? Here. Tax rate is 30%. So deduct tax at the rate of 30%. You will get how much profit after tax? 16,275. Just concentrate on the steps. That's all. You don't have to calculate every number. So far, are we good till here? Whatever data of inflow and outflow they have given, income and expense they have given, I've just plugged in here. Okay. Will we take profit after tax and calculate NPV, or we want net cash flows? Net cash flow. That means last way one step. What is that? Add back depreciation. How much is add back of depreciation? 9250. So how much is your net cash inflow? 25,525. Usually we take this and do the NPV. But here, is there any opportunity cost? Yes. How much is the opportunity cost? 12,000. What is this? That earlier you used to get a commission every year of 12,000. Earlier you used to get an inflow of 12,000 as commission every year. Now are you getting or you'll not get? Once you buy the machinery, you'll not get any commission from the diagnostic center. So that means this is a decrease in inflow. That only I'm calling it as outflow. Or you can also simply treat it as decrease in inflow. How much is the net inflow here, sir? 25,525. Should we take that or should we reduce it further? We should reduce it further as how much, sir? 12,000 rupees, reduce it. So 25,525 minus opportunity cost of 12,000 you do. How much is your net cash flow every year? 13,525. Take this number and work out your NPV. If NPV is positive, accept. Otherwise, reject. Is that okay? Comfortable or going fast? What is it? Or manageable? Everybody. Okay. So how many years is the asset is going to last for? 8 years. And every year net cash inflow is changing or same? Same. So should we have to use PVIF or PVAF? PVAF. So let's do calculate NPV using PVAF. Don't worry about study material. They'll present in different format. As I said, format, multiple ways are there. Everything is acceptable. We'll stick to one because when you have one sort of presentation, your mind runs faster. The moment you change a little bit here and there, no, that hands will not move that freely. So even if it takes 1 or 2 minutes extra, if you're used to one particular format, I suggest stick to that only. Do not change it at the last minute. So year 0, how much to buy the machinery you have to spend? 80,000. So outflow. Every year from year 1 to year 8, how much inflow are you going to get? 13,525. I've taken PVAF here. That's all. Or last year, we should not forget 3 things. Last year, in fact, 2 things you should not forget. What is that? Salvage value, release of working capital. Here, do we have salvage value? Yeah, there is a salvage value. How much? 6,000 rupees. The end of 8th year, you'll get a salvage value of 6,000. Okay. There is no release of working capital. You can ignore that. So when you calculate NPV, you're getting NPV to be, I think this is negative. This is my bad. Okay. This is not positive. This is negative. My calculation mistake. It's okay. My sign mistake. That's all. So NPV is positive here or negative? So NPV is negative means you will accept the project or reject the project. Reject the project. Here they also asked you to calculate profitability index. PI. How do you calculate profitability index? Present value of cash inflows. That is these two. Divided by present value of cash outflow. So these two addition if you do, you're going to get here. That's a numerator. Divided by present value of cash outflow, which is 80,000. So how much are you getting it as profitability index? 0.9. What is the decision rule? If profitability index is greater than 1, accept. If it is lesser than 1, reject. Here NPV is negative, profitability index is lesser than 1. So should we replace the machinery or should we not? We should not replace the machinery. That's all is the overall crux of this particular question. So with this investment decision topic, we have completed. Yes, people, welcome back after that short break. So the next topic that we'll be revising is working capital management. Okay, so how do you get working capital? Working capital is nothing but current assets minus current liability. So when we say working capital management, basically we're trying to manage current assets and some current liabilities. So why do we need to manage current assets and current liability? Because it affects liquidity and profitability, we say. Working capital is all about balancing act between liquidity and profitability. So what do I mean by that? So let's take some component. Is inventory a part of current assets? Yes. I used to give you in my regular class the tomato example. Do you remember? Let's say a tomato dealer used to store 100 kgs of tomato normally. Every day he used to store how much? 100 kgs. Okay, one fine day he decided to store 250 kilograms of tomatoes. What is the advantage? From 100 kgs, he's raised his inventory level to 250. Advantages, he'll be able to keep up the demand. Let's say earlier, no, one person came with an order of 150 kilograms. One person came to this tomato vendor and told him, I want to buy tomatoes of 150 kgs. Earlier, do you think he will be able to fulfill that demand, or he'll not be able to? He'll not be able to, because he has only inventory of 100 kgs, but the requirement is 150. So if he is storing more, means he'll be able to keep up with the demand, meaning he'll be able to sell more. So he'll be able, if he is selling more, means obviously profitability also will be more. Okay, some of the advantages. Disadvantages could be, so now you are storing more, that means your storage cost will increase. But if you want to sell more, means first you need to buy more. When you buy more, you need to invest money. That means your funds are getting blocked. Earlier, you used to buy only 100 kgs of tomato. Let's say it used to cost you, let's say 10,000 rupees. Now to buy 250 kgs, will it cost same? No, it may cost about 25,000, let's say. That means earlier only 10,000 money used to get blocked. Now how much money is getting blocked? 25,000, because you will be able to recover the money only when you sell the tomatoes. So till you sell, the fund will get blocked. Suppose the tomato dealer is not able to sell the tomatoes, then what will happen? He'll be at a great risk. And like this, if he's not able to sell 250 kgs of tomatoes, let's say for 8 to 10 days, what will happen to his business? It will shut down. That means liquidity risk, what will happen, sir? Liquidity risk will increase. So that's what we say working capital management is balancing between liquidity and profitability. If you have higher levels of inventory, you will be able to sell more and earn more profit. But at the same time, your liquidity risk also will increase. So hence, you don't want to compromise on the profit also, but at the same time, you don't want to put too much risk on the business also. So you'll have to manage. That balancing act only, we call it as working capital, or balancing between liquidity and profitability. Data is also same thing. Let's say earlier we used to give 30 days credit to a particular data. Now we started giving 90 days credit. Instead of, we'll sell the goods, and earlier we used to recover the payment within 30. Now we are giving how many days credit? 90. So this way, what will happen? The debtor will buy more and more from us, because we are giving more and more credit, means he will purchase more from us. Rather, we will be able to sell more. If we sell more, obviously profitability will be on the higher side. So these are advantages. What about disadvantages? The funds are getting blocked. Yes, now earlier I used to recover the money from debtors within 30 days. Now I'm recovering within 90 days. That means for extra 60 days, my funds are getting blocked. And bad debt risk also will increase. And if this customer does not pay, what will happen to my liquidity, or what will happen to my business? Business will shut down. That business shutdown risk only we calling it as liquidity risk. So through this decision, your liquidity risk is increasing. Your profitability also may increase, but at the same time, liquidity risk also is increasing. Hence, we need to manage that. Yes. Same goes for creditors also. Let's say I had to make the payment to creditor usually within 30 days, because credit offered by creditor is only 30 days. But I am making the payment only on the 50th day. I am purposely delaying the payment. Instead of paying it on 30th day, I am making the payment on 50th day. So that means purposely if I delay the payment, what is the advantage of this? One is it acts as a free source of finance, because I don't have, usually when you delay the payment, contract clause may say you have to pay interest, but nobody will emphasize this, because on debtors and creditors, you don't usually pay or collect it on time. Contract may say we will collect interest, but in reality, nobody will collect the interest. That means you are able to, instead of settling the payment on 30th day, if you are settling on 50 days, means you are able to use this money for extra 20 days at free of cost. So hence it acts as a free source of finance. But at the same time, there are some disadvantages also. Creditor, will he be happy with you in this decision? No. Purposely, if you are delaying the payment, means there will be a loss of goodwill. Yes. Or creditor also may start showing his actions. What actions creditor can do? He may increase the price of the goods, or he may tell you, I will not henceforth supply the goods on credit for you, only cash and carry. Or he may say, I don't want to sell you at all. So that means there are some serious repercussions or disadvantages also. Hence, left, right, center, we cannot delay the payment. You need to find a right balance. Okay. So these are some of the advantages. Fine. That's the reason managing the components of current assets and managing the components of current liabilities are important. Okay, that's one. Next is operating cycle. Sir, what does operating cycle mean? It's the time gap between what? Between the day you purchase the goods and pay money till the time you sell the goods and recover money from your debtors. From the day you purchase the goods and pay the creditor till the time you sell the goods and recover money from debtors. That particular time gap or that particular cycle only we call it as operating cycle. Let's take a small timeline example. Let's say day 1 we purchase the goods and made the payment to creditor on day 1 itself. Because it's not a credit purchase, it is a cash purchase. Creditor demanded the payment immediately, so we gave the payment on the day 1 itself. On the day 10, I sold the goods to debtor. But unfortunately, I'm not selling it on cash basis. I'm selling on a 30 days credit basis. So on which day I will recover money from my debtor? On the day 40th. Sir, how much money I paid to creditor? 10 lakh. Which day did I pay? Day 1. After making this payment, what am I doing? I'm selling the goods and later I will recover money from debtors. That recovery is happening on day 1 or day 40. That means I invested 10 lakh on day 1, but that day 1 I'm getting back, or that 10 lakh I'm getting back only on day 40. That means for how many days is my fund getting blocked? My funds are getting blocked for 40 days. That 40 days only we call it as operating cycle. Is that okay? So whenever they ask you operating cycle in the problem, can you draw a timeline like this and solve each question? Difficult. Hence for operating cycle, there is a formula. What is formula? Operating cycle is given with the formula raw material holding period plus work in progress holding period plus finished goods holding period plus debtors collection period minus creditors ka payment period. If you do this, all this data will be given to you in the question. If you do this, you're going to get operating cycle. And if operating cycle is 40 days means what is the indication? For 40 days, my funds are getting blocked. Okay. So that means for this 40 days, how can you manage the business? You need to take a working capital loan. To manage this 40 days, you need to take a working capital loan. That's what it's all about. Okay. Then using this operating cycle, you can estimate working capital or you can find out working capital. There is one way, or this is one type of problem. How can we do that? Let's just check. So let's say operating cycle, as I've assumed this, is 36 days. Operating cycle is 36 days. That means what? If you invest the money today, you'll be able to recover this money only on the 36th day. That means your funds are getting blocked to the extent of 36 days. Okay. Sir, I've assumed that in a year, let's say there are only 360 days. Some problems they will mention. Take only 360 days in a year for calculation purpose, because 365 if you take, you may get some decimals. So how much is your operating cycle? 36 days. How many days in a year we have asked you to assume? 360 days. So to run one cycle, how many days you need? 36 days. And how many days are there in a year? 360 days. That means how many cycles or how many operating cycles can you run in this particular year? To run one cycle, we need 36 days. And in a year, we have 360 days means how many operating cycles can you have in a year? 360 divided by 36, which is 10. So 10 times you can run this operating cycle. Is my statement right? Okay. Then usually in this problem, they will give you annual operating expenditure. Usually they will give you annual operating expenditure. I've assumed this to be 10 lakh. 10 lakh is what? Monthly expenditure or annual operating expenditure? Annual operating expenditure. That means, can I say this 10 lakh is an expenditure for one cycles or 10 cycle? This 10 lakh is an expenditure on one operating cycle or 10 operating cycle? 10 operating cycle. Why? So this 10 lakh is monthly data or annual data? Annual data. That means what is this 10? What is this 10? Number of operating cycles in a year. In a year, you can run 10 cycles. And for 10 cycles, how much operating expenditure you need? 10 lakh. So 10 lakh is the expenditure needed for 10 cycle. For one operating cycle, how much is the requirement? So calculate that. How, when you prorate it, how much are you going to get? 1 lakh rupees. That 1 lakh rupees only is your working capital estimate. That's another shortcut. Normally, we estimate working capital by estimating current assets ka components, current liability ka components. That is one way. We also will do that kind of problems also. Another way is we can use operating cycle as a base to get or to estimate working capital. This is another kind of question. Hope this was okay with everybody. Can I move on to the next one? Okay. Next is, sir, is there any magic number for operating cycle? Like operating cycle is 40 days, good or bad? Depends. So there is no magic number that operating cycle has to be 40, 50, 350 like this. There is no magic number. It depends on the nature of business. Like a retail or a real estate industry will have a long operating cycle. Imagine a builder. What is his business? He will construct an apartment. Let's say a builder is there. He will construct an apartment. Then he will sell those apartments to many individuals. Okay. So for constructing the apartment, will it be over within 1 or 2 days, or it may take more than 1 year also? Okay. It could be, let's say, to construct this building only, it will take 500 days. To construct this building only, 500 days. After constructing, when you're constructing, you have to invest the money. Okay. He'll construct this money and the construction will take 500 days. After that, he has to find the buyer and later recover money from the buyer. All this umbrama may take a lot of time. So a real estate company could have a really high operating cycle. Could be 500, 600, 700, 800 also. Because for that line of business, we expect operating cycle to be really long. But however, if you are in a retail industry, a supermarket especially, then you expect a big operating cycle, a small. Because what does any retail industry do? They'll buy the goods and immediately they will sell it off. And that too, when they sell it to the debtors, like you and I, if we visit a retail market, will we get any credit or cash and carry basis? You have to immediately pay cash and collect the goods. That means there is no debtor collection period. There is no raw material holding period, because this guy is not manufacturer. He is only seller. So there is no raw material holding period. There is no work in progress holding period. There is only finished goods holding period. How many days do you think all those big retail outlets will hold the inventory for? Maybe for 1 month or 10 days maximum. Because so many customers visit means those inventory will go on getting sold. Yes, no. So, but that means, can operating cycle be really low for this industry? Yeah. Or it could also be negative. How? So, how do you get operating cycle? Raw material holding period plus work in progress holding period plus finished goods holding period plus debtors collection period minus creditors payment period. For retail market, will there be raw material and work in progress? No. Let's say finished goods holding period is 10 days. What is debtors collection period? 0. Let's say they made a deal with the creditor saying, I will make the payment only on 30 days. I'll make the payment only after 30 days. So that means creditors ka payment is how much? 30 days. So calculate operating cycle here. What are you getting? Positive or negative? Negative. Is it bad? Just because operating cycle is bad, negative, does it mean it's bad, or correct it, going good only? Going good only. So that means for these kinds of industries, operating cycle could be really low, or it could also be negative. Okay, so operating cycle, basically there is no magic number. It depends on the nature of business, nature of products that you're dealing with. If you're dealing with a perishable product, then operating cycle will be very small. If you're dealing with a non-perishable commodities like plastic, etc., or steel, then you could have an operating cycle on the bigger scale. Yes, so like that, it varies from factors to factors. Okay, all right. So next is, I'll just go for a few things. There are usually 4 to 5 types of questions that usually comes from this particular topic. What we will do is, I've summarized everything. We will not have time to go through each and every question, because working capital estimate problem itself will take 1 hour if we do it. So what I've done is, I've called out all the steps. I've written it down. We'll quickly discuss. Then I'll take you through few questions which will kind of summarize all of this. Okay, one question is there. That is RTP question. Quite good. It is targeting multiple concepts. So I feel it is good. But before that, first we will quickly discuss all the concepts. So bear with me for a few minutes. We have done this, but still bear with me. Then we will apply it in the few questions. Okay, one popular type of question that comes from this particular topic is estimation of working capital. They'll ask you to estimate working capital. How do you get working capital, sir? Current assets minus current liability. That means if you want to estimate working capital, you have to estimate all the current assets. You have to estimate all the current liabilities. So one by one components you need to estimate. So first current asset is stock of raw material a current asset? Yeah. If you have any closing stock of raw material, is it a current asset? Yes. So how do you get closing stock of raw material? Think. Who will have raw materials? Manufacturer. Why will he use raw material for? For production. So is he selling the raw material or is he consuming raw material? So closing stock of raw material is arrived by keeping raw material consumed data in mind. Let's say like this. Raw material consumed in a particular year is 10 lakh. For the whole year, raw material consumed is how much? 10 lakh. That means this 10 lakh data is for how many days? It's for the whole year, means it is for 365 days. So entire 365 days ka raw material, will you keep it as stock or will you keep only few amounts of raw material as stock? You will only maintain few quantity of raw material as stock. In the problem, they will say about 40 days of inventory will maintain it as closing stock. That they will mention. So that means that 10 lakh or for 365 days, what is the stock value, sir? 10 lakh. How much on an average in this problem? I assume that you will maintain a stock of raw material of 30 days. For 30 days, how much is the stock? Like that, you need to prorate. So calculate X for me. How much? How do you get that? 10 lakh into 30 divided by 365. Express that in formula for me. Let's see. What is this 10 lakh? Raw material consumed. So how do you get closing stock of raw material? Raw material consumed into what? Holding period or raw material holding period divided by 365, or sometimes instead of expressing it in days, they will give it in months or in weeks. Fair enough, people? Or other way, if you want it in simple language, raw material consumed represents whole year cost stock. We want only specific period, holding period cost stock, which will be 1 month, 2 months, 20 days, 30 days, which will be clearly given to you in the problem. So multiply that. That's a quick fix. Yes, sir. This is a closing stock of raw material. Next will be closing stock of work in progress. Sir, work in progress means what? Let's say on the day 1 we purchased raw material. The day 1 here is 29th March. On 29th March we purchased a raw material. Let's assume that to convert raw material to finished goods, it takes about 10 days. So you purchase raw material on 29th March means it will become finished goods 10 days later, which is 7th April. But between this 29th March and 7th April, there comes an important date, which is 31st March, where our year ends. So that means, sir, on this 31st March, is that good a raw material? No, because work has already started. Is it a finished goods? No, because work is not completed. That means on 31st March, this particular value of goods, it is neither raw material, it is neither finished goods. Somewhere it is in between. That somewhere in between only we call it as what? Work in progress. Is that okay? So how do you get work in progress? Or what and all we should consider for work in progress? We need to consider what's it's a work in progress. So we need only raw material for work in progress? No, we'll have to incur all your production expenditure also. That means if you want to get closing stock of raw material, WIP, we have to consider material also and all the production cost. Usually the production cost is labor and overhead, which will be given to you in the question. So in this case, what you have to do is, usually in the problem, in these sort of problems, they will say how many units of WIP you will have. Like 2000 units, 3000 units, clearly they will call out. So take the number of work in progress units multiplied by the labor cost per unit. They will say, let's say work in progress is 1000 units. They will say material cost is 10 per unit. So what you will do? 1000 multiplied by 10 per unit into percentage complete. So work in progress means, is the work 100% completed or not yet? Not yet. So that means if they give you percentage completion, you have to multiply that. Usually for work in progress, towards material, it will be 100% complete. Because what is a normal setup, sir? First, you will buy full materials, then only you will start the work. So towards material, work in progress will be 100% complete because you will start the work only when you receive the material. Is that okay? But however, for labor, same drama, take the number of units of work in progress multiplied by the labor cost per unit into percentage of completion. Do you think percentage of completion here will be 100%? No, usually they will say 70% complete, 50% complete, etc. etc. Sir, why not 100% complete? Sir, if every cost is 100% complete means, will you call this as WIP or it will become finished goods, sir? If everything is 100% complete means it can't be WIP, it will become finished goods. That is the reason you have to multiply percentage of completion here. Usually for material, it will be 100% completion. For labor and overheads, it may not be 100%. Definitely not 100%, it will be lesser. What lesser? Question may, they will specify 50, 60, 70, whatever be the number. Multiply that. A summation of all that will give you closing stock of work in progress. Any doubt till here? No. Next is closing stock of finished goods. You tell me, sir, which finished goods will you store? Goods produced, completed. So that means finished goods ka closing stock you have to value based on cost of production, can I say? Cost of production means fully over. So take the annual cost of production. Take the annual cost of production, or let me put it up like this. Let's say cost of production is, let's say 50 lakh rupees. In a year, this 50 lakh rupees is 1 month ka data, 1 day ka data, or whole year ka data. Whole year ka data. That means this is for 12 months. This could be given in months, days, weeks, whatever. So 50 lakh is a cost of production for 12 months. Entire goods produced, will you hold it as finished goods ka stock or only few? Few. In the problem, they will say, let's say 2 months of finished goods is held as stock. 2 months ka goods are only held as stock. That means for 12 months, if the value is 50 lakh, for 2 months, how much is it? So calculate in formula for me. Tell me, how do you get X over here? X is nothing but 50 lakh into 2 divided by 12. So tell me, this is formula. What is this 50 lakh? Annual cost of production into 2. What is this 2? Finished goods ka holding period divided by 12. 12 is nothing but your yearly data. That could be 12 months or 52 weeks or 365 days. Sometimes they will say in a year there are only 360 days. So in that case, you have to divide by 360. So check the problem. This denominator keeps varying problem by problem. Yes, sir. So adding all this, you will get, considering all this, you will get the closing stock of everything. Next will be the important one, which is the debtors. Okay. Now debtors usually arises on what? Related to what? Credit sales. Okay. Now here like this usually, let's check this. So let's say credit sale is 50 lakh, or let's say credit sale is 360 lakhs. Credit sale is 360 lakhs. Let's say in a year, or maybe I'll take like this, 365 lakhs. In a year, how many days are there, sir? 365 days. Sir, debtors means usually debtors arises only on credit sales. For debtors, you will give some credit period. Let's say credit period is 40 days. That means how do you get the debtors ka value? For 365 days, this 365 lakh is a value for how many days? 365 days. For 40 days, how much is the value? So prorate this for me and tell me how much is this? 365 into 40 divided by 365. So tell me in formula, what is this? What is this 365? Annual credit sales into collection period divided by number of days in a year. Correct? Don't do this. Don't do this. Correct. One way to get debtors is this, but you are not calculating debtors for normal per se. We are not calculating debtors balance here. What are we trying to calculate? Working capital estimate. I told you here, sir, what? Working capital means what? For number of days for which funds are getting blocked. Now you think if you have to sell the goods means first we have to purchase the goods. Let's say we purchase the goods by paying 100 rupees. One unit we purchased how much? 100 rupees. After purchasing, what will we do? Think that we are a trader. Forget about raw material and all. Think that we are a trader. So our business is what? Buying and selling. We purchased at what value? 100. Let's say after buying, we sell it at 150 per unit. So through this process, we make how much profit? 50 per unit. Any doubt till here? So usually debtor comes, or debtor is associated with selling price. Correct? But what am I estimating here? Working capital. And in the problem, they will say estimate working capital using cash cost basis. You estimate working capital using cash cost basis. Even if they don't tell cash cost basis, always assume it as cash cost basis itself. Or coming back to this question, working capital means what, sir? If your operating cycle is 40 days, what does it mean? For 40 days, your funds are getting blocked. Sir, debtors may first, if you have to sell means, before selling, what you have to do? You have to purchase. Will you purchase at selling price or will you purchase it at cost price? Will you purchase it at selling price or cost price? Cost price. That means what data you need to take to estimate debtors, not selling price, but cost of sales. Because to sell the goods, first we have to purchase. Correct? No. If you have to purchase means how much money you paid now? 100 rupees. How will you recover this 100 rupees? Only when you sell the goods to debtor and when the debtor pays you. That means what money is getting blocked for you now? 100 rupees, because you invested only 100. So don't calculate this data. Calculation process is same, but don't take annual credit sale, but take annual cost of sales. Okay, that's the problem. Annual cost of credit sale you take. Don't take credit sale totally, take only cost. Cost of sale basically you have to take. Is that okay? Just substitute credit sale with the cost of sale, because we are talking about working capital estimate, and working capital here means number of days for which funds are getting blocked, and funds get blocked not to the extent of selling price but to the extent of cost price. That's the funda. Okay, everybody, just instead of annual credit sale, you will take annual cost of sales, divided by 365 into debtors collection period. Everybody comfortable with this? We'll apply it also in one question, but so far whatever I'm saying going in. Okay, next is any other current assets if you have, like prepaid expenses and all. If at all it is there, they will give you, bring it in. Usually cash and bank balance ka data will be provided to you in the question itself. So take that. If you take this, what are you going to get? The total current assets. We want total current assets or we want working capital? Working capital. How do you get working capital? Current assets minus current liability. That means now we have to estimate all the current liabilities. So how do you estimate all the current liabilities? Usually the one common form of current liability is creditors. Now you tell me, sir, how will you estimate creditor? What will you buy from creditors? Imagine you are a manufacturer. What will you buy from creditor? Raw materials. But till now, what and all have you considered? Did you consider material purchased or material consumed? Because for production, we don't want material purchased. We want material consumed. Yes, no? Because if you want to produce the goods means raw material you have to consume. So that means all this data is in the question. What will be given? They will not give you raw material purchase. They will give you raw material consumed. But for creditor, we don't want raw material consumed. We want raw material purchase. That means we'll have to do a reverse working, a small calculation. How do you get raw material consumed? You tell me, sir. How do you get raw material consumed? Opening stock of a raw material plus purchase of raw material minus closing stock of raw material. Yes, sir. So material consumed, if you know. Opening stock of raw material, if you know. Closing stock of raw material, if you know. Purchase of raw material, can you find out? So rephrase this equation. How do you find out purchase of raw material? Purchase of raw material is equal to what, sir? Material consumed plus closing stock minus opening stock. So if you do this, usually raw material consumed data will be given to you in the question. Use that and find out raw material purchased. Yes, sir. Okay. Now let's say raw material purchased, you got it to be 20 lakhs assumption. You got it to be 20 lakh. You tell me, sir, this raw material purchased is 1 day ka data or whole year ka data? That means this 20 lakh represents for the whole year, which is 365 days. Will 365 days creditors will give? We are trying to find out creditors balance. Will creditor give you entire 365 days as credit or lesser? Let's say creditor give you 30 days credit. So for 365 days, if the value is 20 lakh, means for 30 days, how much is the value? So that you have to do. So find X. How do you find out X here? 20 lakh into 30 divided by 365. Express this as a formula for me. What is this 20 lakh? Annual purchase or credit purchase? Annual credit purchase of, where is that? Annual cost of material consumed. Can I say like that? On a credit basis, obviously. Usually cash data will not be given. So material purchase only, we're going to assume it as entire purchase is made on credit basis is the assumption. So effectively what we need is annual credit purchase of materials. Is that okay? That is a numerator. Divided by what, sir? 365 days or 52 or 12 months, depending on what data is given. Multiplied by creditors ka credit period given. This is what we need to do and find out the creditors ka balance. Any doubt? No. Then if you have any outstanding expense, you need to consider that. Usually they will say lag in payment of wages is 1 month. Lag means delay. So if you are delaying the payment, means what will you get? Outstanding expenses. So what do you do for outstanding expense? Take the total expense. Let's say total labor cost is 10 lakh. Total labor cost is 10 lakh. This 10 lakh data is for 1 day, one month or whole year? Whole year. That means this is for 360 or let me express this in months. It is for 12 months. Let's say lag in payment is 1 month. 10 lakh is a data relating to 12 months. Are you delaying by 12 months or only 1 month? So for 1 month, how much? You need to prorate like that. So express this in equation for me. What is this? Total expense for the year divided by number of days in a year or number of months in a year or number of weeks in a year multiplied by lag in payment. Lag means delay in payment. That delay could be expressed in days, weeks, months, whatever. Okay, fine. That's how you need to do. All right. So if you do all this, you're going to get the total current liability. From current assets, if you deduct current liability, you're going to get the net working capital. Usually in some problems, they will also say, sir, all these are pakka numbers or estimated numbers? Estimated numbers. Your estimates are pakka or it could go here and there wrong. Here and there wrong. So what they say is maintain some safety margin of 10%, 15% and all. They will tell in the problem. So whatever working capital you got, now let's say you got working capital of 1 lakh. To that they say maintain safety margin of 10%. So what do you do? 1 lakh ka 10% you calculate. How much is that? 10,000. So basically if they give you any safety margin, add it. Some problems it will be given. Some problems it will not be mentioned. Sometimes they will call it as safety margin. Sometimes they will say unforeseen contingencies, like that they will say. Percentage also will be given 5, 10, 15, whatever. Simply add that. So finally what will be your net working capital? 1,10,000. That's how you estimate. Is that okay, sir? But to find out this one, what is that? Debtors. To get debtors, for debtors, what do we need? Cost of sale. We want cost of credit sales. Yes. So all that data will not be given to you. So we have to take the help of cost sheet. You have to take the help of cost sheet. So only for this debtors we need to take the help of cost sheet. So what is your cost sheet? This is your simple cost sheet data. And this cost sheet don't take total cost. We only take cash cost. Because cost means it will have both cash expense as well as non-cash expense. In the problems they will say maintain or do working capital estimate on a cash cost basis. Cash cost means only those expenses which are expected to be settled in cash, only they will be considered. If there is any non-cash expenditure like depreciation, etc., will be considered or ignored. If it is already included, means you need to exclude it. That problems also we have done in our regular class. Overhead is 70 per unit. overhead includes 10 rupees per unit as depreciation. So what will you do? Overhead is 70 per unit, but the 70 includes 10 rupees per unit depreciation. So will you take 70 per unit for your calculation? No, from 70 you will deduct 10 and take it as 60 for your calculation. Is that okay? So that is your cash cost approach. Cash cost approach means only those costs which are expected to be settled in cash, only they will be considered. Any non-cash expenditure and all will be ignored. So keep that in mind and rephrase what is the cost sheet ka formula, sir. First you will take your, you don't have to do it in detailed way. Here this is a simple working. So raw material consumed plus total wages plus overhead cost. All this if you add it, you're going to get factory cost. Don't worry about prime cost and all that stuff. This is okay. We can directly start with factory cost. Comfortable, huh? So add all this, you're going to get the factory cost. From factory cost, what do you do? If you have any opening stock of WIP, add. Closing stock of WIP, if you have, minus. If you do that, what are you going to get? Cost of production. To cost of production, what do you do? Opening stock of finished goods, you add. Closing stock of finished goods, you minus. You're going to get what? Cost of goods sold. To this, you add administrative expense and selling expense. You're going to get cost of sales. Is that okay? You'll get cost of sales. Cost of sale or annual cash cost of sale. You'll get annual cash cost of sale because you are considering total expense here, only cash expense. Cash expense. So you're going to get annual cost of sales. But for debtors, we want total cost of sale or cost of credit sales only. Credit sales. That means you have to find next thing is what's the annual cash cost of credit sales. Usually in these sort of problems, credit sales and cash sale will not be given. Cash sale will not be given. So entire sale you can assume it as credit basis. But in some problems they will say 20% of the sales is on cash basis. That means 80% will be on credit basis. So what is this, sir? This is annual cash cost of sale means this is for 100%. So if only 80% is on credit sales means you have to multiply by the credit sales percentage. Some problems you may need to do that. So take this number and find out the value of debtors. Don't find out value of debtors using sale approach because we are trying to find out working capital estimate. And working capital means how many days your funds are getting blocked. Funds get blocked not to the extent of selling price but to the extent of cost. That's the reason we always take annual cash cost of credit sales. Keep this number as a base and then find out the debtors. Usual step. Manageable, helpful. Okay, we don't have time. That's the reason I note down all this to discuss. Same step. In only difference between this and the question is, in question you will put in numbers. Here this is only expressed in words. That's the only thing. Can I move on to the next question? This is one type of question that could come in this particular problem. We call this as what's the estimation of working capital. On what basis? Cash cost basis. However, if the problem says, till now I have not seen, if at all problem says, estimate working cost on a total cost basis, then even non-cash expenditure like depreciation also will be included. Very, very rare, I have not seen. But if at all they modify and if they say calculated on total cost basis, then include every expenditure, meaning even non-cash expenditure will be considered. But if you're doing it on cash cost basis, then non-cash expenditure will be ignored. If they don't mention anything, my priority is always solve under cash cost basis and write a small note at the end that we have done working capital estimate using cash cost basis because cash cost is more appropriate because working capital means fund is getting blocked. Depreciation is a non-cash expenditure. Is any fund getting blocked? No, that means all that should be ideally excluded. So my preference is always cash cost basis. Okay, that is one. Can I move on to the next one? The next kind of problem that can come from this particular chapter is debtors management. They ask, currently let's say we are giving 30 days credit to the debtors. We are giving how many days credit to debtors? 30 days. Now company wants to increase sales. What is the quick strategy they can adopt to increase the sale? Increase the credit period. So currently they are offering 30 days credit to debtors. Now they are thinking let's go for 90 days. That means we will sell the goods to debtors today and collect the money only after 90 days. So they will give you some data and they will say, should the company adopt new policy? Should they implement new policy or they should not? That is one kind of question. From this topic it can come. We have done 3-4 questions on this. In fact, we have more than 4-5 questions are there in our study bit in our class notes for this one. Okay. Quickly I will run through this concept. So it's a simple funda. So you have how many policies here? You have one existing policy. Now you're also planning to introduce some new policy. When will you go for new policy? You only tell me, think logically. If a new policy is giving you higher net benefits, let's say net benefit under existing policy is 1 lakh. Old policies, existing policy is giving you how much benefit, I've assumed? 1 lakh. New policy is, let's say, giving you a benefit of 1,80,000. Old policy 1 lakh. New policy 1,80,000. So can you go for new policy? Yes. So if new policy is giving you some extra benefit or incremental benefits, then only accept the new policy. Otherwise, reject. So how to find out that incremental benefit? I've given you some format. Okay. So what is that first? First, you will consider the credit sales because data only arises with respect to credit sales. Then second one is, obviously, if you're selling means you'll incur some cost. Here, usually in these sort of problems, cost will be split between variable cost and fixed cost. In these sort of problems, not mandatory, but usually the cost split up is variable and fixed. So if there is any fixed cost and variable cost, let's say I've taken numbers also with here. Let's say under existing policy, sale value is 1 lakh. Variable cost is 50,000, fixed cost is 10,000. All this will be given to you in the problem. Don't worry. So that means what is the total cost excluding bad debts? These two addition. How much is that? These two addition. What is the total cost excluding bad debts? 60,000. Any doubt till here? So obviously, sir, if you're selling the goods to hundreds of debtor means some of the debtors may be bad, meaning they may not pay us the money, meaning there could be some bad debts. Let's say bad debts is 10,000. So that means how much is your profit, sir? How much is how do you get profit? From the sale value, you have to deduct all the cost. Sale value is 1 lakh. What is the total cost excluding bad debt? 60,000. So 1 lakh minus 60,000 you do. How much is that? 40,000. 40,000 minus 10,000 bad debts you do. How much is that? 30,000. This is the profit. If there is any tax deducted, some problems majority of the problem in these problems, tax rate will not be given. So you can ignore it. If they give you tax rate, deduct that also and find out profit after tax. Okay, till here. Not only that, sir, you have to also find the key element in these sort of problem is opportunity cost. You also have to also calculate something called opportunity cost. What is that opportunity cost? You think logically. Sir, to sell the goods to debtor, first we need to buy. To sell the goods to debtor, first we need to buy. Sir, how much is the cost? 60,000. 60,000. Bad debts comes later, after selling. Bad debts comes only after you sell. First, we have to purchase in order to sell. What is our purchase cost and all? Or what is the total cost before our sale? 60,000. Correct? This we have incurred. Okay. Sir, 60,000. Carefully listen to my sentence. 60,000 you already spent. 60,000 you already spent. You already incurred. Correct? For how many days the 60,000 will be blocked? Can you tell me? For the 60,000, how many days it will be blocked? Till recovery money from debtors. Sir, you will recover the 60,000 only when you sell the goods to debtor and later collect the money from debtors. How many days debtors takes you to pay the money? 30 days. That means, can I say this 60,000 is getting blocked for 30 days. The 60,000 is getting blocked for 30 days. Suppose if you had 60,000 with you and I tell you for 30 days you can invest. Obviously, you will get some return. Correct or no? So that means, let's say the return percentage, or usually in this problems, they will give you a return percentage. Let's assume it is 10% for simplicity. How much fund is getting blocked, sir? 60,000. Okay. What is the return you can earn on this 60,000 if you invest? 10%. Are you investing here? No. Okay. If you invest, how much return will you get? 10%. But can you invest for whole year? Here is the 60,000 getting blocked for whole year or only 30 days? Credit policy is only 30 days. I mean, the 60,000 is getting blocked for how many days? 30. So into 30 divided by 365, you do how much are you getting? 493. Correct? So that is your opportunity cost. Sir, if you had invested, carefully listen to my sentence. If you had invested 60,000, how much benefit you would have got? 493. Are you investing or this is notional? Notional. If at all you invest, you will get 493. Now, are you investing? No. Because you gave 30 days credit to your debtor, that 30 days ka interest you are losing. That only we calling it as opportunity cost. That means this is an inflow for you or outflow for you? Outflow. So that means to get the benefit, you will add this or deduct this or deduct this. So deduct from 30,000 profit, deduct opportunity cost. 493. How much are you going to get? 29,497. So that is the expected benefits of the current policy. Same way calculate what is the expected benefit of new policy. Same data, but numbers will be same or changed. Numbers will change. So in the same format, in fact, I've done 5-6 questions in the class, not even changed a single format. So that even if you don't know a thing, If you blindly go ahead and do the format also, you will get the full right answer. We have done 6-7 questions. Okay. So I don't have time. So that's the reason quickly running that by. Okay. Okay. No. So for the new proposed policy, do the same thing. Let's say that value is 40,000. Now you tell me, you will accept this new policy or reject. Original policy is giving you a benefit of 29,507. New policy, I'm saying, is giving a benefit of 40,000. That means new policy is giving you higher net benefit. So if it is giving higher net benefit, means accept or reject? Accept it. Sometimes in the problems, they will say solve these questions under incremental approach. Solve it under incremental approach. In that don't change anything. Last may bring in one more extra thing. That is incremental benefits. Just put in one extra component called incremental benefit. Old one is giving how much benefit? 29. New one is giving how much benefit? 40. So compared to the old, new is giving how much extra benefit? Compared to the old, new is giving how much extra benefit? Basically 40,000 minus 29,507. How much is that? 10,493. So compared to the old policy, new policy is giving 10,493 more benefit. That only we're calling it as what? Incremental benefits. So if incremental benefits is positive, then implement the new policy. Otherwise, reject it. So watch out. If at all they ask you to solve under incremental policy, last line you bring in. Otherwise, you can keep this only, and based on this only, you can write the answer. Yes, sir, Saru? Okay. So again, what are these types of question known as? Should we relax the credit policy? Meaning, should we give more credit? Or it could also be asked as a, should we reduce the credit period also? That also could come. But usually they will talk about relaxation. Relaxation means giving more credit. So tell me, how do you calculate? Visualize and tell me. So basically we want old policy ka net benefit and the new policy ka net benefit. Okay. But when you're calculating net benefit, don't usually take PAT. We also need to consider opportunity cost. That's the only extra fitting. So visualize that and construct the format for me. What is that? First you will take, to get profit, what do you start with? Sales. Then reduce the cost. Cost here, usually in these problems, cost is split between variable and fixed cost. So add those two. What are you going to get? Total cost excluding bad debts. Is that okay? Then if there is any bad debts, deduct that. You're going to get profit before tax. If there is any tax, deduct that. You're going to get profit after tax. Can you take the decision based on PAT? No. You also have to consider opportunity cost. First of all, why did if you check the fourth column, first column was what? Sales. Second was what? Variable cost. Third was fixed cost. What was the fourth one? Total cost excluding bad debts. Why did I find that? Why did I find total cost excluding bad debts? Why is this necessary? Because this is 60,000. This is the total cost excluding bad debt. This 60,000 is getting blocked. For calculating opportunity cost, we need this number. That's the reason we brought this into our working. Otherwise, this is not necessary. Is that okay? So here 60,000 is getting blocked for how many days? 30 days. And that means on this 60,000, you are not able to earn the return. Return percentage I have assumed in this problem to be 10%. That usually will be given to you in the question. So this total cost excluding bad debts. That's what. So if you want opportunity cost of formula, if you're very big on formula, every line if you want it as formula, how do you get opportunity cost? Total cost excluding bad debts multiplied by the rate of return into what, sir? Credit period divided by 365. That, I think this and all formula not required. Easily you can do it on your own, but in case you want it, I brought it. Okay. So then consider this opportunity cost. Opportunity cost will be added or subtracted? Subtracted. Then you will get the net benefit. Okay. So expected benefit. So compare these two and accordingly take a decision. That is the second type of problem. Can I move on to the next one? Okay. Another type of question that usually gets asked from this particular topic is factoring arrangement. Should the company do factoring or not? Let's say there is one company A Limited. They have sold goods worth 40 lakhs to many debtors. Not just one debtors. There are many debtors. And the average credit period is 60 days. That means the company will recover this 40 lakhs now or after 60 days. After 60 days. But company is in need of funds. They need money. One quick way to recover the money is, can you ask the debtors and collect the money immediately? No, they will pay only after 60 days because credit given is 60 days. So one quick fix or one quick way to realize the money is sell your debtor. How much debtor you have currently? 40 lakh. That debtors itself, you can sell it to another agency and that agency ka name is factor. And this arrangement of selling the debtors to an entity only, we call it as factoring arrangement. You're not selling any goods. You're selling the debtors. The company will sell debtors only to the factor. And what will the factor do? Immediately, they will pay to A Limited. What is the debtor value? 40 lakh. They will not pay full 40 lakh. They will give you some, they will say in the problem. Okay, whatever the value is. Here I have assumed it to be 39 lakhs. It could be anything. Sometimes they will say debtor advanced only 70%. Factor only advanced 80%. Like that they will mention. So accordingly take it. So this way what happened? A Limited got the money immediately. Sir, what's in it for factor, sir? Now what the factor will do is, what is the credit period remaining? 60 days. After 60 days, factor will follow with debtors and collect the money. Now who will pay the money? Debtors. To whom will they pay to? Debtors will not pay to A Limited now. Whom will they pay the money to? They will pay to the factor. That's the whole arrangement. Okay. So what is it now? For A Limited, what is the advantage? A Limited got the money immediately. What is the advantage for factor? Factor will not do all this activity at free of cost. There will be some commission. Like here, see, what is the value of the debtors? 40 lakhs. How much did they pay? How much did the factor pay to A Limited? Only 39 lakh. That means indirectly 1 lakh rupees is factor ka commission. It's same like bill discounting, which bank does, no? In a way like that. Fine now. So this way, factor will earn a commission of 1 lakh. So that way it's a win-win for him also. Usually factoring arrangement are of two types, with recourse and without recourse. With recourse, the English definition recoursing means going back. So if debtor doesn't pay the factor, what will the factor do? If debtors does not pay the factor, then factor will come back to A Limited and tell, give me my money back. Give me my money back. Such a factoring arrangement, we call it as with recourse wala factoring. So if debtors does not pay, factor will go back to A Limited and collect the money. Such an arrangement, we call it as with recourse. So that means, you tell me, under with recourse arrangement, who has bad debt risk? If it is with recourse arrangement, who really bears bad debt risk? Original seller, which is A Limited. Because if debtors does not pay, factor will come back to A Limited and recover the money back. So bad debt risk is with whom? The original seller, that is A Limited. However, if it is without recourse factoring arrangement, without recourse means can you go back or you cannot go back? If it is without recourse arrangement, then if debtors does not pay the factor, then factor cannot go back to A Limited and collect the money. That means indirectly I'm telling what? Under without recourse arrangement, bad debt risk will be with the factor. Okay. So why will factor take extra risk, sir? If he wants to earn extra commission, he may be going for without recourse arrangement. That's an arrangement between A Limited and factor. We don't have to worry about that. Is that okay with you? Usually in all our these sort of problems, we always assume that it is a without recourse factoring. Normal assumption, thumb rule assumption is it is without recourse arrangement. Now you got the whole funda of factoring. Now what they will give you is they will give you some data and they will say, should the company go for factoring arrangement or should they not go? Now if you go for factoring arrangement, there will be some benefit also, but at the same time there will be some cost also. Sir, what is the benefit? Now you tell me, sir, if A Limited sells their debtor and factoring arrangement, you sell your debtor. If A Limited sells the debtors to factor means, should A Limited follow up with the debtors to collect the money or not required? That means all this administration activity is there or not there? Not there. That means if by selling, getting into a factoring arrangement, some administration cost will get saved. Because who will follow with the debtor now? A Limited will not follow. Who will follow? Factor will follow. Correct. Now usually, sir, usually when you sell the goods to a debtor, there will be a team. We call it as a receivable team. What is their job? Their only job is to call up debtors and say, give me money, give me money, give me money. So all that team is required now or not required? Not required, because you gave or you sold off this whole debtors to another agent called factor. So you will be able to save some administrative cost. Is that okay? Alright. Second one, you will be able to save some bad debts losses. But because usually under factoring arrangement, what is the assumption? It is a without recourse arrangement. So if debtors does not pay the factor, will factor come back to A Limited? No. That means some bad debt risk we have saved. Yes. So that is one benefit. So these two are usually the benefit. Factoring arrangement will also have some cost. What is the cost? Factor ka commission. Usually in the question they will say factor also charges some interest. Not necessary both should be there. But in our problems generally commission also will be there. Interest also will be there. These two are the cost. So compare. Let's say the benefit is 1 lakh. Cost is 80,000. Will you go for, now you tell me, sir, will you go for factoring arrangement or ignore? Benefit is 1 lakh. Cost is 80,000. So what is the net benefit? Net benefit or net cost? What is it here? It's a net benefit. How much is the net benefit? 20,000. So if net benefit is positive, go ahead with the factoring arrangement. Otherwise, reject. That is one kind of problem. Okay, there is one more way they can ask. They also will ask you cost of factoring arrangement. Ask you to express it in percentage. That I'll take you through. We have 2 questions. I'll tell you through that particular problem. It's come in RTP and MTP also. Okay, that is another type of question. Then Another kind of question that can come from this particular topic is with respect to payable management. Payable management means creditors management. What sort of question gets asked through creditors management is, now sir, creditor is telling you, or maybe let's take this example. There's a small formula to calculate this. We'll see that formula later. First, I'll give you a background, or maybe I'll just write it down here first and then tell you. Sir, creditor has given you a credit period of 40 days. You purchased the goods from a creditor. When you have to pay? 40 days. Okay. Creditor also told you, if you pay within 10 days, I will give you 5% discount. If you pay me within 10 days, I will give you 5% discount. This is the option. Okay. If we want, we can pay the creditor on the 40th day. We have a choice. Or also, if you pay the creditor within 10 days, then the creditor will give a discount of 5%. So they will give you some data and they will ask you in the question, should we go for this discount option or not? That is one kind of question that can ask. So here what we got the background of. All right. So what we have to calculate here is we have to calculate something called annual benefit percentage. Annual benefit percentage, because all other data will be an annualized term. That means, see, you're getting some discount from creditor means it is a cost or benefit. So you express that benefit in percentage, not in value. Express it in percentage, not towards credit period. Let's say how many days credit period creditor is giving? 40 days. Don't express this benefit on 40 days platform. Express it on whole year platform. So you need what, for annual benefit percentage. Why? I'll tell you in a bit. So don't express it on 40 credit period ka platform. Express this benefit on annual basis. That's given by the small formula. If you don't want logic, you can blindly apply the formula. You'll get the answer. That is D divided by 100 minus D into 365 divided by T. This is the formula. Since you want it in percentage, normally when you want percentage, final number you will multiply by 100. This is the formula. Okay, what is it I said? D divided by, you have to remember, actually you can derive your formula using logic. This is simple one it is. But when you are solving all this question in exam, you have to write it with the formulas. So it's given by what again? D divided by 100 minus D into 365 divided by T. Sir, what is this D, sir? D is the discount amount. D is the discount amount. So you got it. So that means this is solved. What is this T? T is the early payment period or prepayment period to get the discount. Now come back to this example. What is the usual credit period? 40 days. But in order to get the discount, within how many days I need to pay? 10 days. Sir, normally I pay on the 40th day, but to get the discount, I need to pay within 10 days. That means how many days early I need to pay? Compared to normal May, how many days early I need to pay to get the discount? 30. That 30 only we call it as T. So how many days early you need to make the payment to get the discount? That is expressed as what, sir? T. That's what it is. D divided by 100 minus D into 365 divided by T. Okay. Whole thing you multiply by 100 to get it in percentage. So I've taken a small scenario. I think this is a same question ka data only I've taken. Usually they give like this. So check. Credit period is 40 days. Company has a choice of paying 95.5 instead of 100. If you have to pay 100 rupees to the creditor, creditor is saying, don't give me 100 rupees, give me only 98.5. That means indirectly, what is it, sir? Discount is 1 rupee 50 paisa, can I say? Because we are not paying 100 rupees, we are only paying 98.5. So what is the discount? 1.5 rupees. Any problem? So you got your D. D is your 100 minus 98.5, which is 1.5. Now, what is the normal credit period? 40 days. But if you want to get this discount, no, you need to pay on or before 10 days of purchase. If you purchase the goods means within 10 days of purchase date, you need to make the payment. What is the credit period? 40 days. But in order to get the discount, you need to pay before 10 days. Same example. That means what is T over here? How many T stands for what here? How many days you need to pay in early to get the discount? So usually we pay on the 40th day, but to get this discount, we have to pay on the 10th day latest. That means how many days early you need to pay? 30. So T here is for 30 days. So apply it in formula for me. What is that again? D, which is 1.5 divided by 100 minus D, which is 100 minus 1.5 into 365 divided by 30 into 100. If you do, how much is that? 18.53%. Meaning this is the benefit percentage that you're getting from creditor. So why do we do it on annual basis? So usually in these problems, what they say is, think, sir, If you want to get the discount means you need to make the payment to whom? Creditor. If you don't pay the creditor, what will you do? You will utilize this money and make some investment. Suppose you have money. Okay, if you don't want to pay the creditor and if you don't want to invest it in your business, what will you do? Purchase some other company ka investment. Some bonds or some FD you can do and earn some return. That they will say here in this problem, return percentage or investment return percentage is 15%. This 15% now will not be for 30 days. It will be for whole year. Now what you have to do is compare and do a decision. Should we go for this discount option or should we invest this money? Now you think logically. If you invest, how much return are you going to get? 15% per annum. If you go for discount option, what is the benefit you're getting? 18.53% per annum. Yes. So that's the reason both the things has to be on an annual basis. Is that okay? So compare now. Which is beneficial? Investment ka return or discount percentage? Discount is giving you 18% benefit. Investment is giving you only 15% benefit. Which is beneficial? Discount. So that's what I've written here. Since annual discount benefit percentage is greater than return, the company should go for investment option or paying the creditor option. Paying the creditor option or the discount option should be available. That is the reason we express this. Comfortable, everybody? Everyone good, 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 good. Or if you want it another way, the logic of this formula, we can easily construct it. Sir, how much are you paying the creditor? 98.5. How much discount are you getting? 1.5. So tell me what is the benefit percentage? How do you calculate GP percentage? GP upon sales into 100. This is like your GP. This is like your sales. How do you calculate the percentage? 1.5 divided by 95.5 into 100. How much is it? Fatafat tell. 1.5? 1.52. Correct now. You will get 1.52 percentage benefit. You will get the benefit provided you make the payment to creditor within 30 days. That means this 1.52 percentage benefit no is not for whole year. It is for 30 days. Because only if you pay the creditor 30 days early, you will get the benefit. If you want the benefit for whole year, what is the benefit percentage for whole year? How do you get it? Tell me. Calculate this. 1.52 into 365 divided by 30. Yeah, what up? That's all. That is all your formula. Okay, now. Usually when you calculate this benefit percentage, you will get it for the credit period. But we want the benefit percentage on an annual basis. So you don't want, I mean, that's a logic. Is that okay with you? That is only, that logic only is expressed as formula. I feel it's easier to just remember the formula instead of doing all this drama. So what is that formula again? D divided by 100 minus D into 365 divided by T. D for the discount, T for early payment period. That's all. Remember, compare this annual discount percentage with investment return. If discount percentage is greater than, if benefit percentage is greater than investment return means pay the creditor early. Otherwise, don't pay the creditor. That's a conclusion. Got it up? Okay, this is one question that I think these are, and usually I think one more that can come is with respect to cash management model, not so popular. You have your economic order quantity in costing, EOQ. Yes, what is EOQ trying to calculate? Okay, forget about that. It's okay, fine. So, all right. Let's not dive into that now. What here in cash management model, one particular person, Baumol model, has copied EOQ. I don't know, I mean, wrong word, I think. Okay, he has got inspired by EOQ. Okay, and he has expressed, sir, if you have cash means what you will do? If you have idle cash means what you will do? You will invest, correct? Now, how much to invest? So that is what William Baumol model is trying to say. Because each time, sir, you want to buy, let's say, one company ka shares, you have to pay brokerage. So each time when you invest, there will be a transaction cost. And each time when you invest, you will get some return. So this Baumol model is trying to calculate how much you need to invest so that your transaction cost and your opportunity cost are minimum. Okay. So what was the EOQ formula? Square root of 2 AOC to square root of TAO 2 AO divided by C. That's what we need to do. Here instead of AOC, it is UPS. Lot easier to remember. UPS. Current to. Okay. So that's what. So same formula. Instead of AO divided by C, it is UPS. So square root of 2 into U multiplied by P divided by S. U here stands for annual disbursement of cash. They will give it to you in the problem. Annual requirement of cash. Because we are talking about not about inventory, we are talking about cash here. So annual disbursement of cash they would have given to you in the problem. P is your transaction cost. Because each time when you have to invest means you may have to pay brokerage and all that. That will be 5 rupees, 20 rupees like that. They will give it to you in the problem. S is your return percentage, 8, 10%, etc. They'll give you. Calculate this and you will get the minimum cash balance to be maintained. Is that okay with you? 2 marks may, now it's MCQ question, so all this also may get triggered out. Okay, and not as a full-fledged question, maybe a 1 marker MCQ or at best a 2 marker MCQ can come as a cash management model. Okay, another one maybe is our Tandon committee, committee. Maximum permissible banking finance. Sir, if you want to working capital is 50 days, that means what? Operating cycle or working capital is 50 days. That means what? For 50 days, your funds are getting blocked. So how will you manage your 50 days ka expenditure? By taking some loan. That only we call it as working capital loan. So our Tandon committee has framed some rules as to how much maximum borrowings you can do. I don't know why they brought it in here, because the reason is all this committee ka rules are applicable for banks. Are we calculating working capital for banks or our entity? Our entity. That means this is really, all this data is related to what? How much maximum finance bank can give you. So who should worry about that? Bank. So that means all this is literally out of syllabus. Chumma, for the sake of it, they brought it. But it will come for 2 marks. It has come in the past for 5 marks also. So we need to know. So Tandon committee has brought 3 rules. Maximum permissible finance, they found out under 3 rules. One is 75% of current assets minus current liability. Basically, find out your working capital. Whatever is your working capital, 75% of the working capital is your maximum permissible finance. First limit. Second is 75% of current assets you find out. From that deduct current liability. That is the second limit. Third limit is 75% of current assets minus core current assets, we say. Core current assets means certain permanent assets. Like current assets means sometimes you will have, let's say, you have buffer stock. You have buffer stock. Let's say usually company maintains 100 units of closing stock. Okay. No matter what, no sir, in this 100 units, 10 units will be maintained at every time. In 10 units they will maintain every time because that is a safety stock or a buffer stock. Okay, that means this is what? It's a temporary one or permanent one? Permanent one. All this we call it as core current assets. Okay, let's say cash balance is 1 lakh. Company always maintains 10,000 cash. No matter what, every month minimum how much they'll maintain? 10,000. Safety purpose. So that means this is what? Temporary or permanent? Permanent. This we call it as CCA, as in core current assets. Okay, so core current asset is nothing but your minimum cash balance maintained or minimum stock maintained, etc., etc. So what Tandon committee says is, if you have any core current assets, first reduce that from current assets. Because if it is a core current assets means it's like a permanent amount, permanent. Working capital is a permanent number or temporary number? Temporary number. That's the reason they say Tandon committee ka views is, if they have any permanent assets, you fund it from your long-term finance. Because working capital finance is a long-term finance or short-term? Short-term. So if you have any buffer stock or cash and all, you maintain it from your long-term finance, like equity shares, preference shares, long-term debt, etc., etc. Don't take working capital loan for this purpose. So hence, from the current assets, reduce core current assets, calculate 75% of that. From that, deduct current liability. You will get the limits. Okay, Saru. Usually they will only say, or how the question, if it comes for 5 marks, they will say calculate the 3 limits as per Tandon committee. Blindly apply this, you will get the answer. Or they may only ask you, they will only give you some data and ask you only one of the limit, which we will see in one of the question. In this time attempts RTP, that's come. Tandon committee has come. Okay, now. So with this, all the concepts we have revised. So we'll run through certain questions. All right. There's an RTP question, a good question, little tricky or little lengthy, but still, when you're revising, it is good because it will cover 2-3 aspects. AR more LLP is a newly established entity. The moment you see newly established entity, what should come to your mind? No opening stock, because you are estimating working capital. You need cost sheet data. For that, you will consider opening stock of WIP, opening stock of finished goods and all is there. No, since it's a new setup, opening stock will not be there. That's one. Okay, there's a startup, they want to manufacture something ante, revolutionary ante, all that is goli, I don't want that. Consultant was hired and they're saying the cost to set up the plant is 5 crores. It'll require 1 year to make the plant operational. Okay, blah blah goli. Units to be sold is how much, sir? 3 lakh square meters per annum. So they've expressed it in square meters. Usually they will say 1 lakh units, blah 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 and all. Here they've told 3 lakh square meters. Maybe it's a construction industry. I don't know what it is. Okay. Some they express it in meters. It's fine. Okay. Sir, this is the value or units? Units. That units they've expressed it in square meters. That's it. Selling price for each square meter is how much, sir? 1000. 3 lakh square meters you expect to sell, and selling price for each is 1000. So if you do that, you're going to get total sales value. Take a fatafa, do it. How much is that? 3000 lakhs, which is don't do full number. This is 3 lakhs, no. So 3 lakhs into 1000 will give you what, sir? 3000 lakhs. 3000 lakh is nothing but your 30 crores. So as in when we see, can I tick off? Would that be okay with you? So now just check. So your sales is 30 crores. Comfortable? 3 lakh units you are selling, each at 1000 units, and your total sale value will become 30 crores. It's an MCQ question. It's a case study they've given, and they've asked about 4 or 5 questions revolving around that. So sales, we have got it. Fine. Okay, come back to the question. What are they saying next to? Raw material cost is 200 per square meters. Okay. Labor cost is 50 per hour. All other data is in square meters. This one is in per hour. And they are saying labor hours per square meter. If you want to produce 1 square meter, how many labor hours you need? 3 hours. To produce 1 square meter, you need 3 hours. And for 1 hour, how much are you paying? 50 rupees. That means for 1 square meter, effectively, how much are you paying? 150. Can I say so? Because to produce 1 square meter, you need 3 hours. And for 1 hour, you are paying 50 rupees. So 50 into 30, 50 into 3, if you do, you're going to get labor cost per square meter, which is 150. Comfortable? Cash manufacturing overhead, 75 per machine hour. And using 1 machine hour, or to produce 1 square meter, how many machine hours you need? To produce 1 square meter, you need 2 hours. And for 1 hour, how much are you paying? 75 rupees. That means what is your total cost per square meter? Same like the above. 2 into 75, which is 150. So you got your material cost, labor cost, and overhead cost. You need cost data, no? I mean, cost sheet. So all this is important. Selling and administrative overheads. Do keep in mind, all other data will be on the material consumed. Raw material, labor, and all that will be relating to the production. Yes, no, that means they'll be relating to the raw material, the units produced. But selling and distribution overheads and all, will you incur on the goods produced or goods sold? Sold. Keep that in mind. The data slightly will change over here. Yes, sir. So this is always on the units sold. And how much is that? For 1 square meter, the selling and distribution overhead is 250. Okay. Being in the new industry, they are saying we have to give 3 months credit to the customer. Customer means our debtor. So debtor's credit period is how many months? 3 months. Okay. It will maintain a stock of raw material equal to 15% of annual consumption. So whatever is your material consumed, here they've expressed it in months or directly in percentage. Whatever is your raw material consumed, 15% of that is your closing stock of raw material. Is my statement right? Okay. Based on negotiation with creditor, blah, blah, blah. 1 month, credit period is 1 month. Story and all, we don't have time. So credit period is 1 month for creditors. The entity will hold finished goods equal to 2 months units to be sold. How many ever units you are planning to sell, of that 2 months, they will hold it as finished goods ka closing stock. Yes, sir, people? Okay, 1 second, stop there. How many units you are anticipating to sell? 3 lakh units. So 3 lakh units you are expecting to sell. This is 3 lakh is for 1 day or whole year? Whole year. Here the data is given in days, weeks, or months. That means 3 lakh is for 12 months. Entire 3 lakh, will you hold it as closing stock of finished goods or only 2 months of sales they said? I'm not selling that. They are not using the word production. Usually finished goods will be linked with the production. But here what have they told? Question ka requirement, entity will hold finished goods equal to 2 months of the units to be sold. How much is units to be sold? 3 lakh. This 3 lakh is for 12 months. For 2 months, how much is it? 50,000. So that means indirectly they're telling what, sir? Closing stock of finished goods is 50,000 units. Can I say so? That unit only, they're calling it, expressing it in square meters. That's fine. We'll call it as units only. That's okay. Yes, sir. Okay. That means, okay, maybe I'll tell you a little later. So far got it, no? Okay, let's maybe read off the whole data. All other expenses are to be paid 1 month in arrears. Arrears means you're paying early or you're delaying the payment. Delaying the payment. That means you have some outstanding expense over here, and that outstanding is for only 1 month. Okay. Bank balance they've only given to be 25 lakh. This is one part of the question. Leave that. This is relating to estimation of working capital. Next is with respect to the factoring arrangement and all that. We'll read it later. Would you be okay with you? Okay. So this one I'll come back to it later. Let's look at the requirement. First requirement is anticipated profit before tax per annum. You just need to find out profit before tax. So they have given, you have to start, how do you get profit before tax? From sales, you have to deduct all the cost. So can we do it one by one? But before that, maybe I'll take it here only. How many units are you planning to sell? 3 lakh. Okay. But this raw material, production, labor and all will be based on the unit sold or unit consumed. This raw material, labor and all, or production overheads and all will be based on the production. Correct? No? How many units you are planning to sell? I told 3 lakh. Right? How many units you want to maintain it as finished goods ka inventory? 50,000. That means how many units you should produce? 3 lakh you want to sell, 50,000 you want to maintain it as stock, means how many units you need to produce? 3 lakh 50,000. Understood? So units produced here is 3 lakh 50,000. That's all. That is a linkage. Got it, everybody? Once more or okay? Okay. So all this. So means how many units? 3 lakh 50,000 units. Raw material cost you already know. What is the raw material cost per unit, sir? They only gave over here 200 per square meter. For 1 unit, 200 square meter. For 3,50,000, how much? Multiply these two, you're going to get 7 crores. Yes, now it's a simple exercise. Yes. Why can't be 3 lakh? No. You have to sell 3 lakh, pa. And you have to maintain 50,000 as stock, means totally how much you need to produce. See, I want to sell 3 lakh to you. I want to have 50,000 with me also. That means totally how much I need to produce? 350. In 350, I will give you 3 lakh. That means mine, how much will be left? 50,000. So it's not as deduction, it is a addition. Okay, comfortable now? Okay, same labor cost. How many units? All the units column you'll write what now? 3,50,000. Comfortable? Okay. What is the labor cost? We already found out that. What is the labor cost in square meter? 150. And overhead cost per square meter? 150. This also 150. That also 150. Tick off. These two multiplication is these two data. That and all I can run through. Would you be okay with that? Okay. So if you add all this, what are you going to get, sir? Factory cost. Factory cost. Have they given any WIP data here? Usually, what is your, tell me the cost sheet ka? Start with factory cost. Basically, you will take material cost, labor cost, overhead cost. Then you will get factory cost. To factory cost, what do you add? Opening stock of WIP. Deduct closing stock of WIP. Any WIP ka data given in the problem or no info? No info. That means opening stock of WIP and closing stock of WIP are not there. So factory cost only will become cost of production. That's the reason directly they have written cost of production. Okay, now if you want, you can maintain the same format and write all that data, or I hope what I said makes sense. So how many units? 3,50,000. So 17.5 crore divided by 3,50,000 if you do, obviously you're going to get 500. Or this addition also if you do, you're going to get 500. Comfortable? So till here, what have we got? Cost of production. Next, what do we need? Till the end, you complete it off. So how do you get cost of production? What do you do? Add opening stock of finished goods. It's a new entity. So will they have opening stock of finished goods? 0. That's the reason they have not brought it into our working. Deduct what? Closing stock of finished goods. How much is the finished goods? 50,000. Okay. And this 50,000 is maybe based on sale, but is inventory valued at selling price or cost price? Cost price. What is the cost price per unit? 500. So 50,000 into 500 you do. How much is that? 2 crore 50 lakh. Or you could say 17.5 crore is a cost to produce 3.5 lakh units. For 50,000 units, how much is the cost? You can like that, you can prorate and get it as how much, sir? 2.5 crore. That is a closing stock of finished goods. What do you do for closing stock of finished goods? Add or deduct? Deduct it. What are you going to get? Cost of goods sold. So 17.5 crore minus 2.5 crores. If you do, you're going to get 15 crores. Yes, now this is cost of goods sold. So cost of obviously, how many units have we sold? Have we sold 3,50,000 units or only 3 lakh? That's the reason they've written 3 lakh here. Or 350 minus 50 also. If you do, you're going to get 3 lakh units. Comfortable? Okay. The cost of goods sold, what do you do, sir? If there is any administrative expense and selling and distribution expense, you add it up. Do you have administrative expense here? Yes. They only told in the problem administrative cost is somewhere. What is that, sir? 250. Don't calculate 250 on 3,50,000 units. This is selling and distribution overheads. Selling and distribution overheads will be calculated on units sold. How many units have you sold? 3 lakh. And for unit sold, how much administrative cost? 250. So if you multiply, how much is that cost? 7.5 crores. So if you add administrative cost, what are you going to get? Cost of sales. This data is simple. Correct now? How do you get profit? Sales minus cost of sale will give you your profit. Sales we have already ticked off. So 30 crores is your selling price. Cost of sale is 22.5 crores. So what is your profit? 7 crore 50 lakhs. So the option to the first answer is, they ask profit. What is the profit? 7.5 crores. Basically cost sheet only, but asked in a different format. Understood? Can we go for the next one? Yeah. Everyone good, no? Okay, second requirement is you need to estimate current assets, not working capital, only current assets. So tell me, sir, what and all current assets you will have? One, closing stock of raw material. From the data we remember, let's try to recollect whatever we remember. One, we have closing stock of raw material. WIP data is not there, leave it out. Then we have closing stock of finished goods. Then debtors we have. Then any prepaid expenses there? No data. But cash and bank balance is there? Yes. So only these four we need. So first we'll take stock of raw material. This we have to do, or they only told? They told in the problem that closing stock of raw material will be maintained to the extent of 15% of raw material swaha consumed. How much is raw material consumed? 7 crores. So 7 crores ka 15% is how much? 1 crore 5 lakh. Directly given 15% of material consumed. So wrote it there. Closing stock of finished goods we have already found out. What is that? 2.5 crores. Directly written there. Done now. Next is our debtors. Don't calculate debtors based on sales. Calculated on cost basis. Usually they'll mention also. Here we'll just check. I didn't say. Check. Debtors calculated at cost. Okay. Because you know that when you read all this problem, it is a working capital estimate wala problem. Whenever in working capital estimate wala problem, don't calculate debtors based on sale value, but calculate on cost basis. That means to calculate debtors, will you take the sales value or cost of sales data? Cost of sales. In fact, we want annual cash cost of credit sales. But have they told in the problem 20% is cash sale, 80% credit sale, like that breakup have they given? No, that means entire sale will assume it as credit sale itself. So how do you calculate debtors here? You tell me. 22.5 crores is a sales for the whole year. Here the data is expressed in days or in months. So 22 crore 50 lakh is for 12 months. How many days credit will you give it to debtors? I think 3 months they told, no? Yeah. We give how many months credit to our debtors? 3 months. So basically you have to do 22.5 crores. This 22.5 crores is for 12 months. How much for? 3 months. So calculate that. That's what they've done over here and got it to be 5 crore 62 lakh 50,000. Yes, sir. Cash and bank balance, they've only given it to be 25 lakh. So if you do this, you're going to get the total current assets. That's your option. Select, solve it, select the option. Can I go for the next one? Okay, the next one, they asked, what is the net working capital? They asked working capital. How do you get working capital? Current assets minus current liability. Current assets I've already found out. I'll not put up the calculation again. How much is the current assets? 9 crore 42 lakh 50,000. Next, we need only current liabilities. So visualize. What are the current liabilities that could come? Creditors there, yes. And outstanding expense, yes. They said all the expense are paid 1 month in arrears. They said expense. Expense means all the expense are paid 1 month in arrears. That's one. One more point you need to keep in mind is the creditor. Creditor will here, no sir, you have raw material consumed. Because what do you buy from creditor? You don't buy finished goods. What do you buy from creditor? Raw material. Will you calculate creditor by keeping 7 crore as base? Like 7 crore is for 12 months. For creditor, credit period is 1 month. Like that, will you calculate? No. Because what do you purchase? What do you need for creditors? You don't need raw material consumed. We want raw material purchased. So that means from raw material consumed, we have to arrive at raw material purchased. We already discussed that. How do you get that? Here. How do you get raw material consumed? Opening stock of raw material plus purchase of raw material minus closing stock of raw material. That will get you raw material consumed. Using this data, can you calculate purchase of raw material for me? So rephrase the equation. How do you get purchase of raw material? Raw material consumed plus closing stock of raw material minus opening stock of raw material. I have not got opening stock because this is the new entity. So opening stock is any which way? 0. How much is raw material consumed? 7 crore. How much is closing stock of raw material? Already we calculated 1.05 crores. So that means raw material purchased is how much? 8.05 crores. Yes, sir. Using this, we will get the creditor. 8.05 crores is a purchase for the whole year. That is for 12 months. To entire 12 months, you will get credit from creditors or only 1 month? 1 month, how much is the creditor balance? Can you tell me that? They are saying here 67 lakh 8,333. Correct? Okay, that is the value of creditors. Easy. Okay. Next, they told what is that outstanding expense. Let's read that outstanding expense data once again. All other expense. All other expense means other than creditor. All other expense are paid 1 month in arrears. So come back to our working note. See what and all expenses there. Raw material got captured in creditor. So leave that out. Other than creditor, what and all outstanding is there? Labor cost, production cost, selling and distribution cost. Add all this. 5.5 crores, 5.25 crores. Add these two. That will be 10.5 crores. To this you add 7.5 crore. How much are you getting? Adding these three. 18.25 crores. Correct? This is the total expense. This 18.25 crores is for 1 month or whole year? Whole year. That means this is for 12 months. Entire 12 months ka expenditure you are keeping it outstanding or only 1 month? So into 1 by 12 you do. How much are you getting? 1.5 crores is what they were. Is that okay? That is your outstanding expense. Any problem? Yes, sir. Total, if you add these two, you're going to get the total current liability, which is 2.1 crore. From current assets, if you deduct current liability, you'll get the net working capital. This is estimation of working capital. They tested through one case study. Just 3 MCQ questions. Usually they used to ask in format. Now you see how they can ask also. Same data, but asked in a different format. Okay. All right. Just as we say, no old wine in the new bottle. Can we go for case study over? No. Relating to estimation of working capital, case studies done. Now can we go further? They brought in factoring also here. Let's see. Entity is also considering reducing working capital requirement. They feel they're not able to manage. They want to reduce the working capital requirement either by 2 options. What are the 2 options? Either reduce the credit period to customer by a month. So how much credit period are you giving to debtors? 3 months. Now they are saying we'll reduce it by a month. That means now we want to give a credit to debtors only for 2 months, which will reduce the sales by 5%. So obviously, if you are reducing the credit period, debtors will buy more or he will buy less. So sales will, due to this policy, they are saying sales will reduce by 5%. Option number 1. Or engage with a factor for managing receivables. Or 1 minute, hang on. First, can we do it for one option, one by one? So what is the requirement is? One option is reduce the credit period. Second option is to go for factoring. So we have to probably suggest, or let's look at the third requirement. They're asking you the annualized cost of 2 options. Both the option has a cost. We have to find out the cost. On what basis? Annualized basis. So can we quickly do that? Okay, check this. I think I've solved. In the interest of time, we'll quickly go for it. Sir, currently how many units are you selling? So we are going first. We are testing option number 1. What is option number 1? Reduce your credit period by 1 month. Okay. So if you reduce your credit period by 1 month, what did they say? Sales will reduce by 5% or 15%? 5%. Okay. So due to this activity, sales will reduce by 5%. Currently, how many units are you selling? 3 lakh. If you reduce credit period by 1 month, will you be able to sell 3 lakh units going forward, or it will reduce? It will reduce by how much? 5%. So how many units you will not be able to sell? 15,000. So that means indirectly, how many units can you sell? Only 2,85,000. Comfortable? Okay. So tell me, sir, what will be the debtor balance? What will be the debtor balance? Will you calculate it on keeping sales in mind or cost of sales in mind? Cost of sale. How many units you will be selling in the new policy? 2,85,000. The selling price of each unit is 1,000. But for debtor calculation, we want selling price or we want cost of sale? Cost of sale. Cost of sale for 1 unit is how much? 7.5. So for 1 unit, it is 750. For 2,85,000, what will be the annual cost of credit sale basically? How much is, multiply that? How much is it? Ah, 3 crore 56 lakh. I know. No. You multiply 2 by 12 also. Okay, no problem. Once again, I didn't explain that. No issues. Sir, how many units will be able to sell it going forward? 2,85,000 units. And what is the cost per unit? 750. If you multiply these two, what are you going to get? Annual cash cost of credit sales. But we want annual cash cost of credit sales or directly debtors balance? Debtors balance. So this is annual data, no? Meaning this data represents how many months? 12 months. How many months credit are we giving under new policy? 2 months. So hence into 2 by 12. Comfortable? Previously when we calculated 3 by 12. But in the new policy, we are only giving 2 months credit. So this is basically your annual cash cost of credit sale. This is the credit period divided by 12 months. That is the number of days in a year. So what will become your debtors balance? 3 crores 56 lakh something. Currently, what is your debtor balance? We already calculated that. Currently, our debtor balance is 5. Or you can calculate in this fashion also. How many units, sir? Currently, how many units are you selling? 3 lakh. Will you take selling price or cost of sale? Cost of sale. For 1 unit, how much is the cost of sale? 750. For 3 lakh units, how much? 3 lakh into 750. How much are you going to get? 22 crores something. That 22 crores is for the whole year. So that means you will divide by 12. Multiplied by what? Credit period. How much is the current credit period? 3 months. If you calculate, what are you getting? 5 crore 62 lakh 50,000. Not only we calculated here also. 5 crore 62 lakh 50,000. Calculate again or copy the data. Copy. He's saying I'll copy. Done. Do that. Better. Okay. So existing, what is the debtor balance? 5 crore 62 lakh. If you go for new policy, what will become your debtor balance? 3 crore 56 lakh 25,000. That means your debtor balance is increasing or reducing. From 5 crore, it will become 3.5 crores. That means what will be the amount reduction in the value of debtors? 2 crore 6 lakh 25,000. Comfortable? Okay. This is the thing. Okay. Next. Sir, if you implement this credit policy, this 15,000 units, will you be able to sell or it's a loss for you? It's a loss for you because 15,000 units you'll not be able to sell. And what is the profit for one unit, they told, sir? Cost, selling price is 1,000. What is the cost of sale? 750. What is the profit per unit? 250 rupees. One unit you will make a profit of 250. And how many units you will not be able to sell? 15,000. How much profit you will lose? 37 lakh 50,000. This is the cost. This is the cost. Did they ask you cost in value or in percentage? Percentage. Now the same data you have to express it in percentage. It's a simple funda. Sir, you are losing something. What are you losing? Profit. How much profit are you losing? 37.5 lakh. But at the same time, your debtor is paying you early, no? Your debtor's balance is reducing. Yes. So the funda is simple. How do you express it in percentages? Remember like this, easy way to calculate. If you have 2 crore 6 lakh 25,000 money with you. You have 2 crore 6 lakh 25,000 money with you. You have to invest at that place, or you have to invest in such a way that you get a return of 37 lakh 50,000. You have to invest because this money you are getting this. See, sir, earlier how much money was blocked in debtors? 5 crores. Now how much is getting blocked? Only 3.5 crores. So that means how much money is getting released from debtor sooner? 2 crores 6 lakh 25,000. So if you're getting money sooner means you have to invest. You have to invest in such a way that it will compensate the loss in profit. How much is the loss in profit? 37 lakh 50,000. So basically, how do you calculate the return amount? You tell me. Or interest amount? How do you calculate? So basically, you will take the investment ka value and you will multiply the interest ka rate. Okay, now, sir, if I give you the interest amount, if I give you the value, can you find out rate for me? So tell me, how do you find out interest rate, sir? Interest amount divided by the value of investment. Can I say like that? So here, how much is your interest amount? That is nothing but your 37 lakh 50,000. How much can you invest? 37.5 lakh divided by investment value is how much? 2 crore 6 lakh 25,000. So into 100, you do express it in percentage. How much are you getting? 18.8 percentage. Or if you want it in simple formula, it is simply nothing but loss of profit divided by amount released from debtors into 100. Okay. Or logically, it's a simple way like this. You are getting this much money sooner from debtors, but you're losing how much profit? 37 lakh 50,000. So you have to invest this 2 crore in such a way that you get a return of 37 lakh 50,000. So that's all. So the percentage you need to find out. So it is just finally GP percentage. How do you get GP percentage? GP upon sales into 100. How much is GP? 37 lakh 50,000. Sales, instead of sales, here we're talking about the debtor value. How much is the debtor value? 2 crore 6 lakh 25,000. That percentage that they're asking over. Okay. If you get this much return, then there is no loss for you. If you don't get, means that is a cost for you. That's what we're trying to say. This is your annual cost of reducing your credit policy. Comfortable? Once go through this question. Not popular. As I said, sir, RTP question sometimes can be a little tricky. Exam question usually will not be so much tricky every attempt. Some attempt it will be. Not in every attempt. But once in a while, whenever there is a tricky question, just go through it once because it may come also. But did you understand what we discussed here? Give me a quick breakup of this. What is this now? Overview is what? Credit period you are increasing or reducing? Reducing. So just first, due to reduction, first find out how much will be your new debtor balance. Compare new debtor balance with existing debtor balance. Obviously, what do you think? New debtor balance will be lesser. That means you will recover money from debtors sooner. That is one. But if you are reducing credit period, means are you able to sell same units or lesser units? How much lesser units? 15,000 units lesser. You are not able to sell 15,000. If you're not able to sell 15,000 means on that 15,000 you lose profit. So how much loss of profit? 37 lakh 50,000. So this is your GP amount. Reduction from debtors is like your sales amount. Now calculate GP percentage. Visualize like that. You make your own formulas. It's okay. How do you calculate GP percentage? GP upon sales into 100. Here what is GP? Loss of profit. What is sale? Amount reduced from debtors. So bring that into numerator and calculate the percentage. Okay, now this is one. Option number A. That's all. One more is there. One more is that. How can we read the data? Okay. Option number B is engaging with a factor. You can go for a factoring arrangement, meaning you will not reduce a credit period. You will sell the debtor to a factor who will charge a commission of 2% of the invoice value, and who will also advance 65% of the receivables at 12% per annum. That means factor is charging some commission also. He's charging some interest also. What is the interest rate he's charging? 12%. This will lead to savings in administrative cost and bad debts to the extent of 20 lakh and 16 lakh respectively. That means what is the total savings? 36 lakh. Obviously, I told you. So when you get into factoring arrangement, there will be some benefit as well as there will be some cost. What is the benefit? Administrative cost and bad debts saved is your benefit. What is the cost? Commission and interest. You need to calculate. I think here what is the requirement is you need to calculate the cost of both the option. That means with factoring arrangement, you are not getting net benefit, you are getting net cost. That net cost, no, they don't want it in value, they want it in percentage. Okay, same drama. I'll give you one formula for this. Remember and calculate. It will be a lot easier. Multiple ways to do it. I'll give you one formula. Same formula, we'll apply it in one more question also. It will become like a practice. First let's calculate factoring arrangement. Is factor charging some commission? Yes. What percentage commission? 2% of the invoice value. Invoice value means cost of sale or actual sales. Actual sales. What is your actual sales? 30 crore. Into 2% is how much? 60 lakhs. That is your factoring ka commission. Okay. Next. Sir, entire 30 crore is factor giving you as an advance or only 65%? 65%. So 30, because I'm not telling. They only told in the problem. Only 65% will be advanced. So 30 crore ka 65% you do, sir. How much is it? Calculate. 30 crore ka 65%. How much is that? Okay. So 19 crore 50 lakhs. Okay, fine. You got some number. So how much interest is being charged? They told in the problem. How much interest are you charging? You are charging interest at the rate of 12% per annum. So into 12% will you do? Into 12% you do. Okay, that means, so this is the interest for the whole year. This is the interest for the whole year. But hang on. The factor, he is giving you advance. Why is he giving you, why is he collecting interest from you? Because he's getting money from the debtors now or later? Later. In my example here, A Limited, they had some debtor. And A Limited sold the debtor to whom? Factor. That debtor had a credit period of how many days? 60 days. Okay. Alright. Now, factor gave the money to A Limited immediately. But he is collecting money from this debtor after 60 days. I mean, since there is a delay in payment, factor is also asking for some interest. Correct? Now, you tell me, is the delay in payment entire year or only 3 months? 3 months. Why 3 months? Because debtor ka credit period is only 3 months. Hence, you will calculate it as 3 by 12. Comfortable? So, 30 crore is the sale value into 65%. That's what they told. Okay. Into interest rate of 12%. But the interest rate is for whole year. But here, how many year? Whole year, the delay in payment or only 3 months? 3 months. Hence, 3 by 12 you do. Is that okay now? No, not that. No, this is not. He's saying, sir, is old policy and new same? No. The reduction of credit policy is a different policy. Factoring arrangement is entirely different. So here credit period is still 3 months. If you go for factoring arrangement, you will not reduce your credit period. Credit period is still 3 months. So all of you got it. So that means what is the interest, sir? 58.5 lakh. So what is the commission you got previously? 60 lakh. What is the interest you got it? 58.5 lakh. Is there any savings? Yeah, there is a savings in your administrative cost of 20 lakh and bad debts loss of 16 lakh something they told. So total is how much? 36 lakh. So calculate the net cost for me, sir. Net cost for me. How much is that? 60 lakh cost of commission, interest cost of 58.5 lakh, and there is a benefit of only 36 lakh. So if you calculate the net cost, how much is that? 82. They are saying here 82.5 lakh. You're getting the same number. 82.5 lakh rupees is the net cost of factoring. Understood? Any problem? This 82.5 crores is the value, but they asked you in value or in percentage. Percentage. How to calculate the percentages? Remember one simple funda, it's easier. Okay, so if you want the annual cost of factoring, that's given by the formula annual net cost divided by the amount paid. Divided by the amount paid. So do you know the annual net cost? Yeah, annual net cost we only calculated over here, which is 82.5 crores. Comfortable? Divided by amount paid. Amount paid is what, sir? What is the total invoice value? 30 crores. Into, is entire invoice value factor is ready to give advance or only 65%? 65%. Yes. But factor will give the advance based on sale value or based on debtor balance? Factor. Remember, factoring arrangement. In factoring arrangement, what are you doing? You are selling debtors. You are selling debtors. What is this 30 crore? Is it debtors value or sales value? Sales value. Sales value is 30 crore, but entire value is giving or only 65%. 65%. Okay. So if you do this, you want to get sales value. But advances amount is paid by the factor not on sales value, but on the debtor balance. That means this is for the whole year, no? This is for the whole year. Debtor. So calculate this. 30 crore ka 65% is how much, sir? 30 crore ka 65% is how much? 19.5 crore. This is for 1 day, 2 day, or whole year. This 19.5 crore is for the whole year. That is for 12 months. So will you give entire 12 months credit to debtors or only 3 months? 3 months. That means what is your debtors balance? That is 3 by 12. How much is that, sir? 4.875 crores. That is the amount paid by the factor to the company. So cost is 82.5 lakh and amount paid is 4.85 crores. So they are giving, like, visualize, factor is giving you 4.875 crores loan. On that loan, he is collecting a net cost of how much? 82.5 lakh. It's like loan. This 82.5 lakh rupees is your interest amount. 4.875 crores is your principal amount. How do you calculate the interest amount? Interest rate. So simply, if you want it as formula, it is nothing but annual net cost divided by amount paid by the factor. So how much is the annual net cost? 82.5 lakhs divided by amount paid is how much? 4.875 crores. If you do that, you're going to get annual cost of factoring to be 16.92%. Same, I know that we are doing it for the first time. So I'll again do it in one more question in the same fashion. Okay. Now let's go back and recap this once. So what is this factoring arrangement? First, calculate the net cost or net benefit. Here in this problem, clearly told that there is a cost. That means here will be a net benefit or net cost. Net cost. How do you calculate net cost? Add all the cost, deduct all the benefits. So what are the cost? Commission. Then interest. That we calculate. Comfortable with that interest calculation, factors calculation? Okay. So you want me to repeat or okay? Okay. So that we calculated that. Then savings was there, 36 lakh that we deducted. We got a net cost of how much? 82.5 lakh. So this is the cost factor is charging from us in a way. Yes, no? Okay. Now, how do you calculate the net factoring cost in percentage? The net cost in your numerator divided by amount paid. But what do we get from the factor? We get some amount. So basically what you should consider in the numerator, net cost amount divided by amount received. Divided by amount received. Amount the factor will pay based on sale value or debtors value. Debtors value. So what is this 30 crore? 30 crore is a sale value. 30 crore is a sale value. Or simply take like this. 30 crore is a sale value. This 30 crore is a sale value for 1 month or whole year? Whole year. That means this is for 12 months. Entire 12 months credit you're giving to debtors or only 3 months? 3 months. So first do this if you want. 30 crore ka 3 by 12 you do. How much are you getting? 7.5 crore. This is the debtor balance. An entire debtor balance factor is giving the advance or only 65%? Only 65% of debtor only is giving us advance. Calculate this. How much are you getting? 4.875. Yeah? 4.875 crores. That is the amount paid by the factor to the company. So this is the amount paid and that is the cost he is charging. So basically the formula for annual cost of factoring is what? Annual net cost divided by amount paid into 100. That's it. Okay, G. Go through all these questions once you need to go through. I mean, we had only done factoring cost ka net benefit. We had not calculated net benefit in percentage. Like that problem, we didn't have it. Now it has come in. New things will come every attempt. Okay, we have to be prepared for everything. But easy only. Yes or no? One extra thing you need to remember. That's a simple. Once again, I'll repeat. What is that? How do you calculate net cost? Annual net cost divided by amount paid will simply give you factoring ka cost on a per annum basis. Okay. Can I go for the next? I think that we have one more requirement over here. What is one more requirement? Maximum permissible finance also they are asking. Okay. Ton bantu. Entity is also considering funding of part of working capital by bank purpose. For this purpose, bank has stipulated that it will grant 75% of net current assets. Not current assets. Net current assets. Net current assets means current assets minus current liability. So indirectly they're telling you what? 75% of working capital will give it as finance. Sir, do you know working capital? Yeah, working capital somewhere we calculated. Papa, where is that? Here. What is working capital? Take your calculator. 7 crore 25 lakh 41,667. Calculate 75% of that. 5 crore 44 lakh 06 250. That is the maximum permissible finance as per Tandon committee. Okay, Ji. Okay, one more requirement is there in the same question. Let's see what is that requirement. Maximum permissible finance and the percentage cost of the same. On the loan, obviously, there will be interest rate. That interest percentage they're asking. So let's read the sentence as it is. The entity is also considering funding of working capital by bank loan. For this purpose, bank has stipulated it will grant 75% of net current assets as advance against working capital. That is your working capital loan. Bank has quoted 16.5% rate of interest. Oh, that means question only there is answer, no? They ask you the interest rate. What is the interest rate? 16.5%. If they had stopped the question there, we would have selected 16.5 and then moved on to the next question. But unfortunately, ICA, extra goalie they will always keep. Let's read. 16.5 rate of interest with a condition. What is that condition? Of opening a current account. So bank is saying, I will give you a loan, but you need to open a current account, which will require 10% of the loan amount to be maintained as minimum average balance. They're saying, I will give you a loan, 10% of that loan you should not touch. You should keep it as minimum balance. That means you tell me 16.5% is the interest rate on 100% loan amount or 90%? 90%. Why 90%? 10% of the loan amount you cannot touch because you have to keep it as a minimum balance, proration. 16.5% is a interest rate on a loan amount of only 90%. For 100%, how much is the interest rate? Prorate Madipa. Basically 16.5 into 100 divided by 90. How much is that? 18.33%. That is the cost. Understood? If that minimum balance condition was not there, means 16.5% itself would have been interest rate. Because of that, it became like this. Okay. Suppose they tell you have to maintain 15% minimum balance. Then calculate the interest for me. Let's see. Suppose if they say maintain minimum balance of 15%, I'll not show you the working. So tell me, guide me, how will you calculate? 16.5% is the interest rate for how much percentage now? 85%, because 15% of the loan you cannot touch. I mean 16.5% is the interest rate for 85%. For 100%, how much? Like that you need to prorate. Not asked, just I am telling for my satisfaction. Okay. So that is the question. Very good case study. Came for, I don't know how many marks. The marks in RTP, they'll not mention. I will say, give 100 marks for this case study only and finish it off. Better no. So much they're asking. Yeah. Difficult. So much thing fitting in one question is overload. But RTP questions sometimes they come like this. Okay. But overall concept, did you understand? One new concept you need to remember is the factoring ka annual percentage. That is one thing. How to calculate that. That's one new takeaway. And loan, if it has any minimum balance condition, how to find out the cost. That's the fun. Correct. No, it's like, see, he's saying, sir, we are paying anyway interest to the bank loan at 16.5% only. No, FM is on the decision making side. FM, you are paying 16.5% to the bank on a legality basis. But in reality, we know that we are paying 18% interest rate because full loan we are not able to utilize. Full money we are not able to utilize. So this is for the decision making, not accounting. Accounting, this is notional. For decision making, in FM, we also consider opportunity cost like that. So decision making, all that notional also should come into picture. Correct. Notional only, but relevant for decision making. Okay, somebody got up and went on. She's like, enough. Okay, one more question I will do and I will leave. Okay. Yesterday I left early, no? Yesterday's target we underestimated. Today's target we, I think, yeah, yesterday's went over a lot sooner. This time, yeah, it's fine, no problem. These two topics are such way that it will take some time. There are a lot of questions around this. In fact, for working capital management only, I think we have solved more than 40. Investment decision also more than 40, 45 questions. 43. Because that much of concepts are there. We have to cover it. What to do? No problem. Here, can we run through? Okay, NV Industries. You're not saying no, but I will take it as a yes. Yeah. So one manufacturing industry is there. It supplies small articles. Blah, blah, blah. Goalie they've given. Sales stands at 200 lakh, of which 80% is credit sales. Great. The company has a credit policy of 2/40 net 120. What does that mean? 2/40 net 120 means we will give 2% discount to our debtors, provided he makes the payment within 40 days. Else, he has to pay within the normal credit of 120. Normal credit is 120 days. Only for those debtors who pay us within 40 days, we give them a discount of 2%. Past experience shows that on an average, 50% of the customers will avail discount. Balance 50% will settle the payment within 120 days. So that means we have a 50-50 split up ratio. Okay. The finance controller is saying that bad debts loss is about 1%. Okay. That CFO knows, or he has his jobless, he's asking you some questions. So don't worry about all that. Firm spends 2,40,000 to administer the credit sale. This is your administrative cost. So if you go for factoring arrangement, this administrative cost will be there, or you will save. These are avoidable as factoring firm is prepared, blah, blah, blah. It will charge a commission of 2%. The factor will charge a commission of 2%. It will pay an advance against receivables at an interest rate of 18% after withholding 10% as reserve. Okay. Company has an option to take a 15% interest, or it may take a bank finance working capital loan of 14%. I don't know what they're asking. We'll see. So CFO has some question. He's saying, prepare and come. I'll ask you questions. What question he's asking? First question. What is the average level of account receivable? Debtor balance they're asking. Okay. Debtor balance will arise with respect to credit sale. Sir, it's not working capital estimate. Don't left, right, center put everywhere. Average level of receivables. First of all, cost data and all, they were never given there. Okay. So calculate based on what here? Sales only. Okay, now? Yeah. But 1 minute, what is the total sales? 200 lakh. On 200 lakh sales, debtor will arise, or debtors will come only on credit sales? Credit sales. How much is credit sales? Can we look through? Would you be okay with that? I think they have done beautiful table. Solution, it's good. We'll go through this. What is the total sales? 200. This is a working note. Using this working note, you can answer a few questions, few MCQ questions. Total sales is 200 lakh, but we don't want total sales. We want credit sales, which is what? 80%. So 200 lakh ka 80% is 160 lakhs. That's one. Done. Now, sir, can you calculate debtors from this? Yeah. 160 lakh is a data for, they've expressed the data in months, days. What is over here? Days. So have they told take only 365 days, 360 days? In the next line, they told take only 360 days. So read the problem fully. Sometimes last bit they include all this. So here, normally, how do you calculate? 160 lakhs is the data for how many days? For the whole year, which is 360 days. We want what, sir? Debtor. For debtors, we want what? Credit period. Credit period. Let's say credit period is 50 days. How do you calculate debtor? Pro rate. 160 into 50 divided by 360. But the problem here is 50% of debtors will pay early. 50% will pay later. How to take? That is the drama. Understood the drama here? Simple only. But overall, we get where we getting stuck. Okay. Usually, how many days credit are we giving to debtors? 120 days. Yes, sir. Right? 120 days. Will entire people avail 120 days or only 50%? 50%. That means 50% will go for, in a way, when you prorate, you're going to get 60 days. What about the other one? Other one will go for discount option. How many days they have to pay in advance to get the discount? 40 days they need to pay. What percentage of people will go for this discount option? 50%. That means how much effectively you're going to get? 60. That means average, when you calculate average, you say on an average, debtors outstanding is for 80 days, like that. That's it. Did you understand? So if you have multiple options where some section of debtors will go for advance, some will go for discount option, some will not go for discount option. That is, simply take their credit period and multiply the percentage. What is the probability chance? This 120 days ka debtors, how many of them will go? 100% of them will go, or only 50%? 50%. So multiply, you're going to get 60 days. Discount option, if they want to pay, if they want to get, means they have to pay us within 40 days. 100% of them will not avail discount option. Only 50% will opt. That means effectively it comes to 20 days. So average here, you have to get this, not simple average. Even if you want, you can calculate simple average also here. 120 plus 40 divided by 2 is how much? 80 days. That way also you can get it. But I prefer don't go for simple average. Here simple average and weighted average is working out because percentage is same. Suppose they say 25, 35, 75, 25, it may get you a different number. So always calculate like this only, better. Okay, take the days multiplied by the percentage of debtors going for that particular option. So how many days is this now? 80 days. Any drama? No. Now we can easily calculate. What is the credit sale ka total value? 160 lakh. 160 lakh is for how many days? 360 days. For on an average, how many? What is the credit period of debtors? 80 days. For 80 days, how much is it? So 35 lakh 55,556. Correct? That is what they've got over here. Average level of receivable is 35 lakh 55,556. 56. That is the answer to question number 1. Can we go per second question? Or can we finish off this data and then look at the second question? Or maybe once we'll go through that is okay. How much advance factor will pay against a receivable? Factor will pay advance on what? Sale amount or receivable amount? Receivable amount. So did we already get receivable amount? Yeah, receivable amount is how much, sir? 35 lakh 55,556. That's one. Now entire amount factor will give us advance, or there are two elements. In fact, there are three elements over here. What are those? One, he will deduct his commission. Two, he will deduct 10% as reserve in this problem. Last problem not there. Here 10% reserve. Then he is only charging commission or also interest. Interest. So all the three he will deduct. Balance amount he will give as swaha to us. Correct? So three things we need to calculate. Fadafat, can we calculate? So what is commission amount, sir? Commission they only gave in the question. How much is that? 2%. So what is the average debtors? 35 lakh, 55, 56. So this got 2% you do. How much are you going to get? 71,111. That much will be deducted as commission. Correct? Second, reserve of 35 lakh 55. Of the debtor balance, 10% he will withhold as reserve. Not me question telling. Correct? So calculate 10% of 35 lakh 55 666. How much it's going to be? 3 lakh 55 556 rupees. That will be withheld as reserve. Why reserve? We don't know. In fact, that is an arrangement between company and factor. Let's not worry. That's all. One more. What is that? Interest. Now you tell, sir. Okay, take your calculator. What is the debtor balance? 35 lakh 55 666. In that, you deduct the commission of 71,111. How much remains? 71,111 you deduct. From this, you deduct this, sir. That's all. One by one, I'll keep telling you, keep deducting. 35 lakh 55 556 minus 71,111 you do. How much are you getting? Are you getting some number? Correct? Will that amount be paid to the company? No. They will also deduct what? 10% is reserve. What is the reserve amount? 3 lakh 55 556. Reduce again 3 lakh 55 556. How much remains? 31 lakh 28 889. This is amount available to be given as advance. Correct? This is the amount available. On this, they will calculate interest. On this, they will calculate interest. What rate? Oh, interest is calculated at the rate of 18%. So calculate 31 lakh 28 889 ka 18% you calculate. 1 minute. 18% you calculated. That 18% is for the whole year. Funds are getting blocked for whole year. What is the credit period we are giving? What is the average credit period we are giving to debtors? 80 days. Hence, what we have to do here. In the previous problem, I think we did 3 by 12. Because credit period was 3 months. Here, how much is the credit period? 80 days. So don't do 80 divided by 365. Take 80 by 360. So into 80 by 360 you do. Basically 31 lakh 28 889 into 18% into 80 divided by 360. How much is that? 1 lakh 25 156. This also factor will reduce. Then pay the balance amount to debtors. Okay, na? That's all. Got it? So quick run through of this. What is this again? First, find out the average debtor balance. From debtor balance, 2% will be given as commission. Then on the debtor balance, 10% will be withheld as reserve. So if you deduct this commission amount and reserve amount, you will get 31 lakh 28 some amount. On that, that is the amount available to be given as loan. On that, interest will be calculated. At what rate? 18%. But 18% is for the whole year. But average debtor is only for 80 days. So into 80 by 360 you do, you will get the debtor interest amount. Interest also will be deducted and balance will be given off to us as the fund from the factor. So answer to option number, second answer is 30 lakh 3,333. Got it? Okay, not over. Next, what is the annual cost of factoring? Annual, not percentage, annual cost. Okay, sir, all these costs are not annual. Why? Because this 35 lakh is what, sir? Average debtor balance for only 80 days. So that means all this cost, factoring commission, whatever you have found out is for only for 80 days. But did they ask you 80 days ka cost or annual cost? So what is this? The 70 lakh 111, if you want to prorate, the 70 lakh 111 and all is a cost for 80 days. We want it for whole year. Whole year means how many days here? 360 days. So what do you have to do here? Take this cost, multiply by 360 divided by 80. That's what they've done. For each cost, do the same thing. For factoring cost commission also do like that. Interest cost also do the same thing. Comfortable? Any doubt to? Got it. Got it. So these two are the cost of. They ask net cost. They ask the annual. When they ask annual cost, they mean to say the net cost. Okay. So now net cost, I think actually net cost they ask or annual cost only. Oh, actually they ask net cost and annual cost separately. So they asked first annual cost. What is annual cost, sir? These two. It is 8,83,200. In the next option, they are asking you annual net cost, not in percentage, annual net cost. How do you calculate net cost? From the cost, reduce the benefit. Is there any benefits due to factoring? Yeah. One administrative cost of 2,40,000 you will save. And bad debts law somewhere we read, no? 1% of credit sale is a bad debt. We will incur this or we will save due to factoring. Save. So administrative cost of 2,40,000 you will save. And bad debts of 1%. 1% you will apply on, don't apply it on what? On 1% on credit sales they told. What is the credit sale value? 1 crore 60 lakh. 1 crore 60 lakh ka 1% is how much? 1,60,000. So total savings is 4 lakh. Cost was how much? 8,83,200. 8,83,200 is a cost. Benefit is 4 lakh. So what is the net cost? 4,83,200. Understood? 4,83,200 is a net cost. G, this is where you should say yes or no, G. Yes, sir. Leave, sir. They're telling. Yeah, I will leave you. Okay, now last your favorite, cost of factoring. Effective cost of factoring. You tell me the cost of factoring now. Let's see. What is the formula? Annual net cost divided by amount paid by the factor. Yes. How much is the annual net cost? 4,83,200 divided by amount paid by the factor. How much amount factor paid? Oh, 30 lakh. Oh, 3,000. Oh, 733 into 100 madi because we want percentage. 16.09%. You experts, I tell you. Over. That's all. Go through these questions, 2 questions once, just to be on the safer side. I'm not saying it will come because it has 1 or 2 new concepts. New concepts has to be revised 1 or 2 times more just to be on the safer side. Preferably going home immediately do it. Okay, because these are things, you know. Now in class you will say, oh, super. After going home, dabba fellow, what did he teach? Nothing understanding. That sort of feeling will be reached soon. So go through it once so that things get registered. And whatever you understood, especially when the question is little new and it is little tricky, whatever you understood, write down a small pointer. This is what you need to do. This is how you should arrive. Like that, some pointers you make so that on the examination day, it will not freak you. It should guide you. Okay, hang on. You are packing. I am in a mood to do one more question. Budget. Another popular question from this particular topic is preparation of cash budget. Very straightforward, not a big deal. Cash budget questions are very, very easy, but they're very, very lengthy. Question is that, okay, simply you need to prepare a cash budget forecast. So let's learn that with the help of this particular question itself. This is a study material question. So some Zeta Limited is there. Selling price of the book. They are publishing company, book publishing company. Selling price is 15. Okay. They have various costs. Material cost is 5 rupees. Labor cost is 4. Overhead cost is 2. If you're producing the goods, obviously you will incur various costs given. Sales manager has given the following data. So what does sales manager forecast? What will sales manager forecast? Books published or books sold? Sold. Sales manager gives you data relating to sales. No. Sales they have given from November to January. In fact, from November to August they have given. Many months ka sales they have given. Customers are expected to pay as follows. 1 month after sale, 40% we will collect. 2 months after sale, we will collect 60%. So basically, we are not collecting the entire money in one go. We are collecting it in 2 installments. Within 1 month, they are expected to pay 40. Within 2 months, 60%. Company produces the books. Obviously, we are not a dealer. We are publisher. So that means first we will publish the book, meaning we will produce the book. Then only we will sell. Company produces the books 2 months before they are sold. So if you want to sell it in May, you have to produce it in March only. Correct? No, 2 months before. If you want to sell it in August, you have to produce that books in June itself. Yes? Okay. And the creditors for material are paid 2 months after production. So if you're producing this month means for raw material payment to creditors, we paid this month only or 2 months later? 2 months later. Basically, creditor is ready to give us 2 months credit. Variable overheads are paid in the month following production. So this month if you produce, variable overheads you will settle in the next month. And expected to increase by 25% in April. So currently what is variable overheads? Overheads is 2. Correct. Now here only they have given. In fact, variable which overhead? Variable overheads. Okay. So don't say labor. Labor they have given extra thing. How much is the variable overheads currently? 2 rupees. So it will be same 2 rupees. Now from April onwards it will increase by 25%. That means it will become 2.5. Okay. 75% of the wages are paid in the month of production. This month if you're producing means Wages cost of 75% will settle in this month only. 25% will pay it in the next month. Wage increase of 12.5% will take place in March. Currently, what is our labor cost? 4. Will it be 4 only, or it will increase by 12.5%? It will increase by 12.5%. 4 plus 12.5% you do, how much are you getting? 4.5. From March onwards, that is 1st March onwards, labor cost will become 4.5. Don't be freaked out by the data. This is very, very simple. Once you kind of identify and put up a format, it will keep falling in place. Company is going through restructuring and they'll sell one of the freehold properties in May. Sir, in cash budget, all you have to do is, if there is an inflow, show it as positive number. Outflow, negative number. In the respective months, they'll ask you to prepare budget for maybe 3 months, 5 months, 6 months, whatever, usually. So whichever month, whatever cash inflow or outflow is happening, capture that. That's all. So in May, you will sell the property, means it's an outflow or inflow? Inflow. But it is also planning to buy a new machinery in May for 10,000. If you're buying a new machinery, means it's an inflow or outflow? Outflow. Depreciation. I'll not even bother about depreciation. We are preparing cash budget. Depreciation is a cash expense or non-cash expense. That means the depreciation data is totally goalie. If they give it, they are only given to confuse you. So do not bother. Forget about it. Company's corporate tax of 10,000 is due for payment in March. That means what is this? Tax payment is an outflow again. That will happen in March. You need to prepare budget, sir, for 6 months from January to June. They are saying cash ka balance as on 31st December 20x3 is 1,500. You need to prepare budget from January to June 20x4. That means previous year will end on which date? 31st December 20x3. So previous year ka closing balance will become current year ka opening balance. That's what they've given. Opening balance of cash is 1,500. Simple data. First they've given sales. From November to August, whatever data they've given, I've just copied from here to here. Ditto data. Okay. Sir, are you selling these books? Yes. At what value? 15. One book you will sell it at 15 rupees. So how many books you are planning to sell in respective months? This 1,000 books you are planning to sell in November, and each book ka selling price is how much? 15. That means what is your sales value? 1,000 into 15, which is 15,000. Like that, we have found out sales value for all the things. Okay, now that's what they're calling it as sales value multiplied by 50. Okay, now if you sell it in November, you will recover the money in November only. Now what is the arrangement? All these sales are on a credit basis. So what did they say for the sales? 1 month after sale, you will collect 40%. 2 months after sale, you will collect 60%. So how much sales you made in November? 15,000. 15,000 you will collect it in November only. No, 40% of that you will collect it in December. Calculate, take your calculator. 15,000 into 40% you do. How much is that? 6,000. Luckily, everybody is packed today. 15,000 into 40% is 6,000. That you will collect it in December. Now, 2 months after sale, how much you will collect? Balance 60%. So 15,000 ka 60% you do. How much is that? 9,000. Like this, you will do the collection. Can I show it for one more? Can you fill it up? Now here, what are the sales in February? 18,750. If you sell 18,750 in February, you will collect money in February only or in March? March, how much will you collect? 40%. So calculate 18,750 ka 40%. 7,500. Balance 60% you will collect it in the next month. So 18,750 ka 60% you do. How much is that? 7,250. Like this you have to calculate for each month. Can you manage that? Now we want are we preparing the budget from November to June or January? January to June is our budget period. Hence they have totaled only from January to June. Other months, though it is calculated, they have not done the total because it is not required for our budget. Okay, fine. Sir, why did we have November column? Because if you sell in November, 40% you will collect it in December. 60% you will collect it in January, and January is our budget period. That's the reason we started the data from November. Okay, now that's the reason they've copied as it is. This is about money received from debtors. Money received from debtors is what, sir? Inflow or outflow? Inflow. So receipt basically. Next, we have to calculate all the payments. First payment we'll calculate for material. We'll read the material ka data once again. What did they say for material? The company produces the books 2 months before production, and creditors for material are paid 2 months after production. Okay. Now let's take this data like this. What is our or maybe here also it started from November only because it's okay. No issues. Now how? Look at this. Sir, in January, May, if you want to sell 1,000 books, in January, May, if you want to sell 1,000 books, you will produce the books in January only or 2 months before? 2 months before. So January, May, if you want to sell 1,000 units, means in November only you should have produced 1,000. So from here, you need to start copying the data one by one. Is that okay with you? Once again, can I tell? One more, can we? So in February, if you want to sell 1250 books, what you have to do? 2 months before only you need to produce. What is 2 months before February? December. So that means in December only you should have produced 1250 books. Same thing. In May month, if you want to sell 1900 books, means 2 months before. That is in March only you should have produced 1900, like that. So basically you need to copy this data. If you want November ka data, you should start copying from January. So start copying from here to here. Okay now. Sir, after June, what is there, sir? July, August data is given over here. 2200 and 2300. That you can bring it from here. Okay, everybody. That's how you need to copy. I'm revising. Hope I'm not doing everything. That's okay with you? Okay. So this is your books produced. For producing the books, do you need materials? Yes. What is the material cost per book? 5 rupees. So you are producing how many books in November? 1000. What is the material cost per book? 5. And material cost, is it changing? No. Only labor cost and overhead cost is changing. Material cost is same. So whatever books you are producing, multiplied by 5. Because to produce one book, you will incur a material cost of 5. Just multiply this by 5, you will get the respective material cost. Yes, sir. Is this cost paid in that month only or 2 months later? What did they say? Whatever is the material cost, you will settle after 2 months. What is the material cost of November? 5000. That you will settle in November or January? You will settle 2 months later, which is January. That's what is the next table all about. So November, whatever production cost, material cost you have incurred, that you will settle it in January. Is that okay? Okay. If you want, we can write it. This column, maybe for my simplicity, I'll fill it up. You tell me, what is the payment here? December month, you have incurred 6250 cost. When will you settle that? 2 months later, which is February. January, you have incurred 7500. When will you pay that? March. Okay, like that, can you fill it up? That is what they've done here. All these are what, sir? Payment as an outflow. Okay. Now one payment done. Another 2 payments if you're done. Question only is over. Next is what, sir? Labor overheads. Labor overheads also you will incur on the goods produced only. Books produced for respective months are already captured here. So copy the same data. They have captured from November to whatever June. Same data you copy. Now variable overheads. What is the cost? Variable overhead. The cost is 2 rupees. Is it same every year or it will change? They said variable overheads will change, will increase by 25% in April. So that means till March, the variable overhead cost is 2 rupees. From April onwards, it will become 2.5. For one book, variable overhead cost is 2 rupees till March. From April onwards, one book will cost 2.5 rupees. So here, so this is what, sir? Cutoff period is what here? Till March. Till March, what will be the cost per book? 2 rupees. So take the number of books produced, multiply by 2. That's what they've done here. 1900 into 2 will give you 3800. 1500 into 2 will give you 3000. Like that. But from April onwards, what will be the cost? Will it be 2 or 2.5? How many units did you produce in April? 2200. 2200 into 2.5 you do. You're going to get 5500. June, May, 2300 into 2.5. How much is that? 575. Like this. So what is this? This is payment or cost? Cost. This is variable overhead cost. When are you paying variable overheads? Check. Variable overheads, what did they say? Variable overheads are paid in the 1 month following production. So if you produce this month ka variable cost you will incur this month only or next month? Next month. What is November ka variable overhead cost? 2000. That will be settled when? December, 1 month later. What is January ka variable overhead cost? 3000. That will be settled in February. What is March ka variable overhead cost? 3800. That will be settled in April. May ka overhead cost will be settled in June. Like that. This is your payment. Is that okay? Or outflow. That is what we need to capture in our budget. We don't want cost. We are preparing cash budget, means we want cash inflows and cash outflow. We are not preparing P&L. So we don't want cost. We only want inflows and outflows. Great. Next is wages. Wages also you will incur on what, sir? Goods produced only. Okay. Wages cost, what did they say? 75% of wages are paid in that month only. 25% you will pay it in following month. Okay. Here they have started the data from December. Why have they started in December? Because previous and all they started in November. Why here they started from December? Because if you do calculate from November also you can do, no problem. If you are incurring any labor cost in November, 75% of that labor cost you will settle in November only. Balance 25% you will incur in December. But our budget period starts only from January. That's the reason they've started the data from December. If you want, you can start the data from November also. No harm. Is that okay with you? All right. So what is the quantity produced in December? This data they've copied from here. These are all the data which is copied from the above table. Okay. What is the overhead cost or wages cost? Till, what did they say? Till March, it will be 4 rupees. Till March or till February? Because wage revision happened at the end of the March or 1st March? 1st March. That means till February, the wages cost is 4 rupees. From March onwards, it will become 4.5. So whatever quantity you produce, multiply by 4 and 4.5. Till February, you will multiply by 4. From March onwards, you will multiply by 4.5. That will give you your cost. Is that okay? This is your wages cost. Agreed? What about settlement of cost? When will the settlement happen? How is this settled? 75% of the cost will be settled that month only. What is the wages cost for December? 5,000. 5,000 ka 75% you do. How much is that? 3750. That will be settled in that month only. Balance 25%. 5,000 ka 25% is how much? 1250. That will be settled in the next month. Maybe one more I'll take you through. March ka wages cost is how much? 8550. That is the cost. How much will you pay? 75% you will pay in that month only. 8550 ka 75% you do. How much are you getting? 6412. So out of 8550, 75%, that is 6412 you will settle that month only. 25% next month. 8550 ka 25% you do. 2137. Like that. So if you add both, you will get the total payment made to laborers. So capture all this information in your budget. That's all. Do not forget the machinery purchase. One freehold property you sold. One freehold property you purchased. And some tax you paid in the respective months. Rest every data is sales or material or overhead labor. Okay now. So if you do all this, this is your receipt. Receipt minus payment will give you what? Or maybe for 1 month I'll do. What is the total receipt? 15,000. What is the total payment? 13,250. Take your calculator. 15,000 is receipt for Jan. Payment is 13,250. What are you getting? 1750. Negative cash or extra cash? Surplus we have. Correct now? So that means in January, we generated extra cash of 1750. We already had opening balance. Huh? Yeah. What was last year opening balance? Last year opening balance was 1,500. We already had an opening balance of 1,500. In January, May, we generated extra cash of 1750. So what is cash ka closing balance? 3250. January month ka closing balance will become February month ka opening balance. Like this. Closing balance of this will become opening balance of next month. Like that, go on filling it up. Yes, sir. Very easy question, but you can do a lot of arithmetical mistakes in these sort of problems. So watch out for it. Budget is, if it comes, should be happiest. Okay. Then all that factoring, goli-gili and all, this is very, very straightforward, but quite lengthy. It will take some time. The challenging in case of budgeting is the time constraint. Okay. Yes. With this, officially FM ka marathon we have completed. So thank you so much for your time and patience. Now 2 minutes, I'll just take your time quickly. Now, sir, whatever possible from my end, whatever I felt was important or whatever I felt I should cover, I've tried my best to cover within the stipulated time. I kept about 8 hours, 7 to 8 hours as a target. I think more or less I've fulfilled that in this particular marathon. So it was possible through your active cooperation also. So thank you for that. So now, excuse me. So yes, I hope that this marathon will be helpful to you and all that stuff. That is your personal call. I'll not comment on that. But more importantly, we have around roughly 20 or 22 days for our exams. If you're writing that as group 1. Okay. Now excuses won't work. I will study only for 8 hours. I will study only for 10 hours. I will skip this topic. I will only do this. Will I pass? All that till another 20 days you are giving your best. No hour counting and all. Okay, till now you might have studied only 8 hours as cutoff time, 9 hours as cutoff time. Now there is no cutoff time. Now it is about covering the syllabus. Whatever syllabus you have, come what may, you should try your best to cover it. If you have 20 days time, if you have 3 subjects to cover, then do the math. That means for each subject you have 7 days. In 7 days, you'll try to cover as much as possible. Okay, fair enough. Revision also. Ideally, revision is required, 2 days ka revision. But some of you may have encountered a scenario where you have not even studied the subject. So revision is effective only once you have studied. If you have not even studied, the priority is not to revise. The priority is first to study. So use your available time. Whatever portions you have, first try to maximum cover that. Okay, as I told you, even if some topics, if you're skipping, you might land up in that scenario. That is not a good place to be, but if at all you encounter that, it is all right. Whatever you know, try to know it properly and try to prepare that or present that in a proper way without mistakes in examination. So if you know one answer to one question perfectly, then ideally, if it comes for 10 marks, you should aim to get 10 out of 10. Not even 1 mark lesser, 10 out of 10. So answer whatever you know, answer with the precision, no silly mistakes, and keep your writing speed also top notch. Okay, practice few questions, mock papers if you have time. Try to improve your writing speed. I've been telling this from the day one. CA papers will be challenging when it comes to not only with respect to the volume or trickiness, but also in respect to time. Some papers will definitely be lengthier, so mentally be prepared for it. Go with an anticipation that some question will come as tricky, some new questions will come, some lengthy questions will come, and you will try your best to attempt the paper fully. From the starting minutes, don't go slow. The first major mistake which many students will do is first 30-40 minutes they'll relax, especially that first 1 hour, because no, first of all, exam ambience. So your handwriting, especially for first paper, this happens usually. Your speed, no sir, it will not get picked up from the minute one. First 1 hour, you'll go a little slowly, because it's the first question. You want to present properly. You'll worry about your handwriting and all that stuff. Don't worry about all that stuff. From the day one, it is an express lane. There is no stop. Okay, you're non-stop. You will be writing. You keep up that speed. Even if your legibility goes here and there a little bit, it is fine. Okay, your handwriting, nobody gives a damn. You just have to make sure. I told you one trick. What is that? Whatever you have written, your bajuwala friend should understand. If your next friend is able to understand what you're writing, your handwriting is good enough to be awarded marks in examination. That's all is what we're looking at. Legibility, not neatness. So from the day one, pick up your speed. Okay, and go with anticipation that some new questions will come. But whatever questions you know of, try to answer it perfectly. And given your best, whatever time you have now, just give it your best. Don't have that cutoff period. Entire syllabus, we'll try to cover within our syllabus time. That should be the motto for the next few days. Okay. So because it's only a passing phase of time, people. Another 20-25 days, you have to probably struggle. See, everybody has to go through a little bit of struggling phase. Now, last 3 weeks, I'm coughing. Still, I'm taking marathons. 7 hours, 8 hours class, we are also taking. It's not an easy job. But still, we keep reminding ourselves, benefit for the students, it's a passing thing. It's okay. So certain adjustment, doesn't matter which stage in your life you are, you have to do it. And you are a student, you are expected to learn. You are expected to clear the examination. So that is expected out of you. So don't get freaked out by that. Some days you may have some off days. You may feel, what is this? Nothing is going on. No, I'm not, whatever I'm studying, nothing I'm able to understand. Look at my friends, they're enjoying and all that stuff. Whenever those sort of negative thoughts comes in your mind, remember yourself, it is just a passing phase. After night, there will be a daylight. Okay, like that. So all this also will pass. Another 20-25 days or maybe another 40 days. Okay, some more if you are able to push yourself. Okay, because ultimately to clear the examination, sir, what you do in that last 20-25 days is very, very important. Many students would have already studied, but last 20-25 days, they become overconfident. They become like, I know it. They will take that from the 5th gear, they come off to that 3rd gear. That will cost them 1 or 2 attempts. So don't be there. Now you always have to maintain that highest gear only. So give your best. Okay. So just another 30-40 days if you do. After once you clear this attempt or once the examination is over, nobody will ask you to study. If you have given your best, you know that deep down you have a good chance of clearing. That means if your mind is clear after examination, you will start enjoying that study period or that 2 months of break. Because result will only come usually after 1.5 months or 2 months. If you have not written your exams properly, more importantly, if you have not studied properly, that guilt will always be there. Whether I will pass or I will fail. That means neither are you studying properly in this 40 days. Later on, when you get that 60 days leave, it's actually a leave. That's a time for you to go nuts. Enjoy that time. You'll not be able to enjoy it. So for you to have that particular enjoyment phase, this particular struggling phase or this particular buckling up phase is very much required. So stop giving excuses, start preparing. Okay. It is possible. Don't worry about the less time and all that stuff. Whatever time you have now, how much ever is possible from your end, given your best. At the end of the day, what you can do is your efforts. Like here, this marathon, this was all possible from my end. I've given my best. So I don't have regrets. So like that, you also don't have regrets when it comes to examination, given your best efforts, and make more importantly your parents, your family and your relatives proud. Because though you are writing your examination, it is not just your examination. It is not just you who are making the sacrifices. Your dad may be earning more. He may be taking up extra assignments just to fund you. Some of you might be staying in PG. So all that extra cost your parents are bearing. Okay, it is not just your examination. Because of your sleep schedule has changed, your mom might be helping you out by giving you extra milk or whatever it is. So it is not just your examination, it is your whole family's examination. Even they are also making countless sacrifices which you may not be aware of because they may not share it with you and put extra burden on you. So it is time for us to acknowledge that and give it our best and score this reputed exam called CA. Okay, so try your best. I'm pretty sure your best should be sufficient to come out with the flying colors. Okay, so all the very best. So take care. Bye bye.